Markets open mixed as investors assess the recent trade developments. The GIFT Nifty is indicating a gap down start for the Indian market. And crude oil prices extend gains for the second session as optimism over US trade deals lifts market sentiment. Gold prices fall on signs of easing global trade tensions, which dampens the demand for safe haven assets. India and UK signed a free trade agreement. Average tariff to be reduced from 15% to 3%. Tariffs removed on nearly 99% of goods and services traded between both the nations. Prime Minister Narendra Modi as well as Prime Minister Starmer say the deal will boost bilateral trade by $35 billion annually. And in key earnings to watch out for today, Cipla is expected to report a 6% rise in revenue, while Shriram Finance profit after tax is expected to grow at 9.3% on a year-on-year basis. Hello, good morning. You've tuned into CNBC-TV18 and you're watching Power Breakfast with me, Vinny Motiwala. Yesterday, what we saw coming in was a bit of a decline for the Indian markets, but the handover that's from the US market is a bit mixed. What are we seeing in terms of the Asian markets this morning? A slightly bit of a muted start is what is coming in for the Asian markets, right? Taiwan index is down 0.04%, Hang Seng down 0.6%. We're not seeing any optimism here, right? After US and Japan trade deal, we had seen a bit of a run-up coming in for these Asian markets. Now today, Nikkei is down 0.5%. ASX 200 is also down 0.5%. So a bit of a decline that we're seeing coming in for the Asian markets. That is what we're keeping an eye on. Indian markets also indicating a bit of a red start. As of now, a gap down start is what we are watching out for. Now, handover from US is mixed. Asia has opened up in the red. So how is all this going to be impacting our Indian markets? We have a team of research joining in with us to set you up for trade, tell you which are the important stocks to watch out for, as well as what are we watching out for in the world of F&O. Now, before I go to the research team, let me take you all through what we're watching out for in terms of important cues that we should keep an eye out on for the Indian market today. Like I said, US S&P 500, NASDAQ, that closed at record highs, but what came in was Alphabet's number after that. Now, as of now, US futures are indicating a bit of a mildly positive start that we're seeing coming in, given that Alphabet numbers were quite strong. On the other side, we had Intel that actually said that they are cutting 15% of their workforce. They're grappling through all these manufacturing challenges. So a bit of a concern that comes in on that front. FIIs in yesterday's market in India, again, were sellers. 2,000 crores, approximately 2,100 crores sell coming in for FIIs, while DIIs continue to be buyers of 2,600 crores. Other than that, what we're keeping an eye out on, just yesterday before market close, that India-UK deal, FTA deal was signed. So keep an eye out on some of these individual sectors, whether it could be textile, leather, footwear, gems, auto sector. We'll keep an eye out on individual sectors where there have been rate changes, significant tariff reduction that's come in there. Earnings reaction, post-market hours, we had REC, Cyient, Hexaware, Emphasis, IEX reporting their numbers. IT clearly would be some bit of a focus that we'll see coming in on, and other than that, IEX as well. Earnings today that we'll be keeping an eye out on: Bajaj Finserv, Cipla in the pharma pack. We have Shriram Finance, Bank of Baroda as well as SBI Card, some of the important earnings that I would be keeping on my radar. Now, Nifty, obviously, like I said, we saw a correction coming in yesterday. Keep an eye out on important resistance and support levels over there for the Nifty as well. As of now, a gap down start is what we're watching out for. For the Nifty 50 and Nifty implied open is indicating a 100-point decline. So important to watch out for over there. But we have Gaurav joining in with us right now this morning to tell us which are the important stocks to watch out for in today's trading session. Good morning, Gaurav.
Well, yes, first let's talk about some stocks which will be in focus on the back of the earnings. So let's talk about Cyient. Weak set of number here. Revenue declined almost, and at the same time net profit also declined almost by 10% on a sequential basis, and margins also came in low. KFintech actually came up with a little bit of miss if we compare it with our estimates, because when we look at revenue, that has declined 3% and profit has declined almost by 2% on a sequential basis. Surya, the small finance bank, we were expecting weak set of number, and bank has actually reported around 50% fall in its net profit. Johnson Control, Hitachi, AC, that also company reported a little bit of weak number with profit going down as high as 58% on a year-on-year basis. On the other hand, we have got REC. Actually, when we look at profit figure here, it looks strong, and the reason being that company actually reported negative credit costs in this quarter. Loan book growth was at around 10.4%, a little bit lower than its own guidance. Other than that, Bajaj Finance. Now, this stock isn't going to be in focus, and this is on the back of their commentary from the management. In this quarter specifically, credit cost has remained stable on a sequential basis, but what management has indicated is that there is some stress in 2 and 3 wheelers, and at the same time MSME book, although they have maintained their guidance of credit cost, it can be taken in a negative way. Sun Pharma, on the other hand, is going to be on the focus in focus, and on the back of the deal that they have signed $200 million settlement deal with end purchaser plaintiff in the US generic drug pricing antitrust case. And lastly, let's also focus on Nestle, because Mr. Manish Tiwari will be is appointed as the chairman of the board and MD, and he will be this will be with effect from 1st of August. So definitely watching out on all these companies in the trade today.
Okay, thank you so much for that, Gaurav. But let's go across to Sudarshan, who's here to tell us what to watch out for in the world of FNO. Good morning, Sudarshan.
Good morning, Vinny. So it was a bad day of trade yesterday, mainly because of the deep fall that we have seen in IT stocks, not only large cap, even mid cap stocks, all the especially Persistent and Coforge were down almost 8 to 9% each. And even the large cap space, Infosys, despite reporting a healthy set of earnings for Q1, but the cautious guidance, especially on the higher end of the guidance that company had given 3%, that included inorganic acquisition. So that market took it negatively, and it led to a sharp fall in entire IT pack. And at the end, Nifty IT was down 1%, but good part for Nifty was it held on to levels of 25,000, especially near the support of 25,060. But the problem is today, after following the global cues, GIFT Nifty is indicating a sharp downtick at the opening. Currently, it's down more than 100 points. As far as the flows are concerned, in the cash market, we saw both FIs selling more than 2,000 crore, while DIs have bought almost 3,000 crore, so it's fully offset by DIs. In the index futures, it was a mild kind of trade. In the index futures, FIs have bought just 2 crore rupees. They have reduced long positions of 1,500 contracts. They have reduced short positions of more than 1,500 contracts. Now, long and short ratio, if you see of FIs, it's at 85% and 15%. So they are long 15% and 85% short. So it indicates you that it's heavily sold zone. So from here, if there is any positive news, we might see a sharp short covering. Now, in the option market, 25,200 and 25,100 call options were very healthy. And on the put side also, 25,200 and 25,000 put options were healthy. Now first support around for Nifty is 24,900. Resistance remains around 25,300. That is 20-day moving average. As far as stocks are concerned, two stocks remain in the band. Those are RBL Bank and IX. One stock has come out of the band, and that is Bandhan Bank. Two stocks that I'll keep an eye on. First is United Spirits, because of India-UK FTA agreement. And second, Samvardhana Motherson has been moving higher for the last few sessions. Now, following the trade deals that US has been announcing, it might be positive for this stock as well.
Okay, Sudarshan, thank you so much for that. But with that, we're going to slip into a very short break. And after break, we'll talk to you all about India and UK signing that landmark free trade agreement. Details when we return. Welcome back to Power Breakfast on CNBC-TV18. Now, let's move on and talk about that much-awaited India-UK Free Trade Agreement that has been signed. Now, it has been in the works for over 3 years, with talks starting in Jan 2022. The United Kingdom has seen 4 prime ministers since then. The Prime Minister Narendra Modi says that there may be a swing and a miss, but India will always play with a straight bat. Now, the Prime Minister of UK, Starmer, says that the deal would create over 2,000 British jobs. Commerce ministers of both nations signed the agreement earlier today. The deal is estimated to boost bilateral ties between the two nations by $35 billion and bringing down the tariff guardrails to a large extent. Now, products from the UK, including soft drinks, cosmetics, cars, medical devices, and Scotch whisky will get cheaper, and the deal is also going to unlock access for financial and business services for both the nations. Tariffs on cars manufactured in the United Kingdom would gradually be cut to 10% under a quota-based system. The United Kingdom has opened up its market for India's labour-intensive goods, which will include leather, footwear, textile, engineering goods, fertilizers, chemicals and petrochemicals. Agriculture exports to Britain is also likely to increase by over 20% in the next 3 years.
Who misuse democratic freedoms to undermine democracy itself must be held account. इकोनॉमिक ऑफेंडर्स के प्रत्यार्पण के विषय पर भी हमारी एजेंसी सहयोग और समन्वय से काम करती रहेगी.
This is the biggest and most economically significant trade deal that the UK has made since leaving the EU. And I think I can say that it's one of the most comprehensive deals that India has ever done, boosting wages, raising living standards, and putting more money in the pockets of working people. It is good for jobs, it is good for business, cutting tariffs and making trade cheaper, quicker and easier.
We, in fact, spoke to corporate India honchos on that is Sunil Bharti Mittal as well as Anish Shah to understand what the deal with the United Kingdom means for Indian companies and which sectors are likely to benefit from this. Listen in.
I must applaud the leadership of both the prime ministers to finally come together to get to a conclusion of this historic deal. This, to my mind, could actually set up a real roadmap for many other such deals with the Western world. And today, you could see in that room, in the very intimate setting at Chequers, a tremendous amount of energy between both the sides, bonhomie, friendship, exchanging commitments between not only the political leaders, but business community to take the trade, investment, and trade both in goods and services to the next level. Be a very special, advantage for India to get access to technologies for its own needs, own markets, but more importantly, exporting across the world. I personally feel the bigger advantage will come from UK companies investing in India and creating bases in India, which will be high talent pool that they can access, low manufacturing cost, and make the world their market, which I can tell you, having now worked in UK for several years, is hard for UK companies to come to those levels of competitiveness that India can offer them.
All I would say is that it has been done in a manner that really strengthens the auto industry in India and is a win for both countries. That actually put the question the other way around. Is the UK car industry ready for the challenge that we will pose to them by sending cars from India? All I will say is that from what we've seen, it actually has been put together really well. As I understand, there's going to be a 3-year term. I don't have all the details of that as yet. But again, in brief discussions with some of the key leaders here, we feel that it will be a huge step forward in terms of facilitating that movement, making that happen easily, and therefore fostering innovation and a closer partnership in technology across both countries.
Now let's get in Sudarshan as well to understand what companies and stocks will be impacted because of this FTA. Sudarshan, again, back to you. What are we watching out for today? Because I think this is what everyone was waiting for, and it's been years, right? And everyone's talking about the positives. What are the stocks?
That's correct. So the deal was in the works for last 3 years, and finally it's been signed in the presence of both Indian and UK Prime Minister. So I'll just mention few sectors that will be in focus on the back of this deal, and those are auto, chemicals, food processing, pharma, even whiskey companies will be in focus, and as well as software and IT services. So what will this deal do? It's expected to increase annual bilateral trade between India and UK by almost 34 to 35 billion dollars, and it includes tariff cuts, improved mobility and market access guarantees between both the countries. Average tariff on UK imports will drop from 15% to 3%, and 99% of exports to the UK will now enjoy zero duty access. So now first talking about auto, how will this be beneficial for the auto sector and what all the details are there for the auto sector? First, India has offered concessions on large ICE vehicles. ICE vehicles means petrol and diesel vehicles, and also EVs in the higher price range. So there won't be any concessions to electric, hybrid and hydrogen vehicles for the first 5 years. So any concessions will come only after 5 years. So in the EVs, market access for vehicles that will cost more than 80,000 pounds. Concessions and quotas on ICE vehicles, those are petrol and diesel vehicles, include 3000 cc petrol and 2500 cc in diesel category. Now import duty is going to fall from 150% to 75%. That would be effective immediately, and after that it will fall to 40% over next 10 years. Second sector that will be in focus is pharmaceuticals. Why? India currently exports $23.3 billion in pharma, that is in global market, but exports to the UK are less than $1 billion. Now this zero duty access opens up UK's almost $30 billion market that will be taken hugely positive for the pharma companies of India. Third sector that will be in focus is food processing and agri exports. It covers almost 985 tariff lines, and India's current processed food exports to the UK are around $310 million. Now, what all products might be in focus? Instant coffee, tea and spices that might be gaining over the next few years. Fourth sector that will in focus is electronics. Which all products will in focus? Smartphones, inverters, optical fiber cables will benefit from the zero duty access. Last one is gems and jewelry. India's exports to the UK currently stand at $941 million, and UK imports currently $3 billion worth of jewelry annually. Now, India's exports that, as per analysts, are expected to double over next 2 to 3 years. So keep an eye on these stocks that might be in focus, especially these sectors that will in focus in today's trading session.
Absolutely, Sudarshan. Important to watch out for these in today's trading session. Now, speaking exclusively to CNBC, India's Commerce Minister Piyush Goyal explained how the India-UK trade deal would benefit both countries in the coming years. Listen in.
Plethora of items which are uncompetitive to manufacture in UK today, which India can be a trusted supplier in your supply chains. Likewise, they're very high value medical devices, many products that the UK is known for, high value special medicines, where India can benefit from the UK story. UK also is a largely service-driven economy. Another area where we hope to expand our relations so that all in all, by 2030 we can double our trade. And more importantly, a free trade agreement is also a signal of trust, a signal of enduring partnership, a signal that we now have a stable, predictable regime which encourages investments.
The Commerce Minister also briefly touched upon where India and US trade talks lie. Listen into what he had to say on that front.
I think it's a wonderful relationship that the United States and India share, a very special relationship, and I'm very confident we'll do a robust and good deal where both countries benefit and where businesses on both sides are happy. India will get a preferential tariff compared to our peers and our competitors, because we were amongst the first to get into negotiations, and our discussions, our engagement is truly very, very significant.
Okay, on that note, we're going to slip into a very short break, but don't go anywhere. More news and updates on the other side. Welcome back to Power Breakfast on CNBC-TV18. Now, US President Donald Trump arrived at the Federal Reserve, which is the first visit by the sitting president in roughly 2 decades, to tour the site of a $2.5 billion renovation of 2 historical buildings that the White House has been criticizing. At the venue, Trump and the Fed chair had a disagreement over the renovation costs. Listen in.
So we're taking a look, and it looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out. I don't know who does that.
You're including the Martin renovation. You just added.
That's our entire capital.
Yeah, you just added in a third building. Is what that is. That's a third building,
Well,
including
no,
the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to take a look. We're going to see what's happening, and it's got a long way. Do you expect any more additional cost overruns?
Don't expect them. We're ready for them, but we have a little bit of a reserve that we may use. But no, we don't. We expect to be finished in 2027.
And in some somber news coming in this morning, wrestling legend Hulk Hogan is no more. The iconic face of professional wrestling in the 80s and 90s died at the age of 71, reportedly of a heart attack. The WWE confirmed his death, calling him one of pop culture's most recognizable figures. He was instrumental in taking professional wrestling into the mainstream and was a key contributor in making the World of Wrestling Federation global brand. Hogan was inducted twice into the WWE Hall of Fame and referred to himself as Babe Ruth of wrestling. Surely his passing marks the end of an era. And with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. It's a rainy day, guys.
Yeah.
Actually, I'm glad it's raining because July so far was absolutely dry. I mean, it should rain. It is raining.
It was pouring.
Yeah, absolutely. And, set for the weekend, perhaps, with the beautiful weather, at least in this part of the country.
Yeah.
And set for some fireworks between Mr. Powell and Mr. Trump. The men were together viewing the new Fed building. So, yeah, lots to talk about.
That was most entertaining, right, overnight. But also a word on,
look at that. Look at them.
And the commentary was in the exchange was even better.
You know what I thought of that visual?
Pure cinema.
The first thing which hit me is that compared to Powell, Trump is really tall.
That's
the first thing which came to my mind. Maybe Powell is too short. But anyway, we'll get to that in just a bit from now and talk about in terms of what happened. Let's take it from the top, right? What you need to know as we begin another sort of trading session. You basically have U.S. equities which continue to drift, but drift in the right direction, which is up. The S&P was up, Nasdaq was up. Russell, the small cap index in the US didn't do well. That was slightly lower. But otherwise, I mean, the benchmark large indices once again drift higher is what we've seen, like for the bulk of this week earlier. You had data points, lower initial jobless claims, which is good news. Strong US PMI. I mean, essentially supporting price action. So the macro data points were supportive. Macro markets, 10-year yield, 2 basis points higher, 4.4. I mean, basically, we've been between 4.35 and 4.5 for a while. Dollar index, 97.45. But of course, we've kind of fallen quite a bit and just a small push up. Oil prices around 69.5. Actually, none of these indicators have done anything spectacular, even anything, biggish for a while now. So they're all little up, little down, but not really going anywhere. Now, talking to those visuals, right? President Trump visited Fed Chair Powell, saying that while Powell should not be fired, he should lower rates. And we'll kind of talk more about this. And you saw those visuals, etc. There was a little bit of back and forth about renovation costs and all. But I'll tell you this, from a market perspective, I mean, this is kind of now slowly fading into the background over the last 2 weeks or so especially. People have kind of sort of come around to the idea that maybe this is essentially keep going to battering Powell, saying that, well, he's to blame for rates being high and rates should be lower, etc. But that is what it is. It's like a foil. I mean, you sort of blame the guy if things go wrong, but you keep him because he is essentially that. Fed may cut rates at some point, but the general view out there is not because of what President Trump is saying, but because perhaps down the line there will be some weakness in the economy, which will require a response from the Fed. So that is that. Now, trade tariff headlines continue to remain the big talking point as we go into the weekend. From yesterday evening, we'll sort of play out sound bites that India, UK, FTA, Prime Minister Modi, Prime Minister Starmer addressing the press jointly about the FTA. But, I mean, as far as US is concerned, not very much at all. I mean, that's kind of faded into the background, so to speak. Yesterday was a poor session for the markets, right? I mean, actually, it was not just the broader indices which pulled back. The Nifty Bank did much better. Mid and small cap index was down about 1%. But you also had lots of single stock actions. I mean, around this time, we were talking about how IEX perhaps could be the big accident of the day. I think was down about 30% yesterday. But you had other names, I mean, Persistent and Coforge and many others. So it was a poor session overall. So I'll just put out levels for the index, right? Supports for the Nifty, 25,052. It, by the way, broke the recent two-day low. 25,052 is the first support. 25,018 is the next one. If the 25,018 level breaks, you basically are looking at a retest of 24,882, which is the low over the last fortnight or so. I mean, so it's all incremental. It's all very near term, but that is what it is. Those are the levels we're working with. So 24,882 ultimately is the low that the market made once the Nifty broke that 25,000 level a few sessions back. And we'll see if that comes back into view. Bank Nifty did not break any important support levels. It was a much better session as compared to the other indices. Here, support comes in at 56,692, which is the swing low. And after that, 56,617, which is the 61.8% retracement. And near-term resistance band for the Nifty Bank is 57,300 to about 57,350. Very, very near-term levels, but that's the market we're in. GIFT Nifty gives you a quick sense of how we're starting. It's down another 100 points. I mean, so not looking all that great. The screen's been telling you that the market's kind of tired and things are not responding. I mean, good numbers are not responding well on the upside. Bad numbers, of course, getting absolutely pummeled out there. Surabhi.
Absolutely. And we'll have more numbers to digest today. It's a pretty heavy earnings slate even today. But before I talk about earnings, let's actually go back to that big global story with the US president. Checking out all the renovation that's happening at the Federal Reserve building. A lot of back and forth on the cost of that renovation. But then he was also asked the critical question on whether he still plans on firing the Fed chair. Let's listen in to what the US president said.
I have one dispute, and the dispute is there could be some things with money and, where it comes from, how it's come from, how it's printed, where it's printed, all of the standard things with the Fed. But I just want to see one thing happen. Very simple. Interest rates have to come down. If the interest rates don't come down, we're knocking it out of the park with high interest rates. If interest rates come down, then that final little element kicks in, that's housing. To do that is a big move, and I just don't think it's necessary. And I believe that he's going to do the right thing. I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing.
Okay, so markets perhaps taking their cue, at least, no plans of firing the Fed chair. So for what that is worth. Now let's come back to what we're seeing across Asia and some of the other cues. Markets across Asia are seeing profit taking. They've had a good week, especially the last 2 days have been a big surge for markets like Japan. So it's basically profit taking. The Japanese market itself is down half a percent. The others down between 0.5% to 1%. You can see the Hang Seng and Taiwan index on your screens over there. The dollar has been fairly steady, not too much move in the currency markets. Yesterday, the ECB met and they finally left rates unchanged. They've been on an easing spree for a while. But yesterday, they left benchmark rate unchanged at 2%. Now, for us, it's been consolidation, but the bias is negative. And it's very clear that the Nifty is unable to sustain above the 25,200 mark. We went there on Thursday and, on Wednesday. And Thursday was an entire sell down from that level. In fact, that talk, brings me to what we've done so far this week. So the Nifty is up just about 0.5%. Despite all of this back and forth, we're still up 0.5%. Mid-cap index is down 0.2%. The small cap index, so the broader markets, slightly smaller stocks, that's where the pain has been more apparent, down 1.5%. The sector churn is very interesting. So we know IT has been slammed down for obvious reasons this week. FMCG is underperformed as well. It's down 2.5%. IT index down 2.7%. The money is shifting to the banking trade. BFSI is the only so-called island of safe haven, at least going by the trends that we've seen this week. However, speaking of BFSI, it's going to be all about Bajaj Finance today. And while the growth numbers are fine, and we saw that in the update as well, the issue is going to be on asset quality and a slight increase in credit costs. Bajaj Finance is in fact saying that the stress in the two-wheeler space, three-wheeler space, and the MSME space, it's persisting. Now, the market is in no mood for negative commentary. How will it take it? Will it take it with a pinch of salt and move on Bajaj Finance? Or could there be a bit of selling over here? We'll find out. But financials definitely on my radar today. Nigel.
Well, yesterday's trading session was a weak one, but it was a weekly expiry that played out as well, and that could have played a bit of a role out there. On the whole, it appeared like there was lightening of positions because in the cash market, you didn't have any big, sell number coming in from the net institutions. But the weekly expiry factor did play out, and both on the Nifty and the Nifty Bank, there was some lightening of positions out there. Even if you look at the FIs, both on the index futures as well as on stock futures, they were lightening positions in yesterday's trading session. So that's how the data points did play out in trade yesterday. Moving to how they are set up, the FIs, they continue to remain net short with around 1.45 lakh contracts on the short side. While you have clients, now their long positions have hit around 1 lakh. Remember, at the start of the series, it was a third of what it is as of now. And even if you look at the FI short positions, it was a fifth of what it was as of now. So clearly, both of them are moving in opposite directions. And next week, we have the monthly expiry that will play out. But call writing came back into play. And because of the aggressive call writing, we have seen that the PCR has come down to around 0.84 yet again. In yesterday's trading session, went to around 1.1. And the 25,100 call, 25,200 call, both of them were very aggressive in yesterday's trading session. Between them, it added close to around 80 lakh shares. So the call writers, they're getting very confident. Sometimes, they can get stumped on the wrong side. But in terms of levels that we're looking at, well, on the downside, the recent low, which comes in that vicinity of around 24,850, well, that's going to be the important mark. The low is at around 24,882. So you'll want this level to get defended, 24,850 ballpark. On the upside, resistance comes in going by the options data at around 25,250. For an adventurous trader, if you get a 100-point gap down and if you get another 100, another 50 points down during the course of the day, you get closer to around this mark. So for an adventurous trader, they may look at just buying it just for an intraday minor pullback that we could see. So keep an eye out on this mark. You don't want this mark to get breached on the downside. The Nifty Bank, that's been holding one end up, as you all mentioned. And, yesterday it ended pat at around the 20 DMA. The 50 DMA becomes a bit of a resistance zone. So this is the mark you don't want the Nifty Bank to break. And in terms of stocks that we're looking at, well, we mentioned yesterday, there was a likelihood that Bandhan Bank could come out of the F&O ban. And that was the case. The stock ended high yesterday. Today as well, it's eligible for trade. So we'll keep an eye out on that name.
All right, Nigel, thanks very much for that. Lynn Alden is with us, founder at Lynn Alden Investment Strategy. Lynn, good to have you with us here. Thank you very much for your time. You know, the pressure that we're seeing here in India, while markets like the US, etc., do well, and I'm sort of drawing a sharp contrast because US is kind of pulling away to everyone's, not everyone's, but most people's surprise, the strength that we're seeing. For the last few years, 3 years or so, I mean, the two largest big markets which did very well were US and India. Here there is some underperformance creeping in. I mean, as I said, US is pulling away. What explains the US stock market outperformance, Lynn?
So thank you for having me. I think a big chunk of it was there's been a very fast recovery from the April time period when the full kind of tariff fears were in full effect. And so as the market kind of soothed its opinion over how it was going to turn out, there's been a pretty rapid recovery. I, for one, am pretty hesitant on U.S. markets over the next month or two until we get more clarity on tariffs. One thing I find notable currently is that the current kind of tariff proposals that are ostensibly set to go into place in August are of similar magnitude and concern as the ones back in April that were, delayed and minimized in various ways. And yet this time the market's not concerned about it at all. Last time in April, credit spreads were blowing out. Obviously, the equity market was selling off. There were other signs of distress in U.S. capital markets and to some extent elsewhere. And yet this time, the market is very calm with it. And I think it's understating some of the risks going forward. I think it's overall, it's too focused on Fed activities and perhaps not focused enough on some of these tariff numbers that are likely to come in.
Lynn, hi. So, I mean, the market so far has had no reasons to be disappointed, whether it's earnings, whether it's all the tariff headlines. Do you think that, the second half could be actually a lot better than what a lot of people have been forecasting up until now?
So I don't expect massive downside in the second half. I think that the strong run we've had from April until now, like mid-April until now, that I think is potentially going to run out of steam and not continue up at the same pace. Going forward, we have to see what happens with tariffs in August, and then potentially, some of them delayed into September. I think should multiple good news come in, you can certainly see the market kind of jump higher. But I think it's already pricing in quite a bit of good news. So it's not to say that I'm particularly worried about a crash or correction or anything like that. I just think the risk reward favors some caution, perhaps over the next, 4 weeks, 6 weeks, 8 weeks, until there's more clarity. Because if you kind of map out the overall tariff proposals going forward, they're well over 500 billion, potentially over 600 billion in tariff revenues, up significantly from current months. And the market expects some of that to be negotiated down. But if markets are very smooth sailing, then President Trump has every reason to negotiate very hard or not really back down from his high tariff positions. So if the market is kind of trying to look forward through it, they could actually be giving him more ammo to keep them high.
Hi, Lynn. Good morning. Good to see you, Ben. You've mentioned in the past, I think preference could be to emerging markets in comparison to developed markets. Do you stick to that? And within the emerging markets, where does India come in at? Because we've chatted in the past, China and Brazil are relatively cheaper. India has the growth and it's more structural story. So at current reckoning, between emerging and developed, what's your view? And within emerging, where does India feature?
So I continue to like emerging markets overall. Some of my favorite areas continue to be Latin America in particular. Right now, for example, Brazil's under some optical issues because they're potentially facing 50% tariffs from the U.S. based on this latest round. The good news is out of a $2.2 trillion economy, they've got a little over 40 billion in annual exports to the U.S., many of which are agricultural products that over time could be redirected elsewhere. And it's just a very under-owned market. I think similar is true for China. India overall has not been as out of consensus as some of these other markets have been. And so I still think that there's a catch-up trade to be had with some of these more value-oriented markets. But I like emerging markets pretty broadly. I like Eastern Europe. I like Southeast Asia. I like certain parts of Latin America and China and India and elsewhere. So I do like the broader play. I don't think this dollar bear market is entirely over. I think it got overdone for a period of time. It's going through a little consolidation and a bounce, in recent weeks. But I think when we look forward another 18 months or so, I wouldn't be surprised at all to see a lower and lower in the dollar index, which can help give emerging markets a little bit of fuel.
Okay. All right, Lynn, we'll leave it on that note for this morning. Thank you very much for joining in. You have a good Friday and, of course, a great weekend ahead. Well, with that, let's move on and talk about all the interactions that are lined up on the show today. Coming up at 8:35, we'll bring you excerpts from our exclusive conversation with Sid Swaminathan of Geo BlackRock Asset Management as it gets the SEBI nod to enter the Indian mutual fund industry. At 9 a.m., we'll have with us the management of CG Power and Industrial Solutions talk about their first quarter performance and outlook. Harish Krishnan of Aditya Birla Sun Life AMC is our market master of the day. He joins it at 9:20. At 9:30, we chat with the management of Hexaware Technologies, talk about the company's latest earnings scorecard, and of course, the outlook ahead. After that, we have the management of Canara Bank joining in. Remember, Canara Bank popped 5%. Good numbers coming through yesterday. So Mr. K. Raju will join in to detail out that performance. At 9:50, we'll be speaking with Memphasis. The company came out with the numbers yesterday. And we'll get a view on how the rest of the year is looking like. Mithun Rakesh and Arvind Viswanathan joining in. And towards the end, our special segment, it's the economy coming up. Today, Lata will speak with Soumyakanti Ghosh of SBI and Bhavesh Jain of TransUnion Sybil as bank loans to MSMEs have surged in the first quarter. And we'll find out what the asset quality trends are looking like.
Time to take a short break. On the other side, we go full throttle on stocks in our top 10 segment. We're looking at REC, Emphasis, eClerx, Sun Pharma. All of them will be reacting to positive news flow. On the flip side, Bajaj Finance, IEX, Hexaware, Phoenix Mills, Cyient, and KFin Technologies will be reacting to negative news flow. Take that break, come back, we'll get into further detail on all of those names.
Welcome back. Well, it's a slightly quiet morning across Asia. Markets are cooling off after what's been a very, very strong week for some of the regional indices, particularly, of course, the Japanese market. There you see, but Taiwan's now flipped into the positive side. Oh, by the way, that's an interesting update on DLF also coming in. Remember, this is their maiden project in Mumbai West Park, and apparently the first phase is completely sold out. So yeah, sales already 2,300 crores already going to be booking in that amount from the Mumbai project. Of course, one luxury project. It's in Andheri in the city. Anyway, let's talk more stocks and get our team going. Our list of top stocks to watch this Friday morning. Guys, morning to all of you and happy Friday. Well, let's start with Bajaj Finance. Gaurav, first of all, will it be happy or not, given the slight increase in credit cost?
Well, yes, when we look at the numbers, they actually look good because profit has increased almost by 22%. Even it delivered 25% AUM growth. But what remained some negative is that the commentary on credit cost. What has happened is that the credit cost has remained at around 2%. So let's understand the numbers around that. Gross NPAs and net NPAs, they have increased almost by 75 basis points. As a result, when we look at credit cost, that has remained to around 2% on a sequential basis. What management commentary suggests is that the stress is specifically coming up from 2 and 3 wheeler segment and also from the MSME segment. Now, what they're saying is that going ahead, there will be some slowdown in these segments. They believe that at least for the first half, the stress will remain. And when we look at the other commentary, although they have maintained their credit cost guidance around 185 to 195 basis point, it may be taken in a negative way because the credit cost has still remained elevated. Other than that, when we look at brokerages, there also we did not see a big cheer for Bajaj Finance. In fact, JM Financial, they have maintained their target at 1,000 rupees. What they say is that the near-term concerns around the growth and asset quality will keep the stock actually in line and also range bound. On the other hand, we also have JP Morgan who downgraded the stock to neutral. We have UBS who still maintains its sell rating at a target price of 750. Macquarie also maintained its target price of 800. So definitely not a big push that we saw from brokerages as well on Bajaj Finance this quarter.
Well, it's a Friday. Surbhi said they're looking happy. Just look at the faces. All of them. I think Sonal is the happiest.
These are earnings faces. I can see. This is earnings season faces.
Earnings season, any weekend is like a big relief. I think I've seen around 60 earnings seasons here at CNBC-TV18. What a relief. All these guys are going to be enjoying this evening. But Gaurav, coming back to you, you have had a very, very hard week. REC, those numbers look good.
Well, as REC actually numbers look good, and the reason being, on the flip side, we could say actually the credit cost was something which actually pushed the profit for REC. So let's understand the numbers first. Net interest income increased almost by 17%. It was in line with the street's expectation, which is the operating profit that actually increased just by 4.8%. There was a little bit of disappointment because of the loss on fair value, which actually dragged down the operating profit. But on the other hand, credit cost, now company has reported negative credit cost for the quarter of around 670 crores. This was led by one of the NPA accounts of TRN Energy, where we saw a resolution happening, and as a result 270 crores of provision was brought back. On the other hand, this actually pushed the profit up almost by 29% on a year-on-year basis. Let's also not forget that net interest margins also improved on a sequential basis. On the loan book front also, when we look at disbursements, that remained very strong at around 32%. But the loan book growth number actually came at around 10.4%. It was a little lower than their own guidance of around 12% growth for the year. But definitely, I think the street is going to take credit costs in a positive way because the gross and net NPAs have also fallen down. So that was actually something positive for REC in this quarter.
Yeah, no, absolutely. More financials a little later. Thanks very much, Gaurav, for that. Keep an eye on those names, Bajaj Finance in particular. IEX is the big one, right? I mean, sold off big time. News, of course, is now well known. Vivek, tell us more. Did you, by the way, see how much of the equity got changed hands yesterday? I think it's a substantial, over 10%, Vivek?
Absolutely right. Large portion of the equity got changed. The other thing is, while we will be discussing the operational update or the Q1 numbers, more importantly, all eyes will be on what is the way forward, what is the strategic roadmap that the company lays, in the fact that how are they going to go and deal with the implementation of market coupling. So all eyes will be on the management when they join us at 10 a.m. today. Now, looking at Q1 FY26 results itself, largely in line, a very steady set of numbers. Remember, volumes were up almost 15% on a year-on-year basis in the key markets. So on the back of that, revenues higher by 14.7%, the EBITDA up 16.1%, margins, up 100 basis points, and profitability up 25%. Now, there's one sentence that the management has given in the press release. They're saying that the company is currently undertaking a detailed impact assessment of the implications of the regulatory change, that is market coupling, and will keep the stakeholders informed of any further developments. Now, the important part is, what is the company said? The collectives, which is the day-ahead market, RTM market, and the green day-ahead market, actually constitute close to 75% of the volumes which will be impacted by market coupling. So all eyes on the management, and we also need to see whether they have anything in the arsenal to go ahead and challenge this particular order.
Got it. Okay, all right. Thanks a lot for that, Vivek. Let's go to Rima, Hexaware and Emphasis. Rima, how are those numbers?
Well, Hexaware was softer than expectations. The company's top line grew by 1.3%, lower than the CNBC-TV18 poll of 2.5%. The way we calculate margins have come off sharply to 12.4%. And there's this big increase in the other expenses, which is to do with provisions, impairments for select customers, etc. But the way the company calculates it, and they've given adjusted margins, that has gone up to 18.1% versus 17.1%. But there is this big jump in the other expenses, which is hurting the company. Also, from the press conference, while they haven't given a quantitative number for the guidance, just the body language seems to be that they've toned down their expectations for growth this year. So last time, they just sounded a lot more positive. I remember they said Q2 is going to be a good quarter, Q3 is going to be a great quarter. Right now, all they're saying is that we see continued softness in the macro. The slowdown is cyclical in nature and not AI-driven. Margin guidance remains unchanged at 17.1 to 17.4%. Now, for Emphasis, on the other hand, revenues are a miss. It's okay, it's 1%, but lower than expectations. Margins are in line, but the deal wins are very strong. The company's reported the highest ever deal wins at $760 million. And even after this conversion, they say the pipeline is the strongest ever, and 68% of that is AI-driven.
Okay, all right, Rima, thank you very much for that. 9:30 a.m., you'll hear from the management of Hexaware, and they'll be with us a little later. After that, we'll have the management of Emphasis join us as well to talk about their earnings. So that's the lineup which is coming up in a bit. Well, let's talk about Phoenix Mills next. Sonal is here with details. Sonal, good morning.
Good morning, Prashant. Well, this time around for Phoenix Mills, yes, there was growth, but it was a muted growth that we saw. Overall, revenues were up just 5%, EBITDA grew just 6%, margins were flat on a YY basis, profits were up 2%. While on the mall side, consumption was in double digits, up 12% to come in at 3,588 crore rupees. The retail EBITDA for the mall itself was just up 4%. And if we talk about the most famous and the highest consumed or the mall with the highest consumption, that is Phoenix Palladium. That's where the EBITDA was up just 2%. Their market city Bengaluru saw a decline of 10%. Market city Pune saw an uptick of just 3%. So overall, the EBITDA from malls or bigger malls was lower this time. In an additional news, the company has bought out 49% shareholding of Canada Pension Plan Investment Board. This is in their JV Island Star Mall Developers, and the aggregate consideration of around 5,500 crore rupees. This will be paid over 4 tranches, and the company will be funding it via a mix of buyback, capital reduction, and dividend payout.
Okay, all right, got that. Sonal, thank you for it. Let's go to Rima, a couple of mid-cap IT earnings, and let's see, hopefully they'll be better than what we had yesterday, Rima.
Well, Cyan, perhaps not. The company's at a group level, the revenues are down 9%. Margins have come down sharply to 9.5%. Profits are down nearly 10% on a quarter-on-quarter basis. They've done a lot of restructuring. There is this key business DET that we capture, and there again, it's muted. Revenues are down 1.5%. Margins have come down to 12%. And the company says in the conference call that the environment is tough. One of the orders that they were expecting to close has been deferred. eClerx, on the other hand, was a fairly steady set of numbers. Revenue growth 3.3% quarter-on-quarter. Year-on-year, it's about a 16.5% growth. The company's EBIT margins have been largely maintained at 19.6%. So that's an okay set of numbers. Signed is a bit muted.
Okay. All right. Thanks a lot for that, Rima. Well, hopping across to Vamakshi, who's been making a lot of slugs and, putting a lot of data points together. Today, KFin Tech is on your radar. Vama, take it away.
Well, absolutely, Nigel. It's a slight miss as far as the earnings are concerned. Revenue saw a downtick of almost 3% sequentially. Now, keep in mind that the street was anticipating the revenue to be flat, but that hasn't really transpired. Apart from that, the employee expenses for the company grew by 10% sequentially. This was partly offset by other expenses which dipped by 17% Q on Q, but that was not enough, and resultantly the EBITDA margin came under pressure, down almost 170 basis points quarter on quarter, but it was slightly better than what the street was expecting. Resultantly, EBITDA came in at 114 crores. This is only a 1% miss as far as street expectations are concerned. The net profit, on the other hand, came in at 77 crores. This is a 9% sequential decline and came in nearly 2% below what the street was expecting. Now let's look at what how the segments performed. The domestic MF solutions business, which comprises of nearly 75% of the company's revenue, saw an uptick of 3%. Issuer solutions and international solutions, on the other hand, saw a dip on a quarter-on-quarter basis. And when you look at the margins, they've declined across the board, across domestic MF, issuer solution as well as international solutions. So therefore, slight miss, margin compression seen.
Okay, all right. Thanks very much, Vamakshi, for that. Sun Pharma is the next one we want to focus on. Vinny's got more details here. Vinny, good morning.
Hi, good morning. So keeping an eye out on Sun Pharma. Why? Because there's a settlement that has come in terms of one of the issues and litigations that were going on. Now, Sun Pharma and Taro have agreed to pay $200 million. This is to settle claims in the generic pharmaceutical pricing antitrust litigation. This litigation was going on for a while. Around since 2015, this pricing litigation is going on. Now, obviously, what it means for the company that they will be paying this $200 million. It's a one-time settlement that comes in. But obviously, the overhang of this is, now getting over. So that is why we're expecting positive coming in for Sun Pharma. They had cash flow of around $3.1 billion as on March 2025 as well. So no worries in terms of payment-wise as well. $3.1 million is what they were holding as of March 2025. And just in terms of an impact, analysts believe it's not going to be a material impact that is going to be coming in here. So keep an eye out on this one. Positive because the overhang of this litigation is finally ending.
Thanks a lot for that, Vinny. Well, let's do a quick recap of all the stocks we just covered. REC, Emphasis, eClerx, Sun Pharma. They'll react to positive news flow. On the other end, you have Bajaj Finance, IEX, Hexaway, Phoenix, Cyient and KFin Technologies. They'll be reacting to negative news flow. We'll take that short break, come back. Sid Kemka of Motilal Oswal Financial Services is waiting for us for some fundamental talk. We'll also bring you excerpts from our exclusive conversation with Sid Swaminathan of Geo BlackRock Asset Management as it gets the SEBI nod to enter the Indian mutual fund industry. Welcome back. Well, let's get some fundamental analysis going on all the stocks we just discussed. Sid Khemka, Head of Research Wealth Management at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Good morning. Good to see you, Ben. Let's talk about the big boy, Bajaj Finance. Highest in pedigree. Everything good out there. Growth is likely to come about. But some concerns on asset quality, particularly the commentary on the 2- and 3-wheeler space. That could make the market a little bit jittery. And as always, it's never been a cheap stock, right? What is your view on the numbers? And if you want to look through a read-through for the sector on the whole.
Good morning, Nigel. Yeah, good to be on the show. I think Bajaj Finance clearly one of the finest quality stocks, consistently delivers in terms of growth. Even Q1 net profit grew 22%, which was in line with our expectation. The NII also grew about similarly in line with our expectation. I think, yes, some NIM contraction and the management outlook that further reduction of about 15-20 basis points, that could be a big negative, especially given that stock is trading at a premium valuation. And as you rightly said, yes, the management also highlighted that consumer leverage remains a key area of concern, and that is leading to the company to implement some of the corrective measures across certain product lines. So that is leading to the elevated credit cost. Having said that, what we believe is that it continues to report a healthy performance, strong AUM growth, some concerns on the credit costs sequentially that remains, especially due to stress in the MSME and the auto loan segment. And as you rightly said, again, stock trades at 4.4 times FY27 price to book. So despite the healthy PAT growth CAGR of 25% and strong ROAs of 4.1%, we see limited upside catalysts in the near term due to rich valuation. And hence, we have a neutral rating on Bajaj Finance with a target price of 1,000, leaving a very small upside for Bajaj Finance from current levels.
Okay, that's Bajaj Finance. We have to see how the stock reacts and whether it chooses to see the brighter side of things or not. Siddharth, hi, morning. What about some of the other names? If you talk about, for instance, yesterday's earnings, IT has been the big talking point. Do you advise at all venturing in and say, buying the dip on a Coforge, or do you think that these stocks are now running the risk of further corrections just because they've run up, valuations are high?
So definitely, I think if you look at some of the IT names, especially the mid-cap IT names, the expectation was of a very strong earnings growth. And that is where the impact was. So the earnings becoming softer, and some of these stocks, Persistent, Coforge, they are very high value stocks. So hence the market impact in terms of the negativity that we saw. But what we believe is that the overall outlook remains positive. There is a beat on revenue. Margins, yes, a little bit have been a miss. So with a strong executable order book and a resilient client spending across verticals, we believe it bodes well for a company like Coforge. In the near term, I think the stock could languish a bit, but definitely one of the high quality names in the mid-cap IT that one should look at accumulating at lower levels. So we remain positive on Coforge from a long-term perspective. We have a buy rating, and we have set a target of 2240, which is a good, decent 30-35% upside from current levels.
Yeah. Post our interaction yesterday, guys, with Mr. Sudhir saying, I spoke in the evening to a bunch of investors, and they, now, of course, when there's a bit of a, it's not disappointment, numbers are still very, very strong. But the basic difference, when we used to speak with the company, right, they're growing so fast, others are not growing so fast. So people are now starting to question whether, Coforge has been taking on lower quality work.
Yes.
To get those very high growth rates on the top line. But margins are lower. And I asked that question yesterday to the company, that margins are substantially lower to even large cap IT.
Yeah.
Large cap IT is north of 20%. And of course, I mean, there is that bit about, Nigel, I think, which you addressed,
yes,
which is
the third party.
The AI data center
the capex
investment, etc. as well. So we'll see. But there is a fair bit around this, and we'll see how this pans out. But there's emphasis, Hexaware, lots of mid-cap tech. Anything else you like there from in that space? the mid-cap space, mid-cap tech space, Sid?
So, Prashant, I think Persistent is the other one. Both of them has corrected. I think that is where the outlook is. And as you rightly said, yes, again, some of these companies are doing that heavy lifting and spending a lot on the new age digital as well as on the AI capabilities. And hence some impact on margins in the near term. But the two top picks for us in the mid-cap IT names is Persistent and Coforge, both of which we like from a long-term perspective.
Okay, what we'll do is we'll take a quick break here and we come back in just a bit from now with more as far as stock discussions is concerned, and there is a lot to address. And of course, we'll get you that Jio BlackRock conversation as well, Jio BlackRock AMC conversation as well. Stay tuned. Welcome back. We've got Jio BlackRock, which is the new powerful entrant in India's 50 lakh crore mutual fund industry. Of course, backed by the digital scale of Jio Financial Services and the global investment engine of BlackRock. It recently received a SEBI approval in May of 2025. The firm has launched 3 debt-oriented NFOs, money market, overnight and liquid funds, and raised about 18,000 crore rupees. I caught up with Sid Swaminathan, the newly appointed CEO of that entity, which is Jio BlackRock AMC. This is his first television interview since taking over. Just some interesting data points and some sort of perspective on how they plan to build the business out. Listen in.
The value proposition for the funds that we launched with the target segment being primarily institutional really resonated well. And that was evidenced by just the sheer number of institutions that participated in the first set of NFOs, and that continues to grow, even post NFO. And then the brand that you talked about also clearly has a strong pull, which was evidenced by the retail participation that came into these funds as well. So combination of solid value proposition on the funds themselves, along with the trust and recognition of the brand, I think worked really well for us.
I think we've spoken and it's been talked about that it's such a crowded industry and there are more players coming every day, new approvals, etc. coming through. Did you think of that as a bit of a hump to cross? And now that you've raised this money and quite successfully, a large number, is that a question which comes up now or not really?
Yeah, look, I think for us, if you take a step back, right, the industry, when we chose to enter the market here, it was also more about where the industry is going to go to from here. And we see immense potential for this industry to grow. Penetration is still fairly low when you compare it to other markets, but we're seeing the trend of more and more investors coming into the markets themselves growing. So this could easily be 2-3x in 5 years' time from now on, just in terms of the size. So I think the growth is there. Yes, more and more entrants are looking at the same thing that we are and coming in, but I think there is still space for all of us. There is still space for innovation. And I think by helping to grow the market, we will be successful along with all other participants in the market. That's how I look at it.
You have 5 approvals to launch 5 index funds, right?
That's right.
Equity and debt.
Correct.
4 equity, one debt.
That's right.
And by when will we will see this in the market?
So we're not going to put a date on it just yet. We need to go through some more steps before we confirm that. But imminently is the timeline for us to launch those 5 funds.
We ask companies who join us, what's the revenue target? Is there an AUM target with these funds?
No, we don't. Sorry to disappoint you, but no. The way we're looking at this, and I can get into this in more detail if you want. We are coming to market with differentiated propositions, as well as a differentiated digital-first distribution strategy. So there is a lot that we need to test and learn in this market. We've done the first set of NFOs. We learned a lot. We're very happy with how that went, and we are incorporating some of those learnings into the next phase. And I think really once we get through our first phase of fund launches, see how they go, learn about the market, see how they're reacting to our offering, is when we'll really start thinking about setting longer-term targets, right? And that's literally how we're looking at it right now.
What about actively managed equity schemes?
Yes, is the short answer. We are here to cater to the full spectrum of investors in India. That's how we are looking at things. So we addressed institutional primarily already with the funds that we've launched. We're moving into the retail segment now with these 5 index funds. And I really, when we think about investors in general, for me, it's not about active or passive. I think it's about active and passive, because I think both play a key role in the overall asset allocation that an investor should have in their portfolio. So yes, is the answer. We will be launching active funds in the near future. We are looking at it through the lens of what is differentiated that we can bring to the market. So we've assessed what is available in the market right now. We've also assessed some of the capabilities that we can bring. Remember, half of the joint venture is with BlackRock, which has had decades of experience investing globally in markets.
Shareholders of Geo Financial Services are watching, and they want to get a sense of what will be the size of the AMC business with it. How important, what size, but how important will the AMC business be when they kind of sort of look at, like a SOTP of the entire company, etc. Can you give us some way to think about this? Not exact numbers per se, but...
Yeah, look, sorry to disappoint you again by not giving you numbers, but the way we look at it, right, and I said this at the start, the first belief here is that the growth of the market. So this is a market that we think can grow, 2x, 3x from here in the next 5 years. And yes, we want to be a significant player in that market in that time period. How we actually set our targets, again, I'll go back to what I said at the start, is we need to learn about our kind of initial phased launch, which is across all asset classes and investment styles. And then we will evolve the strategy as we go from there. Our aim and vision, obviously, is to be a big player in this market in the near future, and be a big component of the entire Geo Financial Services ecosystem.
Internally, is there a target? You want to be amongst the top 5 in terms of AUM or some such metric?
Any of those targets as yet.
must have some kind of idea. You want to do well, but you're not setting yourself targets. You'll kind of sort of
Not as
respond
yet.
to
Like
how the
I
market.
said, we're really approaching this as a true startup where we want to learn and then evolve and adapt, and then we'll be in a better position to actually set some targets.
Many in the market feel that maybe in financial services with Jio BlackRock and Jio Financial Services, we'll see like a telecom moment, complete disruption. Is there room for that kind of disruption in this business? And of course, there it was, pricing in a big way, but reach, etc. as well. Here, what could be that big disruption? Are you thinking on those lines?
Yeah, look, I think of it slightly differently. Firstly, the industry itself is very different. So, the regulations are different. The level of competition that's prevalent here is also very different. I still think there is room for micro innovations or micro disruptions, whatever you want to call it. And that's how we're approaching it. So the fact that we are coming to the market initially with a digital direct first offering from a distribution perspective, that sets us slightly apart from a lot of the players here. Some of the funds that we're bringing to the market, you will see in due course, also have a very different sort of investment style relative to what's available in the market. So that's another change. Our technology platform that we're bringing onshore to India for the first time ever, that's another micro sort of disruptor, differentiator. And that's just, let's say, one part of the overall joint venture as well, right? So there's other things coming further down the pike. So the way I see it is, a series of these micro disruptions over a time period could lead to a much bigger disruption, but it's different to how it panned out in telecom.
Okay, all right. Interesting chat there. Jio Financial, that's the one that you should be keeping on your radar. Well, let's move on then. India, UK yesterday signed the free trade agreement. Sudarshan joins us to focus on stocks, companies that will be impacted because of this signing. Morning, sir. Take it away.
Good morning, Nigel. So the deal which was in the works for last 3 years has been finally signed in the presence of both Indian and UK Prime Minister, which is going to increase annual bilateral trade to $34 to $35 billion, which includes tariff cuts, improved mobility and market access guarantees. So now average tariff of UK imports will drop from 15% to 3%, and also 99% of the exports to the UK will now enjoy zero duty-free access. So which all sectors will be in focus? So first one in that list is auto. So India has offered concessions on large ICE vehicles, so that is basically petrol and diesel vehicles, and also for EVs in the higher price range. There won't be any concessions on electric, hybrid and hydrogen vehicles for the first 5 years. So in EVs, market access for the vehicles would be for the vehicles which would cost more than £80,000, and also concessions and quotas on ICE vehicles. In petrol, it would be for 3000 cc, and in diesel, it would be for 2500 cc vehicles. So import duty will fall from 150% to 75% immediately and to 40% over next 10 years. So if anyone has a question, will there be any change in JLR's Defender price? The answer is no, because this FTA agreement is only for those cars which are built in the UK. JLR's Defender is built in Slovakia, which comes under Europe. Now, next sector that will be in focus is textile and apparel. So agreement has slashed UK tariffs in the range of 8 to 12% on garments and 10% on home textiles. So now this duty-free access will be for 99% of Indian apparel and textile export. And some of the stocks that might be in focus, those are Westman Living, Gokaldas Exports, KPR Mills. Next sector comes is leather and footwear. So it eliminates tariffs on nearly 100% of Indian leather and footwear exports, which previously attracted duties of up to 16%. Next is marine products and food. That eliminates tariff of over 95% of agri, marine and processed food exports, and also slashed duties that had already reached to 20% on seafood and 70% on processed foods. Next is Alco Web, that is basically beverages stocks. India will reduce import duties on UK whiskey and gin. Duty will reduce to 75% from 150% immediately and to 40% after 10 years. Last is gems and jewelry. So India's exports to UK currently at $941 million and UK imports currently $3 billion worth of jewelry annually. So analysts believe that India's exports are likely to double in the next 2 to 3 years. So overall, India-UK FTA agreement is positive not only for India, even for UK companies.
All right. Thanks very much. So then I noticed that so is focus on the defender. As far as JLR is concerned, but other stuff as well. Very nice, very nicely summed up sector by sector. Thank you very much for that. We'll take a quick commercial break here. Up next, Technical Trades. Mitesh is going to be joining us, and so is Srikanth. It's a Friday morning. So Srikanth with his trades as well. Stay tuned.
Welcome back. 15 minutes to go before trade kicks off this Friday morning. Let's figure out what the trading setup is looking like. What are the kind of bets that you can perhaps consider? We have Srikanth Chauhan and Mitesh Thakkar joining in. Gentlemen, good morning. So it's been a tough week for the market. I mean, the Nifty has been consolidating. It's not falling, but it's not rising either. But individual stocks are getting slammed very hard, particularly if there are earnings involved in some cases. So Mitesh, let's start with you. Friday morning, how would you approach trade?
Yeah. Good morning, Survi. We have talked about the fact that market will possibly be ranged, and that is how it's shaping out. Most of the volatility indicators, if you look at them, have kind of started turning sideways, and that is why we are not able to get past 25,300 zone on the upside and not, giving a decisive break to 24,900. Now, till that happens, till the price signals that it's willing to get out of this range, we must assume that this range will hold, and therefore we're not trading the index aggressively. But yes, trading is stock specific. And on the bank Nifty, I think a very similar kind of an outlook. It needs to get past 57,300, 350 zones to give a break on the upside or move on the upside. And on the downside, the corresponding level is about 56,200. So till that happens, I think you might see the market still chopping around in these boundaries.
Gentlemen, morning. Friday, so visibility into the weekend, but the drift continues here.
It's like, Prashad, I remember what you said. Sorry, you look through the weekend, already start looking through the Monday. That thought never left me. That was last Friday's thought, but please go on.
I'm known to sometimes utter profound statements.
Absolutely.
Anyway, let's, Srikanth, morning. What's on your mind in terms of trading indices?
Good morning, Prashant. Good morning, everyone. Let's say for as far as Nifty is concerned, it is in the range and it has been following the level of 25,250, 300 on the higher side and 24,900, 850 on the downside. So in case if we see the market is opening somewhere close to 24,950 as GIFT Nifty is indicating, then there we should look for taking some contra bet of going long, because I am of the view that the market is going to follow this range for next few days. And buying at important support levels or selling at resistance is actually rewarding to traders. So close to 24,950, 940 levels, we should look for taking contra bets with a stop loss at 24,850. And at higher levels, again, 25,150 going to act as major resistance.
Okay, all right. Trades now, gentlemen. What are the trades you'd like to take? Mitesh, you go first.
Yeah. Morning, Prashant. I have a mix of buy and sell calls. Birlasoft and Coforge. So both from the IT names, they had a negative setup, and Coforge, of course, was in the news with decline, a strong decline with big jump in volumes. I'm looking at targets of around 1625, 1620 to begin with, and maybe even lower levels can be tested. But that's the initial target, and therefore a sell with a stop just about 1701. While Birlasoft would recommend selling with a stop at 404 for targets of around 380. And on the buying side is Indian Bank, buy here with a stop at 640 for targets of 675. Correspondingly, Fortis, which made a fresh high and it was a recommendation earlier as well, now can be bought with a stop below 830 for a target of around 875.
Okay. All right. Got it. Mitesh, Srikanth, what about you? Stocks for you today?
Yeah, I would like to go with PSU banks. There we are seeing good amount of buying strength, especially after the quarterly numbers of Canara Bank. We like Bank of Baroda. It is around 245, 246 levels. Here we can keep a stop loss at 239. It is forming some ascending triangle sort of formation. So based on its formation, I'm expecting stock to move towards the levels of 260, 265 in the near term. So it's a buy at current levels, Bank of Baroda. We also like Grasim, and it is available at its 50% retracement ratio. It rallied from 2,500 to 2,900. Now it is again correcting back to its support levels. So close to this 2,700, 2,735, we should look for creating some long positions with a stop loss close to 2,690. And again, we can expect 2,850 sort of levels on the high side.
Okay. All right, gentlemen, got that. Thank you very much for all the trades. We'll come back to you a little closer to market opening. 9 a.m., let's focus on some earnings as well. The first company on our radar this morning is CG Power. The company's growth in the first quarter seemed quite healthy. Order inflow was quite strong. Margins came under a little bit of pressure. In fact, the top line grew by about 29%. But if you see the EBITDA margins, then from a level of 14.7%, EBITDA margins came down to about 13.2%. So let's understand what's been happening and what the outlook is for the rest of the year. We have with us Amar Kaul, Managing Director and CEO at CG Power, joining in. Amar, great to have you on. Morning. So let's just start by understanding the top line growth. How much of that is your base business, the organic revenue itself, and how much came in through the recent acquisition that you made?
Sorry, there's a voice issue. Can you repeat your question?
Yeah. I was just asking that the top line growth of 29%, how much is it organic, the ongoing base business, and how much came in from your recent acquisition, right? Axiro, the acquisition that you just made.
Okay, that's
If you just split that, talk about Axiro scale up and give us a view on the growth on the base business itself, what you're seeing this year.
Sure. So if you look at, 29% you talked about the top line growth, that is the consolidated basis. So our standalone business is at 25% growth with a PAT growth of 23%. So which is in sync with the way we are seeing the growth. And if I look at consolidated level, which is acquisition of Axiro, that has already been completed, and I think this will be the transition year. They already started getting the revenue, but yes, when you acquire a company, the first year will be the transition mode, and then it starts going up.
Yeah, so if you could give us a sense of scale, and that's very impressive. The base business itself grew at 25%, so we've noted that. Now talk to us about the scale up in Axiro. In FY26, how much will it add to your top line? And in FY27, when it's fully integrated with your operations, then what can we expect? And so then total growth going into FY27, what should we work with?
So we would expect Axiro to be at about 400 crores approximately to bring in this financial year, and keep building on the same.
At what growth rate? Good morning, Prashant here. What rate of growth?
It's basically, we just acquired the company. So I would say it'll be a bit shade above what was done in, it was with Renaissance last year. So it'll be a shade above that.
Which is, if you can give us a number.
It's the shade.
Amar, at what, roughly, I'm not looking for specifics here, but just, over 400 crores, what's 27 going to look like and after that?
So long term, as you know, we don't give forward-looking statements in terms of the growth numbers, but I would say even the growth will be a double-digit growth to start with.
Double-digit.
The aspirations are huge there.
Okay. Amar, just one question on the OSAT, and we've spoken about this in the past as well, right? That has come online, it's showing up in your revenues, it's showing up in the bottom line as well, although in a negative way. Could you talk to us about where that stands now in terms of starting up and when will that business break even? Because it is taking a little bit out of your net numbers right now, but of course that's a matter of time.
Yeah, no, fair point. And as you know, semiconductor, India had no access to it, so it's a long-term investment. That's why it's a strategic investment. But the good news is, I think what we have been able to brought into the country is the technology of OSAT. The second good news is also that the project is ahead of the target. So hopefully in this quarter itself, we should be soon announcing the inauguration of the first facility, which we call the mini facility. And then it takes about 9-10 months approximately for approval and making sure that it gets commercialized. And FY27 will be the main plant, which is the larger one. So both the projects are going exactly in sync with what we have planned for.
All right. Hi, Amar. Good morning. Good to see you, Vin. You're sitting on a solid order book of around 13,000 crores. For the year, what kind of ballpark revenue growth can you deliver in comparison to last year? If you could help us out with the broad range. And also, what about margins? Power systems, the margins are very, very encouraging. Can those margins sustain? And do you expect the industrial systems margins to improve now that, there are some kind of price increases that could come about? There'll be execution of coverage orders as well. So what is the margin improvement we are penciling in from here on?
Yeah, hi, Nigel. Fair point. So two things from the order book that we have, which is pretty healthy. So we'll continue the growth momentum that we have. As I'm saying, with the growth that we are seeing, we will continue that momentum.
Amar, we have lost you, Amar.
The audio dipped.
The audio dipped, yeah.
Can you hear me?
Yes, you're back.
Yeah.
Please go ahead.
So I was saying the order book is strong, so we'll continue the momentum of the growth that we have demonstrated in the last few quarters. And on the margin piece, absolutely confident on sustaining those margins, especially on the power sector, because the backlog that you see is at a fairly healthy margin. And also with our go-to-market that we are working on, I think it will keep building on for a couple of years as well. And on the other... Sorry?
Yeah, please go ahead.
So on the if you would have seen industrial, there was a bit of pressure on the margin, but yes, we are taking the steps on it. Railway was a big function of that, where it was a mix issue more towards traction electronics. So that mix we are addressing. Plus, we are also looking at VAV to make sure those costs are going out and also keep expanding into the new areas.
So 30% revenue growth for the year is on the cards with margins in the vicinity of.
I cannot put a number on that, Nigel.
So you can continue the momentum, right?
The same momentum.
Yeah, the momentum. So the momentum in the first quarter, you've done 29%. So you'll continue that. Maybe you'll do better as well. You have some of these new, capacities that are coming on stream. So we'll see. We'll keep it at keeping up the momentum and margins in the vicinity of improve around 100 basis points or thereabouts. So for the year on average, 14 to 15% is a gettable margin. Blended?
Yeah, absolutely.
Got it. All right. That's out of the way. Just one more point on the QIP. You raised some money. The street wants to know, is there some big inorganic plan that's on the cards?
Sorry, I lost you in
Is
between.
there any inorganic growth plan, sir?
Oh, yeah. So yes, so we did raise funds, money for QIP. And as you know, one is to fund a bit of on the OSAT piece, as well as we are continuously looking at the pipeline of acquisitions. So we didn't want to wait for money at that point of time. And, some of these acquisitions can happen overnight. Some may take a bit more time.
So you raise
as we get closer, we'll, of course, keep you informed.
So you raise when you can, Amar, right? Are you interested in the Whirlpool stake, Amar?
Sorry, come again.
Were you interested in the Whirlpool stake? The Whirlpool. The parent is, in a way, selling out. Were you in contention for that? Did you look at it?
No, not really.
Did that ever come up? Was that, or it never came up?
No, I think we don't go specifically unless we don't crack a deal. It's no point going into the details of that.
Okay, but you're not looking at it now, right? You're not. There's nothing happening there.
No.
Okay, so Whirlpool, not on your radar, but growth definitely is. Good speaking this morning. Thanks so much for joining in and giving us a sense on the business. Okay, I'm going to, thanks very much. I'm going to just pull it back to the market and pull it back to one stock. And this is what we had highlighted in our opening conversations this morning. Look at Bajaj Finance. Not what the market needed, but that's what you have to deal with. 5% down in pre-open. Growth is fine. There's absolutely no issue. Credit cost has inched up marginally, a couple of basis points. Gross NPAs have inched up 4-5 basis points, not more. But their commentary, the commentary is about stress persisting in two-wheeler, in three-wheeler, and MSME. And this market is in no mood for anything even remotely negative. It's just, we saw that playing out on some of the IT stocks yesterday. This morning, Bajaj Finance. Prashant?
Absolutely, and it's the commentary, which is the problem where they're talking about some stress. I think Gaurav is here, right, with some of that commentary, specific commentary. Gaurav, quickly.
Well, yes, when we talk about Bajaj Finance, what they have said is that credit cost is likely to remain around 185 to 195 basis points, but for for the first half of the year, we will see some kind of stress, specifically from MSME and two-wheeler and three-wheeler segment. And as a result, when we look at brokerages, they are also not sounding bullish. In fact, JP Morgan has downgraded the rating to neutral. What they're saying is that the stock remains best when it comes to valuation, but at the same time, at least in the near term, we may not see any kind of re-rating happening. In fact, we also have Goldman Sachs who maintain their neutral rating. On the other hand, we have got Macquarie, UBS, Bernstein. All are actually a little bearish with the stock with underperform or sell rating. We also have CLSA today who actually highlighted one point. They have maintained their outperform rating and a target price of 1150. What they're saying is that in this environment, delivering 25% growth is something which is positive about Bajaj. But at least at this moment, it seems that the market is not factoring in that. They're still more concerned about the credit cost commentary. And as a result, we are seeing some kind of pressure in the Bajaj Finance stock price as well.
Yeah, some is an understatement right now, 5%. Let's see if buyers come in. But Gaurav, very quickly, run us through the street verdict on REC as well.
Well, REC actually reported good set of numbers, and with this, CLSA has actually maintained its high conviction rating. What they are highlighting is that the decline in specifically the provisions and asset quality improvement is something which is actually positive. On the other hand, we also have UBS who maintained their buy rating but got the target price to 550. They still believe that ROAs of around 2.9% is still healthy for the business. We also have Morgan Stanley who maintained their 485 rupees of share price with overweight rating. They are also a little bullish, specifically because net interest margin improvement that we have seen in the quarter. So some bullish stance coming up from the brokerages, not upgrades what we have seen since morning, but definitely some bullish tone is what we are seeing from brokerages on REC.
We got market open coming up, Gaurav. Thank you for that. First rates on indices, and we'll get to stocks. 24,968 on the Nifty. The Nifty Bank is absolutely flat. Small cap index is down 1%. And I think you've got the mid cap index, which is going to come up on your screen as well. So it is a lower start. I mean, cleans straight away 0.5% odd kind of cuts, which are showing up. 840 lower and advances 650 out of the gates, but I think we'll have to give it some time to figure out where we go. But I think we got some big moves already starting to show up, which we should get to quickly. Heat map on your screen, it's bulk of it, at least on the Nifty, is all down. SBI Life, of course, reacting to numbers, and numbers were pretty good. Otherwise, I mean, it's almost 45 stocks which are lower. IEX stock flashing at the bottom of the screen. Surabhi.
Yeah, absolutely. We're starting right at the lower end of the range because in this month and a half long consolidation, we have broken below 24,900 as well, but then we bounced back. So let's see. We're at the lows of the range as we speak. Bajaj Finance is your stock of the morning, down 5.5% in the asset quality issues and commentary that Gaurav just highlighted. Shriram Finance is down about 2.5%. Bajaj Finserv, remember this morning, and that's what I was pointing out, that IT has not worked. The money's been gravitating towards financials so far this week. But now this is a new issue that seems to be showing up. Jio Finance is slightly lower as well. So some of the large financial names are on the back foot. Kotak Mahindra Bank, HDFC Bank, a little bit of cool off here. Banks are relatively better than the NBFC plays, at least as of now. HDFC Bank is still down, but down about 0.5%. But overall financials are weak. There's Infosys, which is lower. There's Reliance, which is lower. Basically, nothing is firing. No engine firing for the market. Lever is lower. So FMCG, IT, banks, you don't have too many trades on the upside. Just very quickly talking about the gainers as SBI Life post numbers. ICICI Bank is managing a little bit of green. And there's BEL. It's 120 down straight away. Weak opening.
Well, that's right. But there are a few winners, Surbi. IEX has bounced back. It's bounced back in style from yesterday's low. In fact, it's up 10%. But all eyes will be on whether or not they can get a stay. These numbers look good, but unfortunately, the court order came ahead of that. So that's why, that stock was down yesterday. It's bounced back a little bit today. Tatva and Chintan, I think that came out with its numbers, if I'm not mistaken. So that's bounced back in trade today. Big up move is what we're seeing on that one. So it's reacting positively. Trident is the other one that's reacting positively to its numbers that it reported yesterday. So that stock is well up and about as we speak. Big move is what we're seeing on that name. Fedfina, Trident, not Trent. Let's pull up Trident. Fedfina, that's the other one that I'm looking at. That as well has opened up well in the green. So big up move is what we're seeing on that name. Metro Brands, potentially there could be some business opportunity coming in from, if in case this US, the India-UK FTA that is signed. So maybe another opportunity for them. That's the way the street is reading it at least. So that's why that one, in fact, is up closer around 5%. Volumes yet to pick up. And some the tubes, steel tubes, that's a new listed entity. We'll have the management at around 10:30 today. That one as well is up closer around 4%. On the flip side, Hexaware selling off. You have Tanla Platforms as well. That's down closer around 4.5%. So all those names reacting negatively. The market's now down 130 points. Prashant.
Which basically means that the low that we saw recently perhaps comes into contention. And we'll have to kind of see if that happens. The low was 24,882. So 24, we are at about 24,951. The low was referring to was made on the 21st of this month. I mean, just a few days back. But it's a 130 odd point cut right now once again. IEX, of course, is the big mover. Maybe just look at Coforge as well. Is there more pressure or has it stabilized? Because it's like a one-way disaster. It's up about $10, so 16.90 or so on Coforge. Harish Krishnan is with us. He's a market master of the day, co-CIO, head of equity at Aditya Birla Sun Life Asset Management Company. Harish, good to have you with us here. This drift in the US, it's a drift higher. In India, it's just a drift. What's responsible, Harish? Is it muted earnings? But muted earnings were very well advertised. Nothing surprising, right? There's hope for H2, but it's hope till it's realized. So what's going on?
I loved your phrase, Prashant, drift. The way we say it, it's a grinding bull market. There isn't
There is a grind sure, but the the bull market is, but maybe it's there, right? We came off a very good phase, admittedly, absolutely. Go on, Harish.
Right. So, clearly, I think the directional element of earnings, the directional element of liquidity and sentiment are all turning positive, and the rate of change is there. The question is only about valuations and have we gone too far too soon? And also the fact that there is such an enormous amount of supply that at each 2-3% higher levels of the market, you see the next wave of supply coming through. So therefore, we have to climb both these walls. So the way we think about it is that the lows of the year are made. But if we were to plot, say, the top 1,000 companies' profits and the top 1,000 companies' market cap, and it's a pretty interesting chart if you were to plot it over 25 years, they broadly move together, which is how it should be. Markets are slaves of earnings after all. Sometime in March of last year, March of 24, we saw a very big divergence happening where earnings growth slowed down quite substantially and the market cap continued to keep going higher. And we saw a lot of that froth get cleaned up by February of this year, which is when we turned reasonably very positive on markets. Since then, this rally that we've seen in the last 3-4 months, we've kind of got back to 80% of that divergence again. So in that sense, I would say that, we now need to see earnings coming through. There isn't too much of comfort in terms of valuations. And therefore, my best guess would be that there would be a time correction. Let the earnings come through over the next 6 months and then to see the next move up.
Harish, hi, great to have you on the show this morning. So, yeah, red screens, that's what we're seeing. So, the problem is, Harish, now you don't know what is the safe haven or what is that area where relatively you'll be better off. You park your money there at least for a year and you'll be fine because IT is not working. FMCG seems patchy, and especially first quarter earnings reactions have been sharp. Look at Nestle, look at Colgate. Anyway, the growth, is not expected to be very, very strong growth. And then there are financials where there are these off and on issues coming up, asset quality, credit costs, some margin compression. So where do you go?
So I think we've had this view that, the leaders of the next bull market over the next 3-5 years are going to be very different from what has kind of taken the market over the last 3-5 years. And therefore, we kind of outlined that there are 9 sectors where we think the potential leaders could emerge. I'm not saying that all these 9 could end up being the champions of the next bull market, but there is greater margin of safety, let me put it that way. Now, these include sectors, including private sector banks. I know financials is a broad spectrum where NBFCs have done a lot in the last 3-5 years, but private sector banks have really taken it on the chin, given significant regulatory kind of oversight that kind of was getting there, right? So we think that private sector banks could be potentially one such area. Similarly, we think that, both cement and metals, which we've been consistently maintaining as our dark horse sectors, continue to do quite well. In fact, cement earnings have kind of surprised quite positively, and they've also kind of performed quite well as the consolidation of the overall sector kind of takes place. Also, the fact that cement is a huge consumer of energy, and with energy prices down, we do think that a larger portion of that profit can potentially come to the shareholders eventually. The other sectors that I would think one should possibly look at would be sectors like, say, insurance, metals, oil and gas, FMCG. Yes, it's not a complete swathe wherein we are getting everything decked up, saying that consumption is revival is back. But if you look at the Amazon Prime data points that came out over the course of the last week or so, we've seen some encouraging demand momentum coming through as far as urban India is concerned. So I would think that there are bits and pockets. Yes, will they work in the next 1 year? Quite honestly, we don't manage only for the next 6 months or for the next 1 year. Our endeavor is to manage the experience of our unit holders as well as identify potential sectors where we can deploy reasonably large sums of money.
Harish, I've been sitting with my notepad and I counted 6. Private banks, cement, metals, insurance, oil and gas, FMCG. Anything you're missing? Because you said 9.
Yeah. So
in case you remember.
Yeah. So there is Alcobev. There is chemicals. That's the other sector. And then a very small sector like textiles. So these are the 9 sectors which, in our opinion, there is some margin of safety. Again, it's disputable, and one can always say, where really the value lies.
There was a big Alcobev deal that was announced, Harish. What do you make of that? This space was not seeing too much of inorganic growth, at least for the last 10 years since that United Spirits Diageo deal took place. But all of a sudden, you have a $500 million deal. What do you make of it?
I think it's an exciting area. I think broadly there are 2 points. One is that during COVID, given the commodity price increases, almost all Alcobev companies saw significant margin contraction. And given the fact that they are mostly regulated in almost all states, price increases have been patchy. We are now at the other side of the curve, wherein you are seeing a deflating commodity cycle, especially for some of the bev kind of raw materials, and you're seeing some amount of price increases. In terms of competition, yes, I think from the bastion of MNC kind of dominating the Alcobev, I think we are seeing some Indian origin players starting to really kind of come through. I think India is a very complex market. A lot of regulations, as a CEO of a brewery recently told us, operating in India is like operating in the European Union. And therefore, it does take a significant amount of regulatory kind of bandwidth to kind of operate in India, for which many Indian players are far more nimble and adept at. So I guess some of this is something that we will be looking for in terms of how large the competitive activity kind of shapes up. For now, we are happy. Just to kind of bring you one point which is in the back of our mind, even though we are currently positive on Alcobev, I think we really have to watch out for what happens when GLP-1 really kicks off in India and its impact on the craving industry. It's a massive experiment globally that is happening, wherein almost in about 100 countries, this drug is going to get generic. The impact of what it happens and its after effects on consumption, I think it's still too early for us to kind of look at. But at the back of our minds, we are definitely kind of watching out as to how multiples will move for the sector once GLP-1 kind of takes off.
I'm going to pour you the drink and I'm going to give you the medicine.
In the medicine, I was wondering, wow, what a connect, Harish. That's
nicely. Just joking, Harish. But that's an opportunity. Absolutely. IEX, just using that as a case study, not your view or whether, I mean, if you want to talk about the name itself, please do. But it's limit up 10%. It's a #1 volume traded name on the NSE right now. What's your sense, Harish? We, by the way, had the management joining us a little later. But how are you looking at this one? And what has transpired here?
So, Prashant, unfortunately, we can't really speak on stock-specific developments. But I think platform-led businesses inherently, are loved because of their monopoly stroke duopoly kind of structure, wherein winner takes all. Any kind of development which kind of impinges on this duopoly or a monopoly kind of a status, while earnings, etc., will see a lesser of an impact. The question really is what really one should give as a multiple for the future set of cash flow streams. I mean, I don't need to tell you that in any company, almost 80 or 90% of the value of the company resides in the terminal value. Terminal value is anything which is beyond the next 5 years. And therefore, when the terminal value of such an enterprise is so nebulous, wherein we don't know from the current 90% share, would it come down to 30 or 40 or 50%? It's all, balls up in the air to try and create, probability scenarios. But I would think that, there are other plays which are monopolistic, which we kind of invest in. We will kind of assess all of such opportunities as they come.
Sure. Harish, very quickly, let's talk about the good things, at least of this week. And the good thing of this week was definitely eternal, right? So I know you won't talk about the stock per se, but the big debate is whether the worst is over for quick commerce and these, food delivery platform businesses. Where do you stand on the debate?
So I think the competitive rationality is kind of starting to come through, especially as the third player also wants to get listed. I think there is going to be generally a discipline that needs to be showed. for the profitability metrics to come through. The question that we kind of crystal ball gaze through is primarily about the potential TAM of this market, and that is where I guess the bigger debate for us is. Clearly, in the urban centers, the top 20 cities, quick commerce is doing exceedingly well. It's cannibalized a lot of other retail outlets. But can it thrive in tier 2, tier 3, tier 4 with lesser urban density, etc., is something I think that the jury is still out. And that will have, I think, a far greater bearing. Because again, like I said, these are all 3 lakh, 4 lakh, or 4 lakh crores in aggregate market cap entities. Almost everything is terminal value because near term is all loss making. And therefore, how this changes in 3 years will have a far greater bearing than where we are. For now, we continue to have ownership in these names.
Okay. All right. Got it, Harish. Thank you for the perspective this morning. Great conversation. Wish you a good Friday and have a good weekend as well. Let's now move on to more earnings conversations. As we do that, I'm just checking the market screen very quickly. So there's some recovery. This is what's been happening. When you hit the lower edge of the trading range, buyers emerge, and that's the good news for the Nifty. The ground is not basically caving in. So some recovery from the early opening lows, but Bajaj Finance is still down 5.5%. So just a note over here. Let's move on. More corporate conversations and more earnings. Hexaware is in focus. Now, the stock has been trading slightly lower this morning, reacting to earnings which were below expectations. Revenue growth was a little below the CNBC-TV18 poll, and margins have weakened. There are a couple of one-off expenses as well that impacted margins in the quarter gone by. So let's discuss this and more with R. Sri Krishna, Chief Executive Officer of Hexaware Technologies. Great to have you with us, Sri. So let's just start right there. The fact that there was a miss in the revenue is one thing, but also the commentary, because I think the wordings that you've used is that there is continued softness in macros. So just elaborate on this, on top line. What are you seeing around? And this whole debate about whether this is just because of tariff uncertainty or whether there is a bigger disruption out there thanks to AI that's playing out.
So there are 3 questions there I'll address. First is the miss for the quarter itself was marginal. Okay, the softness in macros, I'm just calling what we are seeing, right? While the miss for the quarter was marginal, I think what we've also said is that because of a solid pipeline, deal wins that happened, and more importantly, solid progress in our strategic initiatives, our long-term growth outlook remains very solid. Okay. Now, your question on is it macro, is it cyclical, or is it a more structural AI issue? We think it is completely macro and cyclical. The best proof point for it is if you look at our different verticals and the growth rates of the verticals. Headline is travel 23%, financial services 16% Y&Y growth. There's one sector that is materially pulling us down. That is manufacturing and consumer, negative 11.5% Y&Y growth. That's all macros. That's all the uncertainty due to tariffs.
Okay, so you're saying it's all macro, but then what does this imply? I mean, Q2, Q3, if not a guidance, but some sense on, whether this year overall you'll be better off than last year. Will it be single-digit growth? Are you looking at double digits? What's happening with client spends, deal wins? What's the pipeline looking like?
Our pipeline is very solid, okay? And not just overall pipeline, but our pipeline on strategic initiatives, which we called out specifically on legacy modernization, pipeline through a PE channel, high-tech, GCCs in India, which we did an acquisition on. All the strategic initiatives, the pipeline growth is even better than overall pipeline. What it means for a growth in the near term, we said, it's going to be our growth expectations now are a little bit lower than what it was a quarter ago. That's the reality we see, right? What it means is we will still grow nicely in Q3. It's not going to be like an outstanding quarter that it often is in Q3 for us, but we will still grow nicely.
All right. Hi, Sri. Good morning. Good to see you, Ben. So quarter 3 growth will be better than quarter 2?
That's what we hope right now, yes.
As of current reckoning, it seems that, right?
Yes.
And your margins, well, it had quite a few one-offs, many actually. On a steady state, what should the margin number look like?
I mean, our reported EBITDA is 17.2% this quarter, which is a 50 bips improvement from the prior quarter. All the one-offs actually had a net negative impact of about 15 bips. So what you should expect to see going forward is that our reported EBITDA improves. As it has been for a number of quarters, it will continue to improve.
So margins will continue to improve from year on. Growth will be relatively better as well, right?
Growth will be a little bit better in Q3, definitely, than Q2. Okay. But we've said that our growth expectation for the full year is somewhat lower now than what it was a quarter ago.
Okay, all right. Just talking about the margin improvement, you have wage hikes that come into effect from July 1st. That's taken into account in this margin improvement that you're talking about.
That is correct.
Got it. All right. Now give us a few more.
What you did not ask is, will we give a wage increase? And the answer is yes. We will give a wage increase on July 1st, effective July 1st.
All right. You have given a wage increase effective July 1st, and that's already been accounted for in the margin improvement.
We haven't given it yet, but
you will be giving it.
Effective July 1st. That's what we do every single year, and we will continue that this year as well.
Got it. All right. Let's focus on the broader outlook then from year on. You had a goal of around $3 billion by 2029, I think. Does that goal hold out? And also you made a small acquisition, gone ahead and acquired SMC Squared. The revenues that it did last year was around $22 million. This year, I think in the first half itself, it's done around $16 million. How do you see this one scaling up from year on? What is the run rate you're looking at, say, in the next few years?
See, the data is this, that last year there were 1,700 GCCs in India. There's expected to be 1,000 new GCCs in the next 4 to 5 years. That's a lot of new GCCs getting set up, and that's a market that we currently do not participate in. SMC specializes in helping customers set up new GCCs. They have different models, but the core of the model is to operate it for 3 years after they set up. So we actually expect solid demand and growth from that business.
Okay, but overall, you are a little, well, let's say, I'm not saying less optimistic, but in terms of just growth this year, you're paring down expectations now at the end of Q2 versus where you were at Q1. So let's see. We'll see how the next 2 quarters play out. Thank you very much for that. Good to have you on. And thanks for joining in. So that's a word coming in from Hexaware. Slightly cautious, but also saying that that the softness that they're seeing, it's entirely due to macros and not more structural in nature, not because of AI perhaps taking business away. So that's important. But look at that stock. Ooh, down 7%. So mid-cap IT, I mean, after many quarters of outperforming their larger cap peers so far, I mean, Persistent, Coforge, today Hexaware, not such a great run for mid-cap IT. Let's actually look at the rest of the market as well and see where we are at. Yeah, still down about 100 odd points. That's where the Nifty is. The Bank Nifty is managing a little bit of green. So for what it's worth, there is some buying on the banks. Let's see which ones. HDFC Bank is still lower. ICICI Bank has been doing better, up about 0.5%, and SBI up 0.25%. But no such luck for large NBFC players today. So Bajaj Finance 4.5% down, and Shriram is reporting numbers today. I think today itself, Shriram's down 2.5%. Shriram Finance.
Well, indeed, the stock of the morning though is IEX. After cracking big time yesterday, there is some buying, there is some short covering as well they are seeing, and volumes absolutely massive on that particular name, but keep in mind it's pulling back less than a third of what it lost in yesterday's trading session. A few more names actually that are moving around. You have Swan Energy, that's down close to on 3.5%, so big downtake out there. Ujjivan Small Finance Bank, I think that as well is reacting to its numbers, so I think we should get that one up for you on the screen. But Canara Bank, that's doing well in today's trading session. Quarter 1 numbers were good, profit growth was strong, loan book as well is healthy. But margins, well, they feel some pressure. Let's discuss it in further details. We have with us Mr. Raju, the Managing Director and CEO at Canara Bank, who joins us on the show. Hi, sir. Good morning. First of all, congratulations. Last quarter was actually a good set of numbers. Give us a few details, though. I'm looking at it. Your retail book has grown very, very well. And if I remember last, the gold portfolio was around 1.5 lakh crore. You could update us, how did the gold portfolio grow in the past quarter? And more interestingly, the retail part of the gold book, that has been growing a little bit better. I think last count was around 40,000 crores. So tell us about retail book, how is it growing, the gold book, and within that, the retail portion of it. Please go ahead, sir.
Actually, first let me say that we have given guidance for this financial year during the last quarter results announcement under 13 parameters. Out of that 11 parameters, the first quarter itself we have shown very good progress beyond that what we have given the guidance. So the only thing in NIM and the CASA, these two, of course, it is a concern area for us. Except those two things, remaining all key parameters, we are excelling in the first quarter. This is because of our operational efficiency. See, we know that the NIAs will be under pressure for this whole year, but we are efficiently working for not immediately. That's the last 2 years, whatever we are working on the operational efficiency, that has started giving the results for this quarter's last quarter also, we have got the benefit out of it. Now let me say that regarding the credit, we have given a guidance of 10 to 11%, but we are sure that we will do more than 12% growth. Even we are little cautious. Last 2 years back, we have given a guidance of that our RAM should grow better than the corporate. That's what actually earlier we were at 54% RAM. We want to move towards the 60%. And I'm happy to share with you that by June 30th, our RAM has reached to the 58% of our total loan book. Our corporate, because we know that our NIA is under stress, we are selectively going on that without compromising the pricing. That is like a corporate is growing at 10%, but the RAM is growing almost at the 15%. And there our margins are being protected. Within the RAM, housing is growing at 14% and the vehicle loan is growing at 22%. And the secured personal loan, you are talking about the gold loan. Gold loan now, as on date, we have crossed to 1,91,000 crores. That's the total loan book. Out of that, almost 56,000 crores is retail personal loan book. The March we were ended at 51,000. Now we are at 56,000 in the secured retail gold loan product. Of course, the secured retail gold loan product is contributing to us majority in that, but other parameters like a housing loan and vehicle loan are also beating the market. That's why our growth in the RAM credit is almost 32%, 33% in the year-on-year basis.
Right, so I wanted to get that point out of the way because, the retail gold portion was missing. So we've got that number 1.9 lakh is the total gold portfolio and retails around 56,000, which has been growing very well. Got that, sir. NIMs in the near term, they'll be under pressure. So for quarter two, do we see it go a little bit lower, say sub 2.5%? But what kind of a recovery are you factoring in quarter three and quarter four? Can it end the year closer to around 2.7%? That's on NIMs. And on the ROA, that's done quite well, 1.1%. But a couple of brokerage notes are saying that it's run its course now. It will not expand from here. Where is it headed?
No, first, let me speak on NIMS, sir. The NIMS, whatever it is, the current this first February there is a rate cut, April there is a rate cut, and June there is a rate cut. These three rate cuts, we have a 45% of portfolio is linked to the RLLR. Because of that, we have to pass it on to that 100 basis points. We have passed it on to the customers immediately within 1 week of announcement of the RBI. Due to that, our yield on advances has come down 36 basis points from 8.83 to 8.47. But whereas we cannot pass it on this burden on the depositors, on existing depositors, because you are supposed to pay whatever you have agreed the deposit rate till the contract is expires. Our cost of deposit is still maintaining at 5.74. We reduced our deposit rates only on the 9th of the June after latest MPC announcement, 50 to 60 basis points. That benefit we will start yielding that in this quarter onwards. Of course, with this present scenario, the stress will continue in the second quarter also, but I see that there will be a little uptake will be there in the third and fourth quarter, subject to if there are no more rate cuts are there. But if there are, again, we are hearing from various corners that again the rate cuts may be there, but every rate cut, bank has to absorb that burden at least minimum 6 months. So that will have its own impact. But if there are no further rate cuts, definitely we anticipate that it will be around 2.65 to 2.7.
And ROA, sir?
ROA, we are telling that there is no problem on the net profits. Since our net profits are comfortable, though we have given at 1.05 the guidance, we have first quarter itself 114, we have shown that. Here, let me say that everybody was worried about our PSLC income, but our PSLC income is stable, and we have earned almost in the first quarter itself 1,200 crores. And even now, our priority sector and agriculture and small and marginal farmers, we have enough cushion, more than 5% beyond the regulated requirements. That portfolio also we are going to encash it in the second quarter and the third quarter whenever we get a good pricing, because there is a huge demand in the market. Last year we were sold at only 1.7%, but this time we sold it almost in the first quarter 2.75 to 2.90. That's the demand is there. That is another avenue for us. And we have already approved some 1,200 crores worth of big accounts, 4-5 accounts in the OTS, which are scheduled for that time limits. We have given it for 90 days. So we are expecting that much recovery from there also. So second quarter and third quarter, we don't have any issue at this moment. But simultaneously, let me say that if you see the interest income, we could manage the absolute numbers without any fall because of our average advances have increased. So only the yield has come down, but absolute interest income we are able to maintain. Since our credit growth we are expecting beyond 12%, this interest income absolute numbers we will have benefit on that. So that's there won't be any effect on the net profit. So simultaneously we expect that our definitely NII, the return on average assets, ROA will be beyond our whatever the guidance we have given 105, but definitely we will be above 1.10.
Okay. All right, Mr. Raju, thanks a lot for joining in, giving us that quick outlook in terms of growth. You're quite satisfied that you have given some parameters and you have outbeaten most of them in the first quarter. We'll track you to the remaining numbers for the remainder of this year. Time to slip into a short break, but you have the management of Emphasis that's waiting to discuss their numbers. The stock, by the way, is doing quite well. Welcome back. This is Corporate Radar, and the next corporate is waiting for us. Mphasis earnings, well, they have been taking positively. The stock is up close to around 4%. We're now joined by Nitin Rakesh, the Chief Executive Officer, and Arvind Viswanathan, the Chief Financial Officer, on the show. Good morning, gentlemen, and congratulations on a good showing in the past quarter. And your commentary itself has turned quite optimistic. Now you're expecting to outbeat the industry growth by a big margin on the back of a good performance.
We'll have to flip the names a little bit. Nitin Rakesh and left and right, but we'll do that. Sorry, go on.
Okay, all right, we get that done. Coming across to you all, the Q1 performance itself was good. It was better than expected. You're talking about outbeating the industry growth as well, and also steady conversion of the TCV to revenue. You're saying that you'll outpace the industry growth. Do you want to put a number to it?
Again, we called out kind of like a 2x to industry growth number right now, and it's driven mostly by our own order book as well as pipeline. I mean, we had a record order book quarter in Q1 at 760 million net new deals, which is about over 100% YOY, and we had 390 million last quarter. So I think the pipeline had been building up for the last 2 quarters, and we are glad that we were able to convert that into actual deals, and some of that translated into revenue growth within the quarter, as well as gives us a little bit more visibility over the next couple of quarters. So I think that's what's driving it. We are pegging it to 2x at this point. Last quarter, we had called for above industry. So I think the confidence really comes from the ability to look at what the order books holds and what the pipeline holds.
What about the macros? Are they improving on ground?
About a year ago, we decided that in an uncertain macro, we have to focus on the micro. What that really means is if we have the right propositions, if we have the right client needs identified, and if you take a very in-client, account-specific, deal-by-deal approach, we should be able to find a way to at least continue to grow the business despite the macro being what it is, because we can't control the macro. Coming back to your question.
Last time you had said that you're focusing on smaller deals, right? Not going after the big ones, and there is enough action happening. Maybe I'm not characterizing it correctly, but my point is you're kind of sort of looking at not the mega billion-dollar multi-year kind of things, but there's enough happening in terms of smaller size deals. And we have some numbers that in the pipeline, 68% of the deals are AI related. This is AI, applying AI, sort of implementing AI, like generative AI across clients, or something else?
I think when we said that we are focusing on large deals, for us, a large deal is 20 million or above. Even in Q1, we have 4 large deals, 3 of them over 100 million. I think that's kind of a very good sweet spot for us to operate in the 50 to 200 million range. And there is a bunch of deals in the pipeline even today that qualify for that. So just making sure that small deals don't necessarily mean $1 million, $2 million deals. On AI-led pipeline, this is a combination of a few things, right? As clients have gone through the last 2 years and looked at the ability to actually use AI to impact their tech and their operations, now there is a pretty strong appetite and a top-down push to make them more enterprise-wide, whether it is applying AI to get productivity, contact center transformation, developer productivity, applying AI to see how they run their operations, both tech and ops, claims, underwriting, support, production support, maintenance, IT help desk. So this is really, for us, it's more about applied tech. We are not going out there and building new LLMs because that's not what we need to do. There are enough and more available for us to apply. So this is really more about infusing an element of tech orchestration and bringing them together with people to deliver a solution that provides that value that the customer is looking for.
Nitin, hi, morning. So, I wanted to come to the margin picture and what this infusion of AI means for margins. And then there are other sort of factors which maybe Arvind can talk about, which are impacting margins. You've been holding, fairly comfortably around the 15% handle. But going forward, and this is not a question only for, the next quarter, but say over the course of the next year, year and a half, what will this greater AI integration mean for your margins?
Again, I think it's a little bit too early to tell. We are still in early stages of adopting a lot of these solutions, but there's definitely some play that gives us the ability to infuse a platform or codify our solution into a set of repeatable tools. That definitely gives us a little bit of an operating leverage that we can use to either pass back to the customer, get more competitive. So we don't need to really drop our margin to win a deal. that is a $150 million deal. So that, I think that's established over the last 2 or 3 quarters because you just called out the fact that we've held our margins quite tightly. Whether that gives us the opportunity to expand margins over a medium to long term, I think we'll address that as we get a little bit more comfortable with scaling these deals across multiple customers.
Okay, that's an interesting point that you make over there, and we'll watch out for this. So if AI can actually be margin accretive, because there's a contrarian argument that if it just increases productivity, then shouldn't it drive costs lower? But on the other factors impacting margins, Arvind, I mean, general competitiveness in deals, wage costs, and the overall operating costs. Are you comfortable and confident of keeping margins here? Is there any scope of improvement in margins ex of AI?
We kept our margins flat, and let's say for the quarter gone by, we kept it at 15.3, largely driven on the back of significant improvement in utilization, which kind of compensated for some amount of client-specific investments and AI-specific investments that we've been doing, right? So from a range standpoint, what we've kind of said is that we would operate between the 14.75 to 15.75% range. And we are probably right bang in the middle of that. I don't see a reason for a big change. Obviously, like Nitin said, as we ramp up these deals and as we win more, it'll be important to see how we navigate. I don't think the traditional levers are going to swing it too much. But obviously, AI would be something that would be interesting to see how it plays out from a margin standpoint.
Very quickly, Nitin, you said about there are 2 parts: AI work, which is orchestrating AI, which is new work, and then there is using AI to do your existing work, bread and butter work. So the latter is deflationary, the former we don't know. But this agentic AI, you think it'll impact AI orchestration work itself, because you'll have these AI agents orchestrating all that? You think it'll be a big disruption very quickly?
I think to us, the value stream of AI actually cuts across. If you look at the stack that the enterprises need to build, and there's definitely an AI engineering element to that, we are actually calling it the Emphasis AI Superhighway as a solution. What that really means is you need to create an environment where you have the ability for an enterprise to be able to offer these services to the internal users, for them to be able to build AI applications on top of. So I don't think that can be disrupted by agentic AI, because that's an engineering exercise. It can be done efficiently using AI agents, but it requires an element of design, it requires an element of governance, and an element of execution that cannot be fully automated using these agents. Applying agentic AI or generative AI to existing solutions, you can call it deflationary, but I think the way we look at it is that it's unlocking deals that were probably not conducive to ROI because they were either too expensive, took too long, or had too much risk. So it's actually opening up a new addressable market, even in existing book of business.
All right, Nitin and Arvind, thank you very much, both of you, for joining us. Good speaking with you guys. Shorter conversation, but very useful as we continue to track IT numbers and IT results. Let's talk about the big story from yesterday, which is IEX, Indian Energy Exchange. The stock sold off 30% yesterday on the back of market coupling, which now is a reality. But today, it is making a comeback. It's up about 10-11% or so. We have the management joining us now. This is a CNBC-TV18 exclusive. Rohit Bajaj is Joint Managing Director at IEX. Mr. Bajaj, great to have you with us here. Thank you for doing this. Lots of questions I'm sure that you understand investors and markets overall have. And we'll talk about your operational performance and your sort of road ahead for FY26. But you'd understand I'd want to start with the market coupling story, sir. Straight up, if you can tell us, will you approach the courts to try and get a stay in terms of implementation here?
Hi, morning. So bit early days to comment on that, but let me quickly try to rephrase what is there in the order. So CRC issued order for implementing of market coupling for day-ahead market on 23rd July, day before yesterday. And it talks about initiating the process of market coupling for day-ahead market. There are a few more elements in this order where they said that due to shorter time frame available for bid submission in real-time market, and also because of other operational complexities, coupling of real-time market will be considered at a later stage. Then they also talked about doing simulation study for evaluating viability of coupling for term ahead market. And then they mentioned that we should also initiate stakeholder consultation to see whether RTM and SCED coupling is needed. Further in the order, the CRC directed its staff to initiate consultation with Grid India and all its exchanges on operational and procedural aspects of day-ahead coupling.
Mr. Bajaj, the order is well understood. Well, obviously you understand it better than most, but it's kind of understood. So my question is, what from here, sir? It obviously is a big blow to your business model. So will you try to go to the courts to get a stay?
So yes, there is going to be some impact on our business for sure. But if we see the whole thing, in the recent time, we have seen day-ahead market is not everything for us. There was a time when day-ahead market contribution in our total volume was 80-85%. But today, this number has come down to less than 35%. Other segments are also doing very well. Today, real-time market in Q1 has emerged as the biggest segment of within electricity for us. The contribution is more than 35%. So there will definitely be some blow, some impact on our volumes.
Can you quantify that, Mr. Bajaj? I think margins are about 4 paisa.
Yeah.
Which is, I mean, if you compare this to, say, international exchanges, etc., it's one of the highest. What can that number drop down to? I mean, I think in other parts of the world, that number on exchanges is the equivalent of 1 paisa. I mean, could we see that kind of an impact?
So some global exchanges, our numbers are high because their volumes are very, very high. They are trading almost 8 times or 10 times volume than what we are trading. Their margins are less. But there are some other exchanges like Australia, Singapore, and some other smaller exchanges where the margins are similar. So we are not charging margins which are very, very high. But as I mentioned, since this coupling is going for day-ahead market, which is going to be, or which is today almost 1/3 of our total volume, there would be some impact for sure. But this is not going to be huge. But
Mr. Bajaj, sorry, if you could allow us to come in over here. Let's go step by step, right? The order right now impacts the day-ahead market, which, like you explained, is now under 40% of your business. But the order is also talking about launching experiments and eventually extending this to the real-time market and also to the term-ahead market. So that impacts all the three, different products, right? So can you tell us what the impact will be now? What is already in print, unless it's held up in courts, is the day-ahead market. So for that, I think you mentioned 30, if you could just repeat the figure. Day-ahead market is 37%. Based on that, what is the impact?
Yeah, so the order says that real-time market coupling will be considered at a later stage. So they have highlighted certain issues. So for us, there is no reason to believe that it will eventually be implemented. It will be considered. Various stakeholder consultations will be done. All the complexities will be highlighted and then it will be decided. It is not decided as on yet. So what order says is the day-ahead coupling is what they have decided today. Lot of work is required to be done. They have given the timeline, which is January 26. But we believe since the technology is not clear from where the technology will come, it has to be a common technology. Then there are other operational difficulties. How settle?
Right, Mr. Bajaj, if I can just come in.
Yeah.
2 questions that I asked, if you can. One is, can you quantify the hit? You said it will be a hit, but it won't be substantial. I'm sure you looked at.
So I do not have a number to quantify that, but since, as I mentioned, since it's a 1/3 of the total segment, it is not going to be substantial. That is one.
Okay. Second is, will you go to the courts? I didn't get a clear answer.
So that's, as I said, it is little early to comment on that. We are analyzing the order, and we would be able to say anything in due course of time. Not as
we'll wait for you to form a view on whether you need to take the legal recourse or not. But for that 1/3 of your business, I'm sticking to the day-ahead segment.
Yeah.
What can be the loss in market share? How quickly do you think? Do you see volumes shifting immediately? As now there'll be uniform price discovery. Just help us understand. I mean, your shareholders want to know what they need to be prepared for, because that 1/3 is a reality now. So just explain how this will play out for you.
So on the 1/3, if that happens, then there is going to be a competition. And
so why
whosoever is
that's the clear CERC order. Unless you're going to court, there's no if there, right?
So So this is my if is pertaining to the timeline, whether it happens in January or a little more time is needed.
Okay.
So whenever this happens, there would definitely be going to be more competition, number one. And whosoever is able to provide better services would gain in the competition. We feel that our strength is technology. We have been in the business for 17 years and have been able to maintain very good share, as well as we have huge customer base. We have more than 5,000 customers registered with us. So that is going to be our edge.
Yeah.
We have people.
What is the drop in volume, sir, that you're forecasting or that you realistically think will happen in the DAM market?
Sorry, come again.
What is the drop in volumes in the day-ahead market that you see ahead from January for you?
So we would try to maintain where we are. But yes, if the competition is going to be there, definitely there could be some drop. Very difficult to put number to it. Very difficult to quantify this at this point in time.
Got it. All right, Mr. Bajaj, couple of questions now. According to you, why the CERC went ahead despite the Grid India saying that there's not much benefit? So that's point number one, because, the street was actually not expecting it. And the second part is Grid India technology ready to handle coupling?
I can answer the second part because for the first part, regulatory order is already there. Regulator has considered all the aspects and then the final order has been released.
Right, it's come as a surprise, sir, but answer the second part. Are they ready to handle it?
So, not right for me to comment on the regulatory thing, but second part, what we understand is the simulation has been done. They have some technology available there, but they have done this on post-facto basis. So it is not done on the real-time basis. It's not that when we are running the day-ahead market, similar set of front end, back end, all those things are readily available. They did it. They have taken data from all the exchanges and subsequently they did it. So technology, something is definitely there, but not up to the mark, which can be implemented immediately.
Okay, all right. So there is some technology in place. The other question I wanted to ask is on that 4 paise. Bernstein, the brokerage firm, they are saying that it could possibly come down to 3 paise. Do you think that's possible? One. And the other two exchanges, they believe now the market share is going to be divided by a third. They are eyeing 30% each. What do you have to comment on that?
So don't want to comment on what they are projecting for themselves.
So you believe you can hold on to your ground? You have the technology, some technology advantage?
We will, since as I mentioned, technology and people is what our strength is. And see, till now we were working for deepening of the market. All our efforts that were going in, we were working closely with regulator and government and ensuring that our market size should also be similar to what global markets are doing.
Right.
And we take pride in saying that by the last 5-6 years, we have almost doubled the market. In fact, we have seen 100.
Right, Mr. Bajaj, if I can come in, just a quick point, sir. And absolutely, all that is well recognized. I had a simple question. I was talking to a few investors in your company, and what they told me is that, this came as a bit of a surprise because they were being the communication from the company generally over the last few months was that this is not going to happen. That this is extremely unlikely that this will happen. So in that sense, many were taken aback when this happened, and you saw the reaction in the stock. Could you just talk to us through that? I mean, was that was that a big surprise to you as well? And was there any inkling? Because it was about communication from the company, which I heard from many investors I spoke to, a few actually. Go on.
So we were going, so the communication that we were doing was purely on the basis of results of the study, which was coming open in the market, a little bit of it. So whatever we could able to understand from the result, we were there to believe that not much saving is there. But regulator has taken overall view. They have mentioned certain things in the order. On the basis of that, they have taken view. And now the view is there. It doesn't matter what we believed earlier. Now, once the order is there, I think those things have gone past. So this is the reality. And now we are preparing to ensure that we should be able to maintain.
No, but sir, Mr. Bajaj, which brings me to the point that you made earlier. You said that you believe that this will not be extended to the real-time market. And I want to ask you where that belief comes in from. Because it's been applied. And some analysts we spoke to yesterday were saying the market actually believe that it will first come to the real-time market and maybe then gradually be implemented in the day ahead and the term ahead. If they've done it in the day ahead, what stops them from doing it in the term ahead? I mean, are you basing that that view on some technological issue? Is it a tech challenge? What makes you think it won't happen to the RTM market when the regulator is saying they're going to run a pilot?
So let me explain you. Real-time market, the activities which are being done is exactly same as what we do in day-ahead market. But in day-ahead market, there is 4-hour window available to do that. In real-time market, it is 45 minutes which are available to do that. And this is very complex. You have to take bids and then carry forward things are required to be done. Bid window is only 15 minutes. Everything should get completed in next 30 minutes. So the level of complexities which are there
is more in the real-time market. Got that.
As you are saying that some of the people are saying that they were expecting it to come first for real-time, then they made it for DAM. So probably this is the reason they realized that we are not ready to implement this in real-time market as of now. And order also says that.
No, fair enough, sir. I got your point. I just want to understand. So you're basically, technologically, you think real-time will be more complex. So it's a hope rather than maybe a belief that it won't be extended. Sir, have you had any communication with your, key shareholders yesterday, including Dalmia? They've been sort of in the market, partially offloading stake. Is there any communication with investors since yesterday in terms of any of them looking to perhaps pare down stake?
Yeah, just to add on to that, sir, is there a rule that they have to restrict their holding to 5%? Because Dalmia Bharat, they had a big 15% chunk that's come down to 10%. But is there a rule in place that they can't, no single entity can hold over 5%? That's the question. They can continue holding the 10%?
Single entity who is participant in the market, they cannot hold more than 5%.
Okay, all right.
Otherwise, the window is 25%.
So Dalmia can continue to hold on to that 10% without any tension. Got that.
Absolutely.
But have there been any conversations, whether with Dalmia or your other key, shareholders? I'm sure you must have gotten a lot of calls yesterday because this has raised fundamental issues on your business moat. So just tell us, we're just asking for the same conversation to be translated to the minority shareholders as well.
So generally, I am there for last 10, 11 years, and all these decisions are taken by the shareholders themselves. We are management. We are trying to deliver what is needed, the performance of the company, and no such discussions happens with us.
All right. They got lucky. They sold 5% at 200 rupees, so in the last quarter itself. Today, it's around 145. We'll see what they have to do. I'm reaching out to Dalmia Group and checking what they want to do. Very quickly, you're making that point on that 4 paise could possibly reduce or not. Do you think you'll hold on to this 4 paise or do you think you'll trim it down?
So I won't comment on that. Okay. If there is competition, there could be possible reduction. So I'm not saying that it cannot be reduced. It will take its own course.
But it won't go to 1 paise. You're saying it won't go to 1 paise.
At this point in time, I don't believe that it can go to that level. Globally also, the charges are reasonable and it is around that in the smaller exchange. And let us not compare ourselves with somebody like Europe where the volume are 10, 15 times.
Okay, Mr. Bajaj, we'll leave it there, sir. Thank you very much for joining us. And I really appreciate you answering all those questions and staying with us over the last 10, 15 minutes or so, taking those questions. We'll wait for whether you'll go the legal route to try go to the courts to try and get a stay. Appreciate you joining us, and we'll speak again. We'll take a quick commercial break here. Come back. It's the economy on the other side. Lata in conversation with Somikanti Ghosh of SBI, Bhavesh Jain of TransUnion Civil, as bank loans to MSMEs have surged in the first quarter. Stay tuned.
Welcome to It's the Economy. Today we do a deep dive into credit growth for the MSME sector. Loan growth numbers from the three top private sector banks, HDFC, Axis and ICICI, show that loans to business banking, now business banking means MSME sector, loans to that sector was more than double the overall loan growth. For instance, just look at ICICI, the MSME loan, business banking loans grew 29.7%, overall loan growth 12%. HDFC, MSME's loan 19.6%, overall loan growth 6.7%. Likewise, for Axis as well, it's double. Separately, Bajaj Finance told us yesterday they see stress in the two-wheeler and the MSME segment. Okay, their credit cost has gone up, or rather provisioning. To understand if loans to MSMEs, the surge in the loans to MSMEs is a positive sign or is it a precursor to a bad loan cycle, I have with me Soumyakanti Ghosh, Group Chief Economic Advisor of SBI and, of course, Finance Commission member. I also have with me Bhavesh Jain, Managing Director and CEO, Sibyl TransUnion. Thank you very much, gentlemen, for your time. Soumya, if I may start with you. I know you've written a lot of reports on MSME. Have you noticed the MSME sector getting healthier? How do you account for this fairly big surge in the loans to this sector?
Yeah, good morning, Lata. I think the credit to the MSME sector for the banking sector as a whole, if we take last year also, and this year, whatever results have been declared, I think credit good to the MSME sector continues to be healthy. And in fact, if you look into the overall headline credit growth and the MSME credit growth as per the disaggregated data published by RBI, the MSME credit growth is running close to around 19%, while the headline is below 10%. And this trend actually has persisted last year also when the credit growth to the MSME sector was strong. There are, I think, three possible reasons for that, to these 3 or 4 possible reasons. First is that I think but that is basically the first could be the reason is basically a little bit technical one, is that there has been a definitional change for the MSME sector because now the turnover and the investment limit has been redefined. So a lot of non-MSME players are also migrating to the MSME sector. But that is a small technical point. The second important point is that I think the government has taken a lot of initiatives in the last 2 to 3 years along with the banks in terms of digitization, in terms of putting a emphasis on pushing the portfolio, the trades, receivables and other factors are other important steps. And a third important thing is basically the guarantee cover has now been raised to 10 crores. So earlier,
you mean the CGT MSE?
Yes, CGT MSE. So that cover is now raised to 10 crores. And incidentally, out of the, I think on the Uttam portal, which is basically an index of the formalization of the SME sector, around 6.3 crores MSME has registered, of which 99.1% or 2% are micro borrowers. And since these micro borrowers, the outer limit is 10 crore. So therefore, the CGT SME cover being extended up to 10 crores augurs well for the sector in terms of a guarantee. So, and finally, I think the other important point is that the growth in the MSME sector seems to be real this time because there is a lot of new to credit which is happening to the sector, and both across public sector banks and private sector banks.
Okay, you know, that is actually Sibyl's forte, to tell us whether there are more new to credit guys in the MSME pool. First, that question to you, Bhavesh. Before I ask you about stress, are there what you call NTC, new to credit guys who are taking loans in that MSME segment?
Yes. Thanks and good morning for having me on the show, Lata. Yes, we do see a good healthy number of new to credit coming through the door. It's been ranging between 47 to 51% for the last few quarters. A new to credit, which is a very healthy sign when we compare it to the other lending markets and segments. Second question around the stress. As of March 2025, we have seen the delinquencies for MSME portfolio have come down significantly as compared to the pre-pandemic times. It's almost come down to 1.8%, which is on some of the segments it's at a decade low. But when we compare it to the recent time, which is say April and May, as of May, the delinquency of 1.8 has slightly inched up to 1.9. But when we compare it on a trend-to-trend basis over the last few years, it has come down significantly.
Okay, so you're saying that, can we just go to the previous slide where you showed us the bar chart of 1.8? The total bad loans as a percentage of total loans given to MSMEs has come down significantly, as you can see, over the past 5 years. But you're saying March 2025's 1.8 is probably 1.9 for June 2025. Is that right, Mr. Jain?
Yeah, 1.9 as of May 2025.
May, okay, we don't still have June numbers.
Yes.
And you were going to give us some nuances within the numbers. You're saying that the smaller loans defaulted more under the 50 lakh category. I think that's the table that we were going with. Is that right?
Yes, so the credit exposure with below 50 lakh, the NPA levels are slightly higher. In fact, less than 10 lakh, it is significantly higher as compared to the aggregate MSME portfolio quality. And as the ticket sizes increases, we see a good trend in terms of the delinquencies coming down.
Okay, okay. Well, at the moment it is 1.9, so we will just worry a little bit. Shaumya, you know, besides the 3 banks which indicated the numbers, they only said we have given more. All the 3 banks have shown very restrained NPAs. I mean, very small increase in Axis Bank's case, but that was for technical reasons, not because they said they were stressed. But Bajaj Finance numbers yesterday said that their credit cost has increased because they saw stress in the 2- and 3-wheeler segment and MSME segment. So that's why I'm asking you, do you think that there is a certain exuberance year after year, so much loan to MSME? Is there something we should worry about?
I think, Lata, at this point of time, given the initiatives, given the guarantee cover is at 10 crores, and given the fact that out of 6.3 crores, I think more than 99% are micro borrowers. So given this fact, I don't see too much amount of stress building up in the MSME portfolio in the future, because I think there has been a lot of significant steps and the walls which the RBI and the banks have built over the last 3 to 4 years to ensure that this credit grows healthy. And just to give you an example of the amount of credit which this sector actually could do, I think, and this is actually from the CIBIL data, I think out of the 6.3 crores MSME which are registered on the Uddam portal, I think 94 lakhs is the number who have got credit. And overall credit portfolio of the MSME today is around 32 trillion or so. And the per capita MSME sector and the micro loans actually is around 15 to 17 lakhs. So even if we're assuming a penetration rate of 25%, the credit potential of this overall portfolio, of which 99.23% is micro, could be in excess of around 20 trillion.
No, I take your point. Mr. Salunke, the gentleman from the SME sector, is always saying that, you know, there are 6 crore MSME companies and not even 1 crore have yet been serviced. And I agree that there is a headroom. But, you know, now we are not seeing corporate loan growth, as you can see from the 3 banks that have already reported also. Plus, Soumya, the government's capex is not going to grow. It will perhaps not fall off, but because of the fiscal deficit conditions, it's going to remain, it is going to plateau. So do you think MSMEs will have enough business to continue with this kind of a loan growth, or will banks have a problem finding good MSME borrowers?
See, as of now, the problem is of plenty. I mean, there's plenty of SME borrowers. The problem is actually of plenty as of now. Okay. And I agree with your point that corporate credit has not expanded significantly in the last 2 to 3 months. But my sense is that if the SME sector is growing, that means there is some amount of demand from the corporate sector also because of the integrated value chain. So from that perspective, I believe that as of now, we should celebrate the growth in the SME portfolio without bothering too much.
No, point taken. We should celebrate, and perhaps it will also continue because MSMEs, as I think you and Sajid pointed out, are extremely credit price sensitive. When interest rates fall, you and I may not take a home loan because we have to wait for other conditions. But the MSME jumps onto credit much faster than large corporates. Very quickly, Bhavesh Jain, do you think this growth in MSME credit at 13% CAGR is likely to continue? What was the number you got for April, May?
So it's slightly come down. It has come down to below 13%. But with the multiple initiatives by the government and the programs, it should come back. And we do see some of the large credit institutions showing the confidence in the MSME sector. And there is a huge headroom. As we had published in our CIBIL MSME Pulse report, that out of the Udyam registered MSME, the credit active population is sub 1 crore, which allows a lot of headroom for formal credit inclusion of these MSME.
Got it. Got it. Thank you very much, gentlemen. Out of time, but it was a meaningful conversation. The increase in loans to MSMEs has not exacerbated any stress. I mean, it's gone up marginally from 1.8 to 1.9, as Bhavesh Jain pointed out. But on the whole, both Soumyakanti Ghosh and Bhavesh Jain think that there is plenty of headroom for the MSMEs to grow, and stress is not showing just yet. We wrap up on Bazaar. Chartbusters coming up.
Shares of Bajaj Finance fall over 4% after its June quarter numbers failed to impress the street as asset quality worsens. The management in its conference call says there is stress in 2 and 3 wheelers as well as MSME segments, which will continue to persist.
Shares of IEX rebound. They trade higher by close to 8% after a 30% plunge yesterday on market coupling development. The stock remains under the FNO ban. The management tells CNBC-TV18 that market coupling impact will be limited.
Emphasis trades higher on the back of inline margin and strong deal wins. The company's large deal pipeline sees a near 40% uptick sequentially and more than doubles year-on-year, driven majorly by AI projects. Management tells CNBC-TV18 they're still in early stages of AI adoption and expect FY26 margins to be between 14.75 and 15.75%.
Shares of Phoenix Mills, well, they rise close to around 6% after the company's profits gain. While margins remain flat, the board approves proposed buyout of 49% shareholding in Iceland Star Mall developers for around 5,449 crore rupees.
Shares of KFintech, they fall over 6% as well. The company's June quarter revenue and profits fall short of estimates. Margins also witnessed a near 170 basis points downtick.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets have moved to the low point of the day. We're at an extremely crucial juncture right now because if the markets need to reverse, this 24,850 mark is the level that the bulls were eyeing. So important mark out there, but earnings are coming in thick and fast. So let's get straight to it. Mangalam.
Yes, when it rains, it pours. It is at the low point of trade for the frontline index. Bulls would hope that it does not turn out to be a Freaky Friday for them. But the first earnings that we have on our show today, V-Mart Retail reported a steady June quarter. The street was prepared for a 12.5% revenue growth because the company had said in its first quarter update already. The profits jumped manifold on a low base. The stock under pressure today, but was a big mover in yesterday's trading sessions. The CFO, Anand Agarwal, joins in. Thanks a lot, Anand, for joining in. Always a pleasure speaking with you. You had told us in your update that your same-store sales growth adjusted for Eid was close to around 5%. I have a quibble around that, you know, when it was great, you did not say that it was great because of the presence of Eid. But now that it's not great, you've said that if you adjust for Eid, it would have been 5%. That's not you. That's the entire sector that did that. But be that as it may, all the festivities done. Monsoons are good so far. How is second quarter and more importantly, second half looking? Can you do better this year than what you've done in the first quarter?
Absolutely, yes. I think just to put things in perspective, we also have all the festivals this year preponed. So just like Eid got preponed to quarter 4, we also have Durga Puja, which will also get preponed into quarter 2 this year. So therefore, quarter 2 should also look better. And definitely, I think the kind of traction and the kind of footfalls that we are witnessing on the ground, we are looking at slightly better performance. I can't share the numbers, but definitely we are looking at slightly better than what we did last year.
What would it mean then? SSG growth for the year? What's the target?
I think we will still maintain mid to high single digit for the full year. Let's gun for better. But I think that is something that what we delivered last year, and that is something that we would want to better this year again.
Okay. And what does it mean in terms of revenue growth and margins?
I think revenue, we should still look at, mid-teens to high teens full year level. Margins, I think, will again remain a function of how much we are able to do on the SSG. Should remain range bound, but we are optimistic that we should be able to improve on margins as well.
All right, you're expecting margin improvement with mid-teens revenue growth, high single digit sort of same-store sales growth that would come by this year as well, mid to high single digit. If you could give us a sense on a couple of other parameters as well. You know, what really stood out in your first quarter was the footfalls. That increased by about 14%. Your average sales price also increased by 1%, as did your conversion. Are you giving out any targets for this as well this year?
So there are a lot of targets that the teams are working on, but too early and too premature to share that with the street. But definitely from operations perspective, we are working on 3 major, pillars. One is on the product side, where we have drastically improved our product profile in terms of the, the coverage, the fashion quotient, the pricing, the availability and the supply chain and all of that. The second part is looking after the existing stores, how well we can redo the existing old stores, so give them a fresh touch, become more competitive in the market. And third is getting into the expansion mode. So we are pressing the pedal on expansion. We're looking at much higher, more robust growth in all parts of the country. So we are looking at, regaining some lost ground that we did post-COVID. So all these three areas, we're really working very hard, and I think results should start coming up now.
You've given me a lot of streams of thought for all these areas itself, and I'll just pose that as a question to you. The first one is, how have the economics of a new store changed over the years? Because you're planning to add 50 to 60, 65 stores every year. Some stores become old, you have to replenish them, or you have to refurbish them, add new merchandise. And all of this at a time when inflation is there, when it comes to manpower and, the competition that there is as well. So how have the economics of a store changed over the years, if you could give us a sense of that? And you spoke about having lost some ground. What is the moat for V-Mart going to be? Because from a shareholder standpoint, there are multiple options in the value retail, value fashion retail online, and value fashion retail in every part of the country. There are multiple options. What is the moat for V-Mart going to be?
So two questions here. So first, let me address the economic question. So from a cost perspective, definitely there is a lot of inflation. There is a lot of inflation in terms of competitive pressures, and there is also therefore a lot of pressure on how well we are able to source our real estate, and all of that has an implication on the running cost. So all told, I think we require around 2 to 3% of same-store sales growth to beat inflation and maintain the cost structures. And SSG of anywhere upwards of 4 to 5% brings in the operating leverage. So that's on the economic side. But coming to the moat side, I think the moat that V-Mart has always enjoyed has always been the discipline with which we sort of ensure that we don't get into any rush decision. So we're very, very disciplined and conservative on cost structures. We are very, very frugal. We are very, very conscious about not speeding up the expansion just for the sake of chasing a target. We ensure that every store that we try to open has to become profitable on day one. So in fact, in the last 22 years of our operations, 90% of these stores that we have opened have become profitable in the first month of their opening. And that's something that we really are very, very proud of, and we would want to maintain. So we're not really looking at chasing just growth for the sake of growth. We are only looking at profitable growth and remaining frugal and remaining true to our nature of being a value retailer.
All right. Sir, a few years ago, I recall when you all took over Unlimited. Could you tell us on a, sales per square foot, how far is it away from V-Mart, and when do you see them converging?
Yeah, absolutely. So Unlimited, when we took that chain, from Arvind, that was performing at sub 500 rupees sales per square feet. And today, it at a enterprise level, it is already delivering more than 650 rupees sales per square feet. The good part is that all the new stores that we have been opening in Unlimited brand for the last 3 years, they have started to come at par or even started to better the performance of even V-Mart stores. So thereby, we are quite, gung-ho about the opportunity in Unlimited. Unlimited, as you know, operates only in South India. So that's a brand that we have kept, preserved because it was already very well known in South India. So we didn't want to change it to V-Mart. But all our stores carry the same format as V-Mart. But the Unlimited brand only operates in South India, but it is now becoming very profitable.
All right, final question before we let you go. Just give us two numbers. One, inventory days, that it has improved in the first quarter. Do you have a target in mind for that? Go beyond the 93 mark. And the second part is LimeRoad. You've reduced losses, and you have said that this is not a profit-making business for you. It is going to service your overall customers. So what is the metric that you are looking at which decides on the efficacy of LimeRoad?
So on the LimeRoad piece, I think we've said that in the past, it remains a service center for the entire business, being the omni enabler. And I think the losses there, we have been cutting down by almost 50% every quarter. And that's the trajectory that we will still maintain. So this is more like a cost center sitting within the P&L as an IT services for the team. And the number that we look for in LimeRoad is how more we can extract in terms of organic revenue by repeat sales and ensuring that we reduce the loss of sales from VMart customers by allowing them to order online through LimeRoad.
And inventory days?
Inventory days, I think mid to long-term target is around 70-75 days, and we are working towards achieving that.
Take that point, Anand. Always a pleasure speaking with you. Wish you good luck for the remainder of this year, and all festivals will be preponed this year. So obviously, we'll have better celebrations in each quarter as against just a few quarters as we saw in the last year. Wish you a very happy festive season as well and festive season sales. With that, we'll take a short break, and on the other side, we'll get chatting with the management of another company. We will have Sambhav Steel joining in.
Welcome back. Well, let's focus on Sambhav Steel Tubes. The company is in focus. Remember, it's a recent listing and their quarter one numbers actually have shaped up quite well. To help us out with what's the way ahead, we're joined by the MD and CEO, Mr. Vikas Kumar Goel, as well as the Chief Strategy Officer, Mr. Vikas Agarwal. Hi, Vikas and Vikas. Thanks a lot for joining in and congratulations, on a good showing and congratulations on the listing as well. Your shareholders will be quite happy because the stock price is up more than 80% from the IPO price. So good going on, y'all. Now let's focus on a couple of details. For the first quarter, you've delivered EBITDA per ton of around 7,500, 7,800 rupees per ton. For the year on an average, where does this number go to? We understand operating leverage is playing out. The dependency on external power as well has reduced. So what is the sustainable EBITDA per ton number we should look at? And now you're selling close to around 95,000 tons per quarter. So for the year, what should the sales volume look like?
Thank you, Nigel. Thank you for inviting us and this opportunity. And दो आपने एक प्रश्न किया कि जो हमारे अभी क्वार्टर्स के जो नंबर्स हैं, जो हमारा प्रोडक्शन का वॉल्यूम है और जो हमारे प्रोडक्शन पर टन जो हम EBITDA कर रहे हैं, ये हमारा पूरा प्रयास रहेगा कि हम इस पर टन को और इसी तरीके से मेंटेन कर पाएं। और लास्ट ईयर ही हमने जो हमारे वैल्यू एडेड प्रोडक्ट्स जिसकी पाइप एंड ट्यूब्स की कैपेसिटी हमने इंक्रीज की, हमने हमारा जीपी पाइप्स जो प्री गैल्वेनाइज्ड पाइप्स नया चालू किया नई टेक्नोलॉजी से, और हमारा ड्रीम प्रोजेक्ट हमने स्टेनलेस स्टील बनाना शुरू किया। तो उसका रैंप अप फेस हमारा लास्ट क्वार्टर था और इस फर्स्ट क्वार्टर में हमने लगभग उसका 66% यूटिलाइजेशन किया है और गोइंग फॉरवर्ड और हमारा यूटिलाइजेशन बढ़ेगा तो कुछ वॉल्यूम ग्रोथ और देखने को आपको मिल सकती है। और ये हमारा अभी तक का हमारा जो आपने प्रश्न किया उसका टारगेट है।
So, sir, roughly volume growth for the year will be how much? 30%, 40%, mota, like what will it be? And if you could tell me EBITDA per ton, what is the current value added contribution as a percentage of the mix and where is it headed?
अगर मैं वैल्यू एडेड की बात करूं तो लगभग पाइप्स एंड ट्यूब्स, प्री गैल्वेनाइज्ड पाइप, वी आर फोकसिंग ऑन द फिनिश प्रोडक्ट्स ओनली, इंफ्रास्ट्रक्चर प्रोडक्ट्स। तो वी आर मेकिंग 80% ऑफ वैल्यू एडेड प्रोडक्ट्स, जो डायरेक्ट हम कंज्यूमर्स के साथ में रिलेट कर पाते हैं और कंज्यूमर को हम सप्लाई कर पाते हैं।
Okay, 80% value added products. आप EBITDA per ton, if you could give us a sense, ये 8,000 रुपए per ton के आसपास, will that maintain for this year?
बिल्कुल हमारा यही प्रयास रहेगा, कुछ ना कुछ और ऊपर देखने को मिलेगा आपको और नीचे न हो, ये हमारा प्रयास रहेगा।
Okay, तो if you do about 8,000 rupees per ton and roughly 4 lakh tons of volume this year, entirely possible because first quarter you've done 92,000.
लगभग आपको ये कुछ हो सकता है Q2 में कुछ थोड़ा बहुत 5% का एक हो सकता है जो स्लगिश थोड़ा सा जो बारिश का एक सीजन होता है, लेकिन Q3 और Q4 और बेटर देखने को मिलेगा। तो कुछ ना कुछ यहाँ से और इंक्रीज ही होगा हमारा वॉल्यूम और पर टन EBITDA भी कुछ ना कुछ इंक्रीज होगा जैसे जैसे हमारा स्टेनलेस स्टील की क्वांटिटी हम ज्यादा यूटिलाइजेशन कर पाएंगे तो पर टन EBITDA भी हमारा यहाँ।
Sir, roughly मोटा sir, for the year EBITDA number will be in the vicinity of around 320 crores, 320 की 350 approximately.
सर जो हिंदी में बोलते हैं आपके मुंह में घी शक्कर, बिल्कुल हमारा प्रयास तो यही है कि हम इसी क्वांटिटी के साथ में और पर टन EBITDA 8,000 के अबव हम आराम से कर पाएंगे, ऐसा हमें लगता है।
अच्छा, तो करीब 300-350 करोड़ के बीच में आप EBITDA इस साल करेंगे। अब विकास से विकास की तरफ जाते हैं। विकास, आपने IPO में पैसा रेज किया था, you wanted to repay debt. What does your balance sheet currently look like? What is the kind of debt और कितना देना बाकी है? Interest cost कितना कम होने वाला है इस साल?
So, if I see as on 30th June, we didn't raise the money because the money we got after July. I mean after June. So in July, mostly 390 crore of term loan and working capital loan has been paid. So that is the that return and the amount to 8 to 10 crore rupees of interest cost saving going forward quarters. So in roughly, I believe we will be saving around 24 to 30 crore rupees of interest cost going forward. There is still some working capital loan that is still lies in our balance sheet, which we will be continuing to utilize. And we believe the going forward, our debt will be in terms of working capital only will be there and not the term loan. So we will be virtually debt free in terms of term loan, and there will be a certain amount of working capital that we will be utilizing.
What does your current net debt stand at right now, including long-term and working capital, and post-repayment by the end of this year? What will it stand at, even if it is just working capital?
It will be not more than 200 crore rupees that we are projecting currently.
Got it. All right. So got that. And your interest costs effectively will come down from 15 crores per quarter to approximately 5 crores per quarter. Is that correct?
Precisely. Yes.
Got it. All right. You have said that you'll want to increase capacity. So as of now, what is the updated capacity that you have? With the plans that you have on the board, where do you see this capacity headed? And in terms of market share, it's obviously a growing market, but how do you see your market share go up? I think at the time of IPO, you had mentioned around 2% was your market share.
Correct. So we are operating in 3 segments. First is structural pipes and tubes, where our capacity is around 350,000 ton end product. Then second product is galvanized pipe, which we have an installed capacity of 60,000 currently, which may go up to around 1 lakh to 1,18,000 ton this year itself. Then we have stainless steel coil manufacturing capacity, which is currently installed capacity of around 60,000 ton, which also may be expected to go upward of around 1 lakh ton in this current financial itself. So in total, if I see total end product capacity we have currently is around 4,70,000 ton. We have given guidance on having another unit which is installed having having product of 1.2 million ton, which will be executed in 3 phases. So first phase, we are expecting to be, commissioned by end of financial year 2027.
Because
that will add
because we're running a little short on time, but just to get that number out of the way, currently you're at around 500,000 ton, which posts this capacity that you're expanding. In the next 2 years, by the end of FY27, you'll be 1.2 million tons. Is that correct?
No. So in end of 2027, I will be adding another 4 lakh ton. So my capacity will go around 0.9 million ton current.
0.9 million ton. It'll go from around 0.5 to around 0.9 million tons, right?
Correct.
And in terms of market share, say in the next 3 years, where are you headed from 2%?
In structural pipe, we will be upward of 5%, and stainless steel also we will be upward of 5%.
All right, market share upwards of 5% from the 2 to 3% that you had during the IPO. Looking at around 300 to 350 crores of EBITDA this year, led by close to 4 lakh tons of volume and about 8,000 rupees per ton in terms of EBITDA. Vikas and Bikash, thank you so much for joining in and giving us the business outlook. With that, we'll slip into a short break. On the other side, we have all the market action that we will be covering. Near the low point of trade once again for the market, 200 points lower for the Nifty, nearly 560 points lower for the Sensex. the mid caps and the Nifty bank not doing particularly well for the bulls. They might be feeling fairly jittery. And the biggest reason for that, or the biggest the display of the weakness that we are seeing in the market, is stocks that have done extremely well are now seeing some profit booking. So case in point, something like an Eternal comes up for you at the low point of trade after having seen a big gain. So bulls perhaps trying to take home some profits, whatever they've made in this week itself. And the stocks that were doing badly yesterday continue to do worse right now as well. We have names like Trent, which have moved to the low point of trade once again. With that, we'll take your leave on this edition of Chartbusters. Thank you so much for watching.
Good morning. Welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Hormuz Fatakia, and we are starting this Friday morning on the back foot. It's a massive selling that we're seeing across the board. It's a broad-based selling, actually. If we talk about the Nifty, down a 200-point, mid-caps are falling even more. There's a 1.2% cut on the mid-caps as we speak. The advanced decline ratio absolutely in favor of the declines, outpacing that number that is in the favor of the declines. And right now, we are at the day's low as well. And that gap between advances and declines is only getting broader by the hour. It's only Nifty Pharma that is managing to be in the green currently. Even that is absolutely flat. Industrials, capital goods, all of it putting a lot of pressure on the Nifty currently. We do have a lot of stock-specific action, earnings which are trickling in. Bajaj Finance, after that credit cost issue, that stock is down around 5% as we speak. SBI Life, on the other hand, is doing well. That stock is up 2.5%. We have Bajaj Finserv, which is lower. All these auto names are lower in trade. We'll talk about the impact of UK FTA trade deal being signed as well. But overall, the end to the week so far hasn't been the best for the bulls.
It hasn't been, and we started off the session with a 100-point uptick for the week, but now with this 200-point cut, we've now turned down for the week. So 24,968 is that level that the Nifty needs to close above for a weekly gain that it needs to have. We already had 3 down weeks now, so this might just turn out to be the 4th one in case the index does sustain at these levels. But of course, as Sonal was highlighting, there are a lot of earnings reactions trickling in. Phoenix Mills is one of them, 5.5% higher now on the stock. Of course, that also after an HSBC upgrade that came in with a price target revision as well on the higher side. Trident is the other one, 5% higher on that stock as well. Anant Raj is up 4%. So positive earnings reactions, but there are negative earnings reactions as well. KFin Tech is one of them. It's seen a slight recovery from the lows. At one point was down almost 8% and now it's down 6%. Bajaj Finance, as Sonal just highlighted, and ahead of its results, Bajaj Finserv is already down 4.5% in today's session. UTI AMC is another earnings reaction. UTI AMC was down yesterday ahead of its results and down another 4% after its results today as well. A lot of these asset management companies, wealth management companies are trading lower today, be it Aditya Birla Capital, Nuvama Wealth, most of these trading with losses in today's session. But Bajaj Finance was the Nifty stock of the morning that we had to highlight. And of course, after the results, the asset quality stress that they highlighted in their earnings call, credit cost remaining elevated, JP Morgan downgrading the stock, a lot of moving parts here. So let's get in Gaurav, who will summarize all of that for us for Bajaj Finance. Gaurav.
Well, yes. When we talk about Bajaj Finance, at first glance, the report looks very good because profit has increased almost by 22%. Company also delivered AUM growth of 25%. But even after that, commentary is something which is hurting the stock right now. And let me tell you why. When we look at asset quality now, gross stage 3 and net stage 3 assets both have gone up. And the reason being that specifically from the commentary what we have picked is that the credit cost has remained stable on a sequential basis because of 2 factors. First is the MSME segment and second is that 2-wheeler and 3-wheeler segment. Both these segments are actually causing some kind of stress. Now, commentary suggests that this stress is likely to remain in second quarter as well. Company, in fact, is also going to slow down their credit growth in that segment, but they have also retained their credit cost guidance of 175 to 185 basis point. That is something positive, but definitely at this moment, commentary is something which is causing the stock go down because they are taking it in a serious way. Other than that, when we talk about brokerages, from there also we did not see any kind of push coming up. In fact, we saw JP Morgan actually downgrading the stock to neutral from overweight. The reason being that what they believe is that if we look at the valuations, their stock still looks fine, but because there are some near-term pressures in terms of asset quality, so there are no triggers left for the stock, at least for the 2-3 quarters for re-rating, and that is the reason why they have downgraded the stocks. In fact, we also have Macquarie, UBS, Bernstein. They have actually retained their sell rating and underweight rating with some bearish view on the stock. On the other hand, let's also not forget that CLSA has also highlighted one thing here about Bajaj Finance. What they say is that the 25% growth in this environment is something which is remarkable. But at this moment, it seems that Street is not taking this growth in factoring in the growth. It is actually factoring in the credit cost, and that is the reason why we are seeing some stress in the stock price as well.
Okay, all right. Thank you so much, Gaurav, for joining in and telling us what we saw with Bajaj Finance's results this time around. IEX was one stock which was definitely in focus yesterday. A big fall is what we saw yesterday because of those coupling rules being notified by CERC and being approved by the regulatory body as well. The stock, though, has seen a recovery today. It's up around 7.5%. We'll talk about that in greater detail as well. We spoke to the IEX management as well. But if we look at the markets yet again, because there have been a lot of movers in the mid-cap space in particular, Tatva Chintan Pharma, for instance, that is one stock that should come up for you on the screen. That one is up 16% on the back of goods said after quarters of weakness. There has been some recovery there. But we are talking about IEX. That continues to be our focus point. Vivek, tell us more.
Well, that's right. So IEX yesterday clearly grabbed all the headlines, almost a 28% downtick yesterday, trading, one of the steepest falls in the history. Delivery volumes there were quite large as well, indicating that it was actually cash-based selling that was happening as far as IEX was concerned. Now, two things to remember as far as technicals of the stock are concerned. Number one, yesterday as well as today, the stock is in the F&O band. So cannot take any new fresh F&O positions. So fresh longs and fresh shorts cannot be initiated on IEX. Now, the other important thing to note was that last evening, the company actually gave the exchanges their operational performance for the quarterly results, that is Q1 FY26 results, were largely along expected lines. Remember, IEX does share volume update at the end of every quarter. 15-16% volume uptick was seen. On the back of that, top line too grew in the range of 15%. However, most of the headlines continues to be grabbed by market coupling and the implementation. EBITDA is not quite steady, 16% higher. EBITDA margins up 100 basis points. Profitability higher by 25%. Last evening, the company told the exchanges that they are reviewing the market coupling order. Today, we had the management on a challenge. What they're saying is that they are reviewing the order. At this point of time, they cannot comment whether they can go ahead and challenge this particular order in a higher court. Not only that, they're saying that the DAM market contributes almost third of their total volumes. So they're saying that the impact will be limited. But despite that, the markets post this particular development, all of the sell-side analysts have actually gone ahead and downgraded both the valuation multiple as well as estimates. We had the management on a challenge earlier today. It will be interesting to see what exactly they told us, especially in terms of how they will react to market coupling.
So bit early days to comment on that, but let me quickly try to rephrase what is there in the order. So CRC issued order for implementing of market coupling for day-ahead market on 23rd July, day before yesterday. And it talks about initiating the process of market coupling for day-ahead market. There are a few more elements in this order where they said that due to shorter time frame available for bid submission in real-time market, and also because of other operational complexities, coupling of real-time market will be considered at a later stage. So yes, there is going to be some impact on our business for sure. But if we see the whole thing, in the recent time, we have seen day-ahead market is not everything for us. There was a time when day-ahead market contribution in our total volume was 80-85%. But today, this number has come down to less than 35%. We would try to maintain where we are. But yes, if the competition is going to be there, definitely there could be some drop. Very difficult to put number to it. Very difficult to quantify this at this point in time. Single entity who is participant in the market, they cannot hold more than 5%. Otherwise, the window is 25%. If there is competition, there could be possible reduction. So I'm not saying that it cannot be reduced. It will take its own course.
All right, that's the big story for today. IEX management speaking to CNBC-TV18. Let's get another corporate conversation now. DLF and Trident Realty have sold all 416 flats of their first Mumbai project for around 2,300 crore rupees in a luxury residential project in Mumbai. It is because of high demand that has come by. Akash Ori, Joint Managing Director and Chief Business Officer at DLF Homes, is joining us now. Akash, good morning. Thank you so much for joining in. All the flats sold, all the units taken up by the buyers. Can you give us a sense of what your stake is in this JV? Will you be coming to Mumbai standalone? And if that does happen, by when do you plan to do that?
Thank you. Firstly, Mumbai Karna Dhanwad. I think it's been a tremendous warm welcome for DLF in Mumbai. Yes, we did. In fact, we had announced about 5 days back that we will be coming in with 2 towers. But what a demand, what a response. And I think we were compelled to bring out the other 2. So it's been quite a good response for us. And as I say, repeat, thank you, Mumbai. But with regard to our partnership, Trident is our partner here. The relationship is 51-49. And yes, as opportunities keep presenting themselves, we'll see how it goes from here.
So 51 is with DLF or Trident?
51 is with DLF.
Okay. And you do have plans to enter on your own in Mumbai?
We are just about allow us to celebrate this moment today. Yes, as I said, we've got a lot of proposals. We've got people reaching out to us, but very early days. But I think all I can say is we are here to stay, and Mumbai is an important market. NCR and Mumbai are two large markets for real estate, and for a long time, you all in the media, our analysts, friends, and everybody else was wondering and was actually asking us to be here. So we are here with you. We've done what we had to do in our first launch, and I think we'll take it on from here.
Akash, now that you're done with the first launch, are there more in the pipeline? You mentioned whether or not be standalone or be it in a joint venture. Is there more in the pipeline, at least in FY26? We may not talk about the future years ahead, but now that with such a response that you have received for your first project, is there more in the pipeline, in the works?
So the phase 2 of West Park will obviously be next year. But, as you know, real estate is a complex subject. I mean, there are enough approvals that need to be taken for anything to launch. And though we had planned for this to be in 2 phases, in fact, the first launch to be in 2 phases, which we've kind of now done in literally this week. But I think we will have to get down preponing a lot of our planning and get down to it. But definitely the West Park phase 2 launch, please look forward to that next year first.
Okay, so what does it do to overall residential sales guidance, Akash? You had around 22,000 crore rupees. Do you plan to revise it upwards because of the strong response that you've already received? That's within 5 days, right?
Yes. Well, upwards, I was asked this morning as well, but 22,000 is a big number. We've already given you guidance for the next 3 years. We've just come out of the first good sales out of Gurgaon in Privana North there, which was 11,000 crores, as you all know. Mumbai is definitely added to that kitty. But at this point in time, we've got things happening. We've got Goa coming. We've got other things back home in Gurgaon. So I think revising the guidelines at this point in time, I won't want to comment. But I think meeting them and getting on to doing other things is something which is very important.
So you will be able to exceed it at least if you can't give us a number, if that is something qualitatively you can tell us.
Well, as I said, depends on launches. We've got things coming up. Allow us to announce those as we move along. But for sure, watch this space. I mean, I'm sure we will have to prepone. We've had to rejig our strategy, and we will have to see how we prepone some of these things now. But this has been good, and I think the concentration will be in the West, at least in this quarter.
You mentioned Goa very briefly in your previous answer, Akash. When does that happen, and what is the kind of potential that you are envisaging from there?
Goa is a boutique kind of development. This is super luxury, just 61 villas, but we are waiting for our final approval. As and when that happens, I hope we can do this quarter. We're planning for it, but that is going to be quite a marquee project for the country as well.
Okay. All right, Akash, thank you so much for joining in today. Of course, we are speaking to you ahead of Q1 earnings as well, so I think you'll be able to give more idea about things after earnings are out as well. Always a pleasure speaking with you. Thank you so much for joining in today. That's the word coming in from DLF. With that, we'll slip into a break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. Still below 24,900 is where the index lies, a cut of 180 points. The Sensex also down 550. Slight, trying to have some recovery from the lows of that 24,850 level. The bulls trying to defend that. But shifting focus now to the commodities space, and Manisha has escaped the heavy rains in Mumbai, and she's joining us to put the spotlight on metals from a different location. Manisha.
Well, yes, escaping Mumbai rains right now, but not for too long, clearly. The last day of the week has seen most of the commodity prices gain up. So whether you look at energy, metals, all of that is trading on the positive side. But I do want to focus on silver and copper, because this week has been all about these two commodities. You have the silver prices trading above $39 an ounce. And in the Indian markets, the silver is trading at an all-time high at very close to 1,17,000 rupees a kg thereabouts. When it comes to copper, well, the U.S. copper prices are trading at a record highs. We've seen $5.9 a pound in the overnight markets there, and that is because the global scenario really seems to be changing. If you look at the dollar index, we're trading at 3-week lows onto that one. The risk appetite has strengthened in the global markets as well. There is progress about trade negotiations with U.S. for most of the trading partners. We do hear that the U.S. and China trade conversation could extend beyond second week of August as well. The US, European Union seem closer to a deal. Even for Japan, for that matter, we seem to have seen that tariff lower from 25 to 15%. So that means that you would be looking at more demand coming in from various these economies for metals, and that has been supportive. Also, China pushing for auto, for infrastructure, for manufacturing and electric equipment has been supportive for both these green energy metals, which is silver and copper itself. I also want to talk to you about the US Fed meeting, which is in the next week, where the markets are anticipating that we would not see an interest rate cut, but there is now a 70% probability of a rate cut coming in for the month of September. That also seems to be keeping many of these metals in good favor there. And finally, let me take you through on what we've done in the past 1 month when it comes to both of these metals. So while silver prices have gained up by 7% in the month of July, you have copper prices up by 14%. But when you look at the last 12 months, we've seen both silver and copper gain anywhere between 40 to 42%. So very strong gains continuing in both of these metals.
All right, take that point. Thank you so much, Manisha, for joining us with those details and what's happening in the commodity space. Let's slip into a break. When we come back, we'll discuss market technicals with Mitesh Thakkar and also discuss their top trading bets.
Welcome back. And since the markets are looking to recover from the lows of the day, let's go straight across to our FNO desk. And Mangalam is here to tell us what the FNO data is indicating, whether 24,850 will continue to act as a strong support for the Nifty or not. Mangalam, what's the data suggesting?
That is what the street is hoping for right now, because below that there would be a further flurry of selling activity that may take place. The good part is that Reliance is actually holding up or recovering from the lows, and as a result of which supporting the cause of the Nifty, but that's just about 15-20 points. The Nifty is just about 15-20 points off the day's low today, down about 180 points for the frontline index. We have the Nifty bank lower by 400 points as well, and the mid-caps will have your portfolios look like they are in a sea of red. The important part, the Nifty is broken below the 50-day moving average and also below the July 21st low of 24,882, which it's now, trying or making an attempt to defend at the lower levels. And the good part that has happened from a market standpoint is that the VIX, which was fairly contained and perhaps at some point even pricing in complacency, has seen a spike right now, gone back to, more relevant levels of 11, 12. But remember, the VIX on an average around 13 to 14 is good for the overall health of the market itself. The put call ratio, that's come down from 0.88 to 0.75, telling you that put writers have begun to cover their positions and call writers have started to come in the market. So we have the 25,000 call, which is fairly active in today's trading session. We have the 24,900 call as well, equally active in today's trading session. What does this activity tell you? That between 25,000 to 25,050, there is still likely to be some congestion, even if the market does recover. And technically as well, that ties in with the 50-day moving average on the Nifty. At the lower levels, though, 25,100 put writers who were hoping for support coming in at 25,000 are now covering those positions, and the premium out there has seen a sharp spike, though the 24,900 put writers are still holding on, telling you that the market may bounce back from here. 24,900 put has a premium of almost 130 rupees, telling you between 24,750 to 24,800, there is important supports for the market. And that ties in again with the support levels for the Nifty Bank. The Nifty Bank 50-day moving average, which is about 200, 300 points from where the level is right now, is an important support at 56,313. Done with the index, let's talk about individual stocks. We have shorts covering their positions in IEX after a big gash yesterday. And remember, these are unwinding positions because no fresh positions can be taken because the stock already is in FNO ban. And the first hour of trade itself has seen a lot of shorting activity take place in names like KFin. Bad numbers coming in. The stock is pummeled in today's trading session. Poonawalla FinCorp as well is seeing a lot of shorting activity for this time of the day. So that's another stock that I'll be keeping on my radar.
Interesting names there, Mangalam. Thank you for that update. And the bulls would definitely be hoping that 24,850 does sustain on the downside. We did make a brief move below that level. 24,844 is the intraday low that the Nifty has made, and it has since then recovered around about 40 points from those levels. Just before we go to Mitesh, you pull up Force Motors. It was one of the big movers this week, was up yesterday as well. And take a look at the move that it has had from the lows of the day. At one point was down 12 or 13%. It has recovered almost half of those losses now, and it's now trading with losses of around 6.5% is Force Motors. And despite this correction that we have seen today, the stock is still up 8% for the week gone by. Though Mitesh Thakkar now joins in for a quick chart check. Mitesh, 24,850, does it have the power to sustain as of now? Do you see a bit of a reversal back towards 25,000, 25,100, or do you just sit on the sidelines and see how more data unfolds?
Good afternoon. So actually, I have a slightly negative kind of view. One, for me, the key moving averages are placed around 24,930, 900 zones, and we are trading below that. So assuming in case we close below that, then I think it will be a negative. Also is the fact that today was a gap down opening. Yesterday's low was around 25,018, and today we got a high of 25,010. So there's 8-9 point kinds of a minor gap over there. But a gap down typically will suggest, slightly higher chances of this decline continuing. So till the gap is being filled, which is, till we start getting past 25,020 again, in the short term, I would not turn positive. And if we get a closing below this 24,900 zones, good chance that we are looking at levels just below 24,600, 24,550 zone, thereabouts. So the setup for me is slightly on the negative side. And as I said, I think, till we get past 25,020, I'll maintain this kind of a view. On the stock side, I have a Bharat Forge, which is a sell or a negative call. keep a stop at about levels of 1211 and look for a target of around 1160. While Bharti, surprisingly, in a weak market, is performing very well. So buy here with a stop at about 1929 and a target of 1990 to 2010 we looked at.
Okay, all right. Take that point. Yes, Bharti Airtel at the day's high in a market like this. Thank you so much, Miresh, for joining us as always. We'll slip into another break. When we come back, we'll discuss market fundamentals with Ajit Banerjee, President and Chief Investment Officer at Shriram Life Insurance. Welcome back. It's a good time to talk about market fundamentals. Ajit Banerjee, President Chief Investment Officer at Shriram Life Insurance, is joining us now. Mr. Banerjee, good morning. Thank you so much for joining in. While the markets seeing a sharper cut today, a lot is happening in the global trade with macros as well. The recent one being that UK-India FTA that has been signed. Any big takeaway for you from that? Does it change the way you look at sectors now? And anything that is looking very exciting to you after this deal?
Thanks for having me. So I think this is something which was the negotiations and the conversations were happening for 3 years and all. So which has finally got crystallized. Even though actually this will take a final, it will take another possibly 6 to 8 months time to finally get materialized. But there are certainly some positives which would be benefiting the Indian economy for sure. Automobile sector, for that matter, even IT, as well as basically we can see on the semiconductor place. Those are the things which might get benefited. At the same time, in India gets access to their marketplace for the engineering products as well. On the contrary, UK also gets gets access to Indian market. So I guess it is a mutually beneficial trade agreement which has happened. And UK claims to be the biggest trade beyond the Brexit. What is their Prime Minister has claimed.
Mr. Banerjee, good morning. Thank you for joining in. Since we were on the subject of autos is one of those sectors that has been likely to benefit from the FTA. The sector itself, the sector financiers, the CV financiers are seeing a bit of a struggle this time around with regards to asset quality stress, and you saw that in the commentary from Bajaj Finance. It's not necessarily a CV lender, but even for names like HDB Financial or even for Shriram Finance that reports results today, is that a trend that you are anticipating to continue, some stress to continue in the CV lending space going forward, considering that the auto demand so far has been pretty sluggish?
See, what we feel as a house view is that there would be certainly a strain, but that will be more in the unsecured place, which of course CV does not fall into that per se. But generally, with the economy as well as the infrastructure sector expected to do better, and government spending already has commenced. So I think it's a time lag which is there at present. So overall, we are positive on the CV space is concerned. But certainly, there is always a time lag when this in the benefits of the rate resetting takes place. So I guess that is what is going to play out. So for a longer time perspective, we are positive on the CV space. But yes, there can be some minor hiccups in the short term to come.
Okay, Mr. Banerjee, any other space that you're liking, considering the macros, the economy, and what's happening with the commodity prices currently?
The commodity prices, if we see actually some of the positives which are looking at this point of time, infrastructure related, if we see. So metal prices, are something which is expected to, as a metal producer, it is going to be definitely positive for the commodity sector. But as a metal consumer, consuming companies, definitely the cost might go up or expected to go up for a while. Even auto companies are also facing the brunt for that because they're a consumer of the metal sector for that matter. But at the same time, with the infrastructure push happening, at the same time, if the trade, the trade agreement between US and China is on, get settles on amicable terms or on, win-win situation terms, then at the same time, the fear of dumping which can happen from China to India and other emerging markets can get thwarted, and that's positive for India. In any case, we are seeing that the overall consumption led growth has to also increase. So for a sector per se, I think we are positive on the metal, but it might take out time to play out for the fully over the year actually.
Right, Mr. Banerjee, thank you so much. Pleasure having you as always for sparing time and joining us today. The manager, Ajit Banerjee there of Shriram AMC. We'll take a short break and more on the markets on the other side. Stay tuned. Welcome back. Now, the much-awaited India-UK free trade agreement has been signed. It's been in the works for over 3 years, with talks starting in January of 2022. The UK has seen 4 prime ministers since then. Now, Prime Minister Narendra Modi said that there may be a swing and a miss, but India will always play with a straight bat. Keir Starmer, the UK Prime Minister, said that the deal would create over 2,000 British jobs. The commerce ministers of both nations signed the agreement earlier yesterday. Now, the deal is estimated to boost bilateral ties between the two nations by $35 billion and bring down the tariff guardrails to a large extent.
Plethora of items which are uncompetitive to manufacture in UK today, which India can be a trusted supplier in your supply chains. Likewise, they're very high value medical devices, many products that the UK is known for, high value special medicines, where India can benefit from the UK story. UK also is a largely service-driven economy. Another area where we hope to expand our relations so that all in all, by 2030, we can double our trade. And more importantly, a free trade agreement is also a signal of trust, a signal of enduring partnership, a signal that we now have a stable, predictable regime which encourages investments.
All right, that is the big story that we are tracking. In fact, let's get into Sudarshan now to understand on which companies, stocks and sectors will be impacted because of this FTA. Sudarshan.
So this FTA, which was in works for last 3 years, has been finally signed, and some of the sectors that will be in focus because of this FTA. So first on that list is auto, because India is offered concessions both on EVs as well as ICE vehicles. That ICE means petrol and diesel vehicles. So for EV, concessions have been provided for vehicles that will cost more than £80,000, and as far as ICE vehicles are concerned, for petrol, concessions would be for vehicles of 3000 cc, and in diesel it's 2500 cc. Now, next sector that will be in focus is textile and apparel, because there would be a duty-free access for 99% of Indian apparel and textile exports, and some of the stocks that might be in focus: Westman Living, Gokaldas Exports and KPR Mills. Next sector is leather and footwear, because it eliminates tariffs on nearly 100% of Indian leather and footwear exports. Next is marine products and food. Here also it has eliminated tariffs on over 95% of agri, marine and processed food exports, in which tariff rates used to be around 16 to 20% earlier. Next is Alco Beverages. India will reduce import duties on UK whiskey and gin. So over next 10 years, the tariff would be reduced to almost 40% from current level of 150%. Last is gems and jewelry. So currently India's exports to UK in this sector is around 941 million, and UK's imports in gems and jewelry is around $3 billion. So analysts believe that India's exports to the UK is expected to double over next 2 to 3 years. So overall, FTA is positive for both Indian and UK companies.
Okay, all right. Thank you so much for explaining that to us, Sudarshan. Also, stay tuned to CNBC-TV18, because in a short while from now, we'll be speaking to Pallab Banerjee, who's the Managing Director and Group President, Pearl Global Industries, Nitin Panwar, who's the Group CFO at Vaibhav Global, and Tausif Mirza, the MD at Mirza International. All these companies, they will be impacted by this big move. So we'll understand the industry view on the India-UK trade agreement and a lot more. Welcome back. You're still tuned into Trading Hour. Well, Capgemini has acquired WNS for a total cash consideration of $3.3 billion. So let's talk about this. We are now joined by Mr. Keshav R. Murugesh, Group CEO of WNS, to take a few questions about this acquisition. Mr. Murugesh, good morning. Thank you so much for joining us today. You know, you've led WNS through multiple industry cycles since 2015. What made you decide that this was the right moment to sell the company to Capgemini?
As far as the Capgemini transaction is concerned, it is just an acceptance of an offer at this point in time. We are both working through the approval process, which will take a number of months. Until then, we will operate as two independent entities, and in many deals even compete in the marketplace. So I just want to make that clear. Having said that, we've seen a number of changes in the traditional BPM model across the years, starting with the wage arbitrage models, to value beyond cost, to digital transformation, and now the most exciting phase of AI and Gen AI. And personally, I'm extremely positive and excited about this new phase, because this is actually going to create completely new models in the traditional GBS world, and companies, therefore, that lead in terms of leveraging AI and Gen AI to do good for their end customers are going to be the market leaders of the long term. So while WNS continues to do extremely well, in fact, we just announced results today, and our Q1 results show 3% sequential growth and solid metrics on all fronts. And I think it is at this point in time when both companies are actually doing very well that both of us have met, understood where the opportunity of the market is in terms of the long-term creation of a new model around intelligent operations, where we move away from the traditional enterprise automation to much more enterprise reinvention. So this is not a coming together of two companies that are just going to leverage the talent forces. It's going to be a coming together of two companies where one will provide the might of scale, of balance sheet, of potential for investment in AI, Gen AI, technology, automation, cloud, and things like that, and a market force of 50 countries, and the other providing high growth, high visibility, traditional, domain-based operations rigor. The combination of all of this will be a unique new force multiplier in the marketplace, which will be around intelligent operations. And we believe that while on standalone basis, one can continue like this for maybe a year or two, the longer term, the way AI and Gen AI will evolve, this is the model to create, to do the best for not just our clients, our investors, but also for our employees. And that's the reason why we decided to come together.
So, Mr. Murugesh, you are saying that the traditional business model that exists today would have been fine for the next 1 or 2 years. And so if WNS had chosen to remain independent, what would be necessary for you to compete effectively in a landscape that is transformed by AI? What would be the kind of investment you would need?
Today, all of us are making investments in the AI, Gen AI, the field, right? But what is being seen in terms of, changes and the speed of change being driven by AI and Gen AI is the need for much larger, much more massive investments. So if you look at some of the US companies, you look at some of the pronouncements coming out from OpenAI, Google, Amazon, Microsoft, the investment quota that is being put into these models are running into billions of dollars, right? Can a smaller standalone, BPM player that needs to make this huge transformation for the benefit of their customers over the next 5-10 years, make those investments is where you have to place your bets.
So it's in jeopardy only for the smaller to medium-sized companies, given the kind of investments. Do you have a number in mind for WNS? For instance, if they had to remain independent, What would be the amount? Is it 1 billion or is it 2 billion or even more than that?
Well, your guess is as good as mine, because what we are trying to guess about is an evolving movement of where AI and Gen AI will move, how quickly it will scale, what will be the new disruption arriving out of those models, and as a result, how will public companies with smaller balance sheets have to make investments in order to be relevant in the longer term, right? Look, finally, technology and ops is really coming together, right? A lot of us have spoken about the evolution of this model for a long time. But finally, we are seeing that the decision maker on the other side is starting to come together. And therefore, this model that we are talking about is about intelligent operations. And it is all about enterprise reinvention and not just about automation. And it is about taking the ball to where it should be and not where it can be in just 1 or 2 years. So as far as investment is concerned, I actually think the need for investment, the need for disruption in existing business models, the need to cannibalize your own revenue in order to stay relevant in the long term is going to become a force multiplier. And this combination addresses that for the benefit of customers as well as for our employees. Smaller companies or standalone companies in the longer term will find it difficult to do it because the need for investment will be huge. I don't know what that amount is going to be, but I already told you there are other companies investing billions of dollars now in this space. How can you with a small balance sheet compete against that investment? That is the core of the discussion.
All right, Mr. Murugesh, thank you so much for joining in and taking us through this rationale for Capgemini's acquisition of WNS. By the way, some flashes on your screen. Rani Kapoor, the mother of late Sanjay Kapoor, has written to the board of Sona BLW, and she has sought deferment of the AGM of the company that was supposed to be held today, which is on the 25th of July. And she has alleged coercion and misuse of documents, and she's also said that she was approached multiple times and compelled to sign various documents without explanation. Now, the letter which has been accessed by CNBC-TV18, that also mentions that the contents of the documents were never revealed to her, and the fact that she has been totally denied access to her accounts. And this is the letter that Rani Kapoor, the mother of late Sanjay Kapoor, has written to the board of Sona BLW. We'll keep tracking these developments as the day goes by. For now, the stock 1.5% lower, seeing some bit of choppy moves after this revelation. But we take your leave on this edition of Trading Hour. From Sonal and me, thank you so much for watching. We leave you with the index at the lowest point of the day. Halftime report on the other side.
Equities see broad-based selling with the declining stocks far outnumbering the advancing. Industrials and utilities are the big drags, while healthcare and consumer durables show relative strength.
IEX CEO Rohit Bajaj tells CNBC-TV18 the impact of coupling in the day-ahead market will be lesser than earlier expected as its share of revenue has dipped. He concedes that charges may decline but won't see a big drop given the low traded volumes in India.
Bajaj Finance points to growth challenges as stress continues to persist in the MSME segment as well as in 2 and 3-wheelers. And though the lender sees normalization in H2 FY26 and retains its credit cost guidance, analysts fear a negative revision. The stock slips in trade.
The India-UK Free Trade Agreement is set to spark big changes for the industry, with 99% of Indian exports set to extract zero duty and average tariffs on imports from UK dropping to 3% from 15%. Sectors like auto, textiles, engineering, leather, alcobev and jewellery could see an impact. Good afternoon. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Vinny Motiwala. Not a particularly good day for the bulls, you would say, for the market, because after trying an attempt at crossing past that 24,882 mark, which was the low that we saw on July 21st, the markets sold off once again. We're at the low point of trade at midday itself, so there's broad-based selling on D Street. That's not all. The Nifty is at the low point of today's trading session. And if you look at all the major indices, the Nifty Bank comes up for you, the broader markets come up for you, all of them trading a lot lower. The Nifty Bank just about 200 points away from the 50-day moving average. The broader markets as well. An 800-point decline is what we're seeing. If you're looking at individual stocks, 2,100 stocks on the National Stock Exchange currently in the red for just about 500 stocks which are in the green. So it turns out that for the bulls, it may be a bit of a freaky Friday. Vinny.
Absolutely a freaky Friday that's coming in clearly for the bulls, and that advanced decline ratio, look at the gap, it's quite wide today. So that is a bit of concerning, and that's why maybe our portfolios are also in the red, because only one sector is managing to hold on to some bit of a green. That's pharma. Metals is in the red. We have energy, IT, all of them seeing a decline in today's trading session. Obviously, interestingly, today we have IEX that is seeing a bit of an up move, but yesterday we had seen a sharp fall coming in for that stock. So that is something that we are watching out for. I'll just mark the flashes at the bottom of your screen as well. We have this coming in on Sona BLW, where late Sanjay Kapoor's mother, Rani Kapoor, has written to the board seeking deferment of a July 25th AGM. Rani Kapoor is alleging coercion as well as misuse in terms of documents. So that is something that, we'll keep an eye out on, and we'll be maybe joined by Parikshit also shortly from now. So we'll keep an eye on that. But as of now, the stock has seen a bit of a fall today's trading session as well.
It is a bit of a fall, and we've seen, the letter, and the contents of that letter will be flashing for you at the bottom of your screen, along with Parikshit trying to explain what has happened. But by and large, the allegation that Rani Kapoor has made is that she was basically coerced into signing documents behind locked doors. Contents of the documents she had to be signed were not revealed to her, and she has been denied access to her account. She alleges that as, the wife of the late founder of the company and the sole beneficiary of his will, and the mother of Sanjay Kapoor, she would be best placed to represent the interests of the family, the Kapoor family, and not anyone else. So basically seeking deferment of the annual general meeting only on account of trying to gather more information to stake her claim as a person on the board to hold the interests of the Kapoor family out here. We'll obviously get more on this, perhaps a word from a legal expert as well. But meanwhile, keep an eye out on the bottom of your screen. More numbers coming in. Yesterday, Bajaj Finance reported numbers. The street did not take that well, and as a result of which, Bajaj Finserv was lower as well. And now we have Bajaj Finserv numbers at the bottom of your screen as well. Okay, we were talking about the story at the bottom of your screen. We have Vaibhav Ghaggar, who's a senior advocate, joining in now. He's authorized to make a statement on behalf of Miss Rani Kapoor. Mr. Ghaggar, first up, Miss Rani Kapoor is alleging that she herself is likely to be the sole representative of the Kapoor family on the trust by virtue of being the beneficiary of the will. If you could tell us on paper, what is the kind of shareholding that Ms. Rani Kapoor has, which has been defined, and what is the further steps that need to be, what are the further steps that need to be taken for her to actually put into effect this deferment request of the annual general meeting?
So Mrs. Rani Kapoor was the sole beneficiary as far as the will of Mr. Surinder Kapoor, late Shri Surinder Kapoor is concerned, which was a registered will. Shri Surinder Kapoor was the founder and head of the Sonar Group. And when he expired in 2015, there was a probated will with all the assets being given exclusively to Mrs. Rani Kapoor with a clear intent as to what she wanted to do and needed to do with the same. Insofar as what happens, your second part of the question as to what happens with the AGM, you're aware that she's written a letter to the shareholders and the board of directors. She has put down on paper quite explicitly how things have transpired, how there are, serious apprehensions as far as she's concerned in terms of the circumstances leading to the death, what has unfolded immediately post that. And it's a grieving mother who is very sure that what the headlines were when the death occurred, the facts and the headlines do not meet. In her head, this is not just a freak accident. She needs this looked into and investigated deeply, and she wants to get to the truth of the matter.
Do have our colleague Parikshit joining in as well to take a couple of questions. But before I toss to him, I just wanted to understand Aureus Investment Private Limited, which has 28% stake in the company, which is the largest shareholder of Sona BLW. Could you give us the sole beneficiaries or the shareholding pattern of Aureus Investment Private Limited itself? And then I'll hand it over to Parikshit.
So, as far as the shareholding patterns are concerned, those would be publicly available. What is clear is that it is the ownership of the Kapoor family and the Sonar Group, because there's a web of companies which are involved in this entire thing. It's not just a singular company as far as the Sonar Group is concerned. So those are issues which would be grappled if the matters are taken to court. Those are issues to be dealt with in court.
The reason why I ask you this is because, I'm looking at the directors of Aureus Investment Private Limited. This is publicly available information. And the directors out there are Dinesh Kumar Agarwal, Sanjay Kapoor, Priya Sachdev Kapoor. Miss Rani Kapoor's name is not there on the directors of that group as well. So we're just trying to understand the claim that she's making of being the largest shareholder in the company. On what basis is that claim?
So, as written in the letter as well, lots of suspicious circumstances have unfolded and are coming to light now. How various appointments were made, what the role of certain individuals that you have named in just right now, how did they come into being where they are, what were the documents which were signed, what was the manner in which they were brought about. All of these are matters which have to be looked into very carefully. And if this goes into court, all of these would be looked in by the courts.
So, Vaibhav, we believe that the board meeting is taking place today. And as far as the appointment of Priya Sachdev Kapoor, that is what you're contesting. But she was the director of the promoter entity, Aureus Investments. If we go through the company documents, they show that in the absence of Sanjay Kapoor, she has to play the role of director. Now, isn't that obvious that in case of his demise, the director of the promoter entity would be brought on board the company, and therefore she has been brought in as a non-executive director?
You would need to go a step further back and a few steps back as to what the shareholding of Aureus may be and how does anybody become a director in Aureus, who represents the interests of Aureus, and in turn, who represents, therefore, the interests of the Sonar Group and the Kapoor family. I think it's very important to emphatically state that all these entities are, at the end of the day, part of the Kapoor family. And the Kapoor family is structured in a particular manner, starting all the way back from Sri Surinder Kapoor's will, that everything was meant to be exclusively with Mrs. Rani Kapoor so that she could ensure that the interests of the family is not usurped by anybody from outside. She has to make sure the family remains intact.
Vaibhav, does Miss Rani Kapoor or Sanjay Kapoor's sister have a stake in Aureus Investments? Would the stake be greater than that of Priya Sachdev Kapoor? Is there a will which says that in case of Sanjay's demise, the family, that is Rani Kapoor, has to be appointed on the board, or a person nominated by her has to be brought onto the board?
So Mrs. Rani Kapoor herself has been seeking documents, seeking information not just from the companies, but even from individuals to say what has happened, how have things transpired, is there a will or not? You just asked me whether Sanjay Kapoor has a will. She's still not aware, is there a will or not? And even in terms of was the shareholding in Aureus held by Mr. Sanjay Kapoor in his personal capacity or not? Assuming it was, how would the flow go? If there is a will, what happens? If there is no will, then what happens? But as I said earlier, you need to go dig a lot deeper to see where it all starts from, to know how things have really unfolded now.
So you are going to contest this in court, Priya Sachdev's appointment?
It is going to be for Mrs. Rani Kapoor to take the call. She was very clear in her letter. She's not named anybody. She wants to try to get to the truth of the matter and ensure that nothing happens in the meanwhile which could prejudice the interests of the family or of the company for that matter. She's not named anyone quite consciously, I would imagine.
Right. You know, Mr. Gagar, I'm again looking at the shareholding of Aureus. There are, as per publicly available information, 2 major shareholders, in which one of the boards does have Rani Kapoor. And you're obviously representing Rani Kapoor as her counsel, as her lawyer. Up until now, why was it that she did not stake her claim to be the representative of the Kapoor family's interest? It is, you know, one just is wondering about the timing of this all.
Because until now, it was her son who was heading everything on her behalf. And therefore, she did not need to stake claim. Number 2, it is only post the demise that she was forced to start looking into the affairs because of the events that transpired. Number 3, she's very sure that something is amiss for it to be treated as a freak accident only. She wants to get to the truth of the matter. And number 4, today, she is the person who has to make sure that the family remains intact. Therefore, she's coming forth. In terms of what you said, that you found the timing to be strange, please look into the letter a little more carefully, because I thought it's quite explicit in her letter as to what all she's been asking for, what she's been made to do during the period of mourning. An 80-year-old lady loses a 55-year-old son, and the next few days she's made to sign documents in certain circumstances. I would imagine that would also be something which should be of matter concern to people.
Right. But you know, Mr. Gagar, the fact is, and we spoke to Vivek Vikram Singh, the CEO of Sona Comstar, soon after Sanjay's demise, and just days after the board had taken a decision to appoint Jeffrey Mark Overly, who's a former top executive of Blackstone, as the chairman of the group, and he was already on the board of directors. Priya Sachdev Kapoor was brought on board as a non-executive director handling corporate social responsibility. She did not have an active role in the day-to-day running of the company, so to say. And that's what Sanjay always wanted. He wanted this to be a professionally run company. And that's exactly what the board is doing. And the people who are now heading the board were appointed by him himself. So do you, in a way, feel that the board was respecting, wouldn't you agree that the board was respecting the wishes of Sanjay Kapoor itself?
I think that's something which is a huge leap of faith and a speculation over here. Mrs. Kapoor does not believe that these were the wishes of her demised son. She believes that something horribly amiss has happened over here. And she believes that it's important to get to the truth of the matter as to what the wishes of the son would be or what the wishes of the mother would be. I think that's best left for time to tell, because there are too many murky circumstances surrounding this. So I wouldn't hazard a guess of what Mr. Mr. Sanjay Kapoor's wish would be. I don't have an insight into his mind now, for sure.
Finally, Mr. Gaggar, my final question to you. What would you be expecting now in the interim? What is the kind of relief that you're seeking from the board as an immediate effect?
I think the last line of the letter is quite clear. She's only requested to defer this by 2 weeks and to be granted access to the documents and information which has been, withheld from her all along, despite her constantly writing to some of the names that you just took right now as well. Hopefully, she would be provided the information and she would be able to make a decision on the way forward.
All right. Thank you very much, Vaibhav Gaggar, for joining us. The AGM of Sona Comstar takes place today at 1 p.m. Let's see what happens over there. Rani Kapoor, the mother of the former chairman of Sona Comstar, who died during a polo match in the UK, has now contested the decisions of the board of Sona Comstar, saying that these are not in good faith and there should be a 2-week hold on whatever decisions have been taken till the time she's able to access all the documents related to the changes that are taking place. With that, it's back to you in the studios.
Okay, Parikshit, thank you so much for that. So this is something important that we'll be keeping an eye out on as well. If this AGM finally actually goes through at 1 p.m, we'll keep an eye out on the details coming in from there as well. And the letter especially that has come in from Rani Kapoor will be key to watch out for. But important updates coming in from Vaibhav Gaggar. On that note, actually, let's just slip into a very short break. We'll be back and we'll be discussing more on market stock-specific action on the other side, and especially on the India-UK FTA. What companies are going to be seeing benefits there? We'll be joined by Pallab Banerjee of Pearl Global, Nitin Panwar of Web of Global, as well as Tausif Mirza of Mirza International joining in with us to discuss all of that. Welcome back to Halftime Report on CNBC TV18. Now we're putting the spotlight on the India-UK FTA that has been, the much-awaited free trade agreement that has been signed. And this has been in works for over 3 years. The deal is estimated to boost the bilateral ties between two nations by $35 billion and bringing down the tariff guardrails to a large extent. Now, to assess this opportunity that actually comes in for most of these sectors, textile, footwear segment, gems and jewelries. These are some of the beneficiaries coming in here. And that is why we have Pallab Banerjee, Managing Director and Group President at Pearl Global Industries, joining in with us, as well as Tausif Mirza, who is the MD at Mirza International, and Nitin Panwar, who is the Group CFO at Weber Global, to talk to us about the benefits we are seeing, the much-awaited deal for most of these sectors that everyone's keeping an eye out on. Mr. Pallab, I'm going to start with you. Let's talk about the benefit that we're talking about that comes in for the textile players. Obviously, previously, the rate was around 8 to 12%, differentiating between ready-made garments as well as home textile. What is the benefit for you that you see coming in? As well as your UK exposure is only 5-6%, I believe, right now. If you could talk to us, where do you see that moving in the next couple of years?
Thank you, first of all, for having me on the show, Vinny. And yes, it's a very exciting time that India is doing this FTAs or the BTAs with various countries. I think this is a good time for India. India was exporting approximately about $1 billion plus of garments to UK. I think that number should significantly go up as we start this. I think it will be starting in the next 6 to 8 months, I believe. This tariff would go away. And we would be at par with other countries like Bangladesh, Cambodia, Vietnam. So they had that. And there's an undue advantage that India was having because the Indian goods were subject to this tariff, whereas the goods coming from the other countries were not. This is, in the short run, definitely we will gain with the kind of raw material that is available in India, that is cotton products and cellulosic products and this kind of thing, like we will definitely scale up. But also it will be a good boost to the industry to invest into the other, category of products, which is not typically made in India, like the synthetics and all, which was the world still depends on the Far East or the Chinese raw materials and all. So that's something also over the long period of time, India will invest more and will have much more infrastructure to do that as well. So overall, we are looking at it very positively. Talking of Pearl Global, we do manufacture out of Bangladesh, Vietnam, Indonesia, India, and Guatemala. So naturally, like we have been taking those advantages from which the other countries had. So now with this thing happening, we had seen a lot of positive traction amongst the customers to do business out of India. So that's getting a boost along with the other countries as well. And a lot of migration is going to happen from China. If you see, like they will still be subject to a tariff of up to 12%.
Right. Nitin, just a two-part question. Let's keep it very simple. As of now, what proportion of your revenue comes in from the UK? If you could give us that number. And what proportion of that is actually manufactured in India? And secondly, was duty the only thing that was stopping us from actually exporting to the UK? I'm sure capacity, quality, a lot of product that they required would be the others as well. So now that it has come down, how long before we stand to benefit from this? Because manufacturing, etc., you said like you have your ecosystem in other countries as well. Will you bring that back to India? How much comes in from the UK and how long before we start to benefit?
Approximately about 4,506 crores. Out of that, about 5% was coming from the UK sales. So that number, we are seeing that, at least the India portion, India was a smaller portion because, as I said, the other markets were more competitive. When the retailer was importing the goods out of, let's say, Bangladesh and Vietnam, they were not paying that duty. Whereas if they are importing the goods from India, they were subject to a 10% or 12% kind of duty or tariff. So that was making it a little more expensive for the customers. So naturally, this tendency was that if something which is only unique in India, let's buy that from India and balance we buy from the other countries. So that particular barrier is now going away. So that's one good thing that is happening. And if you look at specifically pearl numbers that you're asking for, we are expecting that the India portion of that, UK sales that we're doing, that is, we're looking for almost like 2 to 3 times immediate within this next 1.5 year growth, because these customers have been talking to us. They have been planning to shift some of their production into India if this thing happens. So this has been, as you said, like the discussion has been happening for a very long time, almost like 3 years. So we had seen certain traction and preparedness for it. So I think this is the time that we should immediately start getting those benefits. But yes, both the parliaments are still yet to approve it, and then the customs of UK or India will start waiving.
Absolutely. Absolutely, but let's talk about gems and jewelries as well, right? Because that's where some benefit comes in as well. Nitin, bringing you in the conversation as well, there's, a lot more that is happening here. One, what is the benefit that you see for Weber Global? You have a good exposure coming in from UK as well. How do you see that moving? And is there enough actually to meet the additional demand that you all may get in?
Certainly. You are spot on that this agreement will definitely change the dynamics of India-UK trade. India is 12th largest business partner of UK, and specifically gems and jewelry, around almost $1 billion gems and jewelry export from India, is 400 million is jewelry itself, is having a roughly duty of 3 to 5%. And that will definitely change the demand, where Indian craftsmanship of jewelry is really valued by UK consumer. And we see that the removing that and easiness of all the customs and clearance processes will definitely help to boost the demand. We currently export from India roughly around $15 million in UK. And we expect that this will definitely improve in coming years, as the jewelry demand is quite prominent in UK in all across physical retail and online e-commerce markets.
All right, so that's about the gems and jewelry piece. Let's bring in Mr. Mirza as well. Tausif Mirza joins in from Mirza Global. Thanks a lot, Mr. Mirza, for joining in. Have you made any exports to UK earlier, and was duty the only reason why you wouldn't make any exports there?
It's not like that. First of all, thank you very much for inviting me. And this was a most important agreement we've been looking forward to since a very long time. We at Mirza International are exporting more than 400 or 560 crores worth of goods. And out of that, at least 65 to 70% of our exports is to the UK. So I think giving us this duty advantage definitely will be a big boost to the overall industry of especially footwear and leather sector. Because at the moment, the duty rate ranges from 4% to around 14%. And like Mr. Banerjee said, that, so we had the same problem that Cambodia, Vietnam, and Bangladesh and Indonesia were already enjoying the zero duty benefits. And that was the huge disadvantage at times that we were facing. And a lot of these Chinese manufacturers have got set up factories in Cambodia and Myanmar and Vietnam and Bangladesh. So they were using that advantage to their favor by bringing in duty-free imports from their country, from China into Bangladesh, for instance, and then exporting those footwear into UK with zero duty. So that will be a huge boost, I think. And in fact, I would feel that this could be a game changer for us, for the overall footwear industry. I think we have to be very bullish about it. And there's a chance to multiply this business at least 5-fold over in the next maybe 2 to 3 years. At the moment, for example, the Indian exports to the UK is only about $437 million worth of leather products out of total UK imports of $6.7 billion. And I think in the next 2 to 3 years, we should easily be at least target $2 billion worth of exports out of India. So that should come only to the UK alone. And I have a feeling that this has happened in UK, and I really want to thank our Honorable Prime Minister, Mr. Narendra Modi, and our Commerce Minister, Mr. Piyush Goyal. They've done an excellent job for us, and this should bring a big boost to the industry.
I want to just understand 5-fold growth, boost to the industry coming in. How does this help your margins as well? Because now you do not have to, take in that duty that was going on so far. So how will it help your margins going forward? How do you see that moving?
The duty is around 4%, so that should definitely add to the margin. But of course, for adding to the margin, we have to become more efficient, and the factories have to be more efficient. And there are some restrictions on imports coming in for raw materials coming in from China, because this will give us a good entry into a non-leather footwear sector, which is very, very important. And there we are going to have a 12% advantage, because then the duty into UK was 12%. So that gives us opens up a completely new foray into much larger manufacturing of non-leather footwear to be exported to UK, and I think the same should happen soon with Europe. So yes, there's very good times looking ahead. So yes, it should add
Times
to
looking
margins as well.
Tausif, just before we move on to Pallab, for a quick comparison, what is the cost of production in India ex of duty versus all the other countries that we're speaking about? Tausif?
Sorry, what's the question again?
What is the comparable cost of production ex of duties in India versus Cambodia, China and Vietnam? Will duty be the only differentiator?
I think the duty is, no. Yes, I think duty, sorry, I'm so sorry. Duty is the only differentiator, because there is anti-dumping duty on raw material, for example, on PU goods. And there is talk of, through the Council for Leather Exports, we're talking to the government, hopefully trying to mitigate that in some shape or form. So that's a huge disadvantage of bringing in materials, paying anti-dumping duty on raw materials, and a lot of raw materials is 22% duty. So that sort of reflects in the product alone of about minimum difference of around 10%, and then getting rid of this import duty of 4% on leather footwear and about 12% on synthetic footwear into UK. So all that will add up and give a huge boost to the industry. Yes.
Would you say the same of the garment sector, Pallab?
Similar. See, what happens is, if you talk of Bangladesh as a apparel hub or garment manufacturing hub, over the period of this duty advantage for certain countries was existing for quite some time out there. As a result, the ecosystem that got built up, the efficiencies and the ecosystem that got built up in the whole system is slightly ahead of India, I would say, at this point of time. So once this kind of FTAs, like if you see, Indian government is now looking forward to some kind of agreement with US, which is a much larger market, and also with EU, which is the biggest market. So with this kind of approach to the trade and manufacturing, we will see a tremendous change in India over the next, 2 to 5 years. You will see the whole scenario will change if these things are in place. We had these kind of shortcomings. And of course, what Mr. Mirza is saying is that getting that raw material, because a lot of raw material is not made in India. Anything which is synthetic is still not there. Sorry, you're asking something?
No, please continue.
Yeah. So if you see, a lot of this synthetic raw material that China got, the ecosystems got made, they got a lot of these mills and raw material manufacturing happening out there, which is still not happening in India. So if you have to import those raw materials, then we are paying a high duty, or like it has to be done against the advanced license or against the exports. So those kind of norms do exist in this country. I think every country have some kind of norms, but I think the ecosystem that developed in Bangladesh and Cambodia was slightly more easier because of their dependency on this manufacturing of apparel was much higher.
Okay.
So we would see this kind of changes as well. This is, I think, a stepping stone. I think the first step, we have this kind of advantage and built up the whole infrastructure system.
Okay, a stepping stone there. So surely a positive one coming in for textiles, footwear, as well as gems and jewelry. So thank you so much, gentlemen, for joining in with us this afternoon. It was a short conversation, but thank you so much for joining in with us and in giving us insights in terms of what we should be watching out from the industries. But on that note, slipping into a very short break, and as we slip into the break, a small programming note for our viewers as we are slipping here into the break, that as the workplace transforms, so must leadership in the Bengaluru edition of Future Female Forward Season 3. India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29th, 5:30 p.m. onwards, only on CNBC-TV18, CNBC-TV18.com and YouTube.
Welcome back. The market's not doing particularly well, though there has been some recovery from the lows. Let's go across to Nigel, who's standing by at the FNO desk to give us the early trends. Nigel.
Well, that's right, Mangalam. The markets are looking a little bit jittery, and the problem is we're breaking crucial technical levels. The problem is that we are lacking a positive trigger actually to move up. And as we speak, the VIX has popped up close to around 6-7% odd, but it's popping up from bombed out levels. The reason that I say that we're at a very, very crucial juncture is now the Nifty, just till a few minutes ago, was more than 450 points away from the 20-day MA. And if we have an extremely weak close today, then it opens up that journey towards the 200-day MA, which is around the 24,100 odd mark. So that's the important mark that we're talking about. And the key batsman, or the one that's been holding one end up, has been the Nifty Bank. That has broken the 20-day MA, and it's close to around 300 points away from the 50-day MA. And that's the level from where it's bounced. So if the markets need to bounce, we need to hold on to this 24,800, 24,850 odd mark. And that's what the bulls will be hoping for. Now, looking at the PCR, well, that's come down to around 0.73 odd. How has that happened? Because the call writers, they feel they're back in business. Just take a look at the kind of addition you have seen. 25,000 calls suddenly has seen a lot of addition in today's trading session. The premium has crashed by close to around 60%. So out there, the call writers, they are dancing away because the premium is crashing. They are eating to the premium. 24,900 call as well, similar is the case out there. Massive erosion in premium. And after a while, I'm seeing that the lower puts as well are opening up. Look at the 24,600 put. Out there, the premium has moved up by 150%. So at the start of today, it was only around 15, 18 rupees or thereabouts. Now that number has moved to close to around 45 rupees. So those put buyers are now making some money. Stocks that I'm looking at, well, SBI Life, that's one of the few stocks that are seeing fresh buying in today's trading session. So some mild open risk build up is what we're seeing on that one. IEX, yesterday it saw massive open risk build up. The stock got cracked. Today what's happened is there's a big short covering bounce that's playing about. And as I just checked last, the open interest as a percentage of MWPL, that's come down to around 82-83%. If it ends below that 80% odd mark, then the stock will come out of the FNO band. So that's a stock you need to track, particularly towards the end of trade. If there is further shedding in open risk, it will come out of the FNO band, which means fresh positions can be taken in the FNO market. Phoenix Mills, it seems some part of the street was bracing for a weak set of numbers or a negative development, because that one has popped up 6%, and now the shorts are gradually covering out. Two more stocks that I'm looking at, IDFC First Bank, big open risk built up out there. That comes out with its numbers tomorrow. And SAIL, I think the street is sniffing that those numbers will be a little bit disappointing. So the open interest built up is massive on that front. As I said earlier, though, for the Nifty, 24,800 mark has to hold out today. The close above the 24,850 mark is something that we're looking at as well, because if it breaks that level, then it opens up a level towards the 200 EMA, which is a deep 800 points away from current levels. Back to you guys.
Okay, thank you so much for that, Nigel. Keeping an eye out on those important levels over there, 24,800 is an important mark over there. But on that note, slipping into a very short break, a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, a premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interaction with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back. 200 points lower for the Nifty. Let's States industry reporting on production, sales and pricing. In fact, Manisha Gupta caught up with Pradeep Chaudhary, who's the MD of Gemini Edibles and Fats India, began by asking him about the factors behind rising edible oil prices. Listen in.
Edible oil prices should not be seen for a short term, because India has been deficient on edible oils in terms of our requirement for a long time. One of the factors is low prices. Farmers are attracted towards other crops and not sowing oilseed because of the prices. One of the reasons. There are various other reasons. So we should see edible oil prices in the context or perspective of the last 40 years. Then you will realize that today's prices are much lower than other agri prices. So sort of, I beg to differ. And taking a short-term view is not the right approach.
How would you look at the prices moving from here on? The other concern in the market clearly has been that as the duty goes higher, the consumers get the, not the benefit, but that reaction immediately. But when the duty is cut, that isn't passed to consumers fast enough.
Not at all. It's not true. Because we had a meeting with the ministry itself the last time when the duty was reduced. See, what happens typically is that when the duty is about to be reduced or increased, either way, there is a lot of murmur in the market. So mostly, few weeks earlier than the actual change in duties, it is already in the market. So the prices start reacting much before the event. So like this time around when the duties were reduced, 80% of the duty reduction benefit had already been passed on to the consumers. So after the event, the balance 20% was passed on. So the entire, you see, the industry is so competitive with so much of overcapacity, there is no scope of anybody profiteering from any duty changes.
You know, 55 to 60% of dependence on imports, and with so much happening outside, whether it's about geopolitics or tariffs or the protectionism moves that we've seen come in for countries, and then the whole biofuel mandate that the producing countries are getting into, food security for India, especially when it comes to edible oil, do you see that as a concern?
Surely, because dependence, you're saying 55%, my estimate is higher.
Okay. What is your estimate?
My estimate is 2/3 we are importing. That's my own estimate, because if 24 million tons is the consumption, we are importing close to 16 million tons. So about 2/3 we are importing. So definitely it's a cause of concern. And of course, we are producing other things as far as food is concerned. It's only edible oils, which is the main problem. But yes, it is a matter of concern. And you see, worldwide, if you see the producing countries, they are at liberty to jack up their own economies, you know, and use it for biofuels. Why not? I mean, today if you take the case of Indonesia, they are diverting something like 15-16 million tons into biodiesel, almost 1/3 of what they produce. They consume only 10 million tons and they export about 25 million tons. So what happens by diverting 15 million tons to biofuels? They jack up the price of the remaining 25 million tons, which is exported. So they reduce dependence on imports of petroleum and jack up the price of the 25 million tons of the oil which they export. It is economics for them. And every country who produces will try to jack up prices of what they produce. So it has to be expected. So that is why we need to have self-sufficiency, at least to a certain extent. I used to say this 10 years ago.
Still saying it.
At least whatever extra demand each year, at least let us have a target that should be produced domestically. What we are doing is the extra demand also we are importing, which means imports are increasing every year. You stop the imports at this level as a first target.
No, I just had a follow-up question on that. So it is a moving target, as you see. We've been saying the same thing for some years, and we're only importing more and more. So, you know, by the end of, let's say, 2030, are you making any calculations on where we really could be?
See, Manisha, if now the way things are heating up within the government, we heard the secretary today, if India is indeed serious on increasing the domestic edible oilseed production, which is definitely possible. If we can do it in other crops, why not oilseed? You know, issue of GMO, number one. A lot of land reforms required. Getting technology in terms of seeds and giving the right price to the farmer. If we do all the three things together, we are today at 1 metric ton of per hectare in terms of soybean yield versus Brazil at 3 tons. So there is, look at the scope to increase. Look at where mustard, how we can grow in terms of sunflower. When I entered the sunflower business in the year 1991, there was zero imports of sunflower. Today there is zero production of sunflower. We have moved from where to where. So there is definitely a scope. So the figure what will be in 2020 depends a lot on what we do on the domestic front. I wish that on the domestic front we play a beautifully balanced role between consumer and farmer. Try to give that much of incentive to the farmer, I'm not saying not be bothered about the consumer. Sure. It's a very tightrope walk. You got to balance it beautifully. Consumer inflation, please see in the context of 40 years. Don't see it with last year. Because if last year prices were low, this year inflation will be there. But if you see 40 years ago and today, then you will realize inflation is not so much. So that's the point, you know. So otherwise, if you go at the same rate, then India will import over 20 million or 22 million tons by 2030, which is very high.
And the farmer is also a consumer.
And farmer also is a consumer. And if they earn more, it's benefit for the overall. I mean, see the bottom of the pyramid, the world has seen it, US has seen it, Europe has seen it, how much the farmers are supported. They are at the bottom of the pyramid, they are consumers also, and they are the economies of, they are the real growth in the economy and come from there.
With all this as a background, I'll wind this down with one final question on price sense. Do you see prices consolidating as we go ahead, or with the way the moves are, uncertainties in the international markets as well, are we looking at higher highs?
I am definitely bullish right now on prices for various factors. One of them is the biofuels. And if this US biofuels policy does actually take shape in January 26, because it is already there, but you know, because of Mr. Trump, uncertainties, a lot of people are saying they are not believing in it, but it's a reality, it's already a law, it's been passed. If that happens, you will see very, very high prices.
Equities see broad-based selling with declining stocks far outnumbering the advancing. Industrials and utilities are the big drags while healthcare shows relative strength.
IEX CEO Rohit Bajaj tells CNBC-TV18 that the impact of coupling in the day-ahead market will be lesser than earlier expected as its share of revenue has dipped. He concedes that the charges may decline but will not see a big drop given the low traded volumes in India.
Bajaj Finance points to growth challenges as stress continues to persist in the MSME segment as well as in 2- and 3-wheelers. And though the lender sees normalization in H2 and retains its credit cost guidance, analysts fear a negative revision. The stock slips in trade.
The India-UK Free Trade Agreement is set to spark big changes for the industry with 99% of Indian exports set to attract zero duty and average tariffs on imports from UK dropping to 3% from 15%. Sectors like auto, textiles, engineering, leather, alcobev and jewellery could see an impact.
Sona BLW finds itself in the midst of a family rift with the founder's wife questioning the freak death of her son and suspecting a move to wrest control from her as the family heir. She's called for deferring the AGM by 2 weeks to allow her to gather more information on the matter.
Good afternoon, you're watching Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Fatakia. With me is Vamakshi Thoria. Vamakshi, good afternoon. Counting down to the end of what has been, well, another forgettable trading week, if you could say that, for the bulls. But they're fighting to defend some key levels as of now.
Well, absolutely, Hormus. You know, it's 200-point downtick as far as the Nifty is concerned. The mid-cap end of the market is taking a sharper knock in today's trading session. For now, the mid-cap index is trading with a cut of almost close to 1.4%. And this sort of reflects in what is happening in the advanced decline ratio as well, with the declining stocks far outnumbering the stocks that are advancing in trade. And a lot of these moves, actually big moves, are coming on the back of earnings. They continue to dominate the headlines apart from some of the global as well as macroeconomic cues. Take a look at Tatva Chintan. That stock is up almost 16% in today's trading session. IEX, of course, is seeing a very sharp recovery after seeing a very sharp fall in the trading session yesterday. Apart from that, on the flip side, take a look at Hexaware. That stock has taken a knock of almost 8%. KFin2 down almost 6% in trade today. But Hormas, the picture for now looks grim. Most sectors declining. Is there any movie dialogue you remember on account of this?
Well, it's a Friday. The only thing that comes to mind is हार के जीतने वाले को बाजीगर कहते हैं. But if the bulls do manage to defend 24,850 on a closing basis, they would surely like to believe so. As of now, well, the index continues to hover around that 24,850 mark for sure. A 200-point cut. If numbers of Intellect Design Arena flashing at the bottom of your screen. Numbers coming in thick and fast. We just had numbers from Bajaj Finserv a few minutes earlier. Numbers from HFCL also flashing at the bottom of your screen. It's a net loss compared to a net profit from last year. So that is HFCL for you. And we'll start off with all of these broader market results now. Awaiting results from Cipla, from Bank of Baroda, from Laurus Labs more particularly, because that stock has moved almost 25% in the last 1 month, is at a 52-week high in anticipation of a strong quarter from the street. And Laurus Labs, there you can see it's still 1% lower near the lowest point of the day. But of course, you can see the 25% in a month. So you keep track of all of these results. But of course, it was IEX. It was the stock of yesterday's trade after that 30% fall. It's seen a recovery in today's session. Still, of course, mind you, it continues to remain in the FNO ban though. And let's listen in to excerpts from our exclusive conversation with the management that we had earlier in the day.
So a bit early days to comment on that, but let me quickly try to rephrase what is there in the order. So CRC issued order for implementing of market coupling for day-ahead market on 23rd July, day before yesterday. And it talks about initiating the process of market coupling for day-ahead market. There are a few more elements in this order where they said that due to shorter time frame available for bid submission in real-time market, and also because of other operational complexities, coupling of real-time market will be considered at a later stage. So yes, there is going to be some impact on our business for sure. But if we see the whole thing, In the recent time, we have seen day-ahead market is not everything for us. There was a time when day-ahead market contribution in our total volume was 80-85%. But today, this number has come down to less than 35%. We would try to maintain where we are. But yes, if the competition is going to be there, definitely there could be some drop. Very difficult to put number to it. Very difficult to quantify this at this point in time. Single entity who is participant in the market, they cannot hold more than 5%. Otherwise, the window is 25%. If there is competition, there could be possible reduction. So I'm not saying that it cannot be reduced. It will take its own course.
Well, that was the management of IEX, and let's move on and focus in on Hexaware. That stock is down and out in trade, reacting to its Q2 calendar year 25 earnings, which have been below what the street was expecting. Their revenue growth was below expectations, and higher other expenses have impacted their margin. Earlier on, we spoke to R. Sri Krishna, Chief Executive Officer of Hexaware Technologies, for more on the quarter gone by. Let's listen in.
It is completely macro and cyclical. The best proof point for it is if you look at our different verticals and the growth rates of the verticals. Headline is travel 23%, financial services 16% Y&Y growth. There's one sector that is materially pulling us down. That is manufacturing and consumer, negative 11.5% Y&Y growth. That's all macros. That's all the uncertainty due to tariffs. Growth will be a little bit better in Q3, definitely, than Q2. But we've said that our growth expectation for the full year is somewhat lower now than what it was a quarter ago. We will still grow nicely in Q3. It's not going to be like an outstanding quarter that it often is in Q3 for us, but we will still grow nicely.
On to the latest with Sona BLW. Rani Kapoor, the mother of the late Sanjay Kapoor, has written to the board of Sona Comstar seeking deferment of the AGM that was scheduled for today. Now, she alleges coercion, misuse of documents and attempts to usurp the family legacy after the death of her son. Parikshit is joining in with more on this. Parikshit, what are the latest developments here? What is in that letter that Rani Kapoor has written to the board of Sona Comstar?
Well, Rani Kapoor, the mother of the late chairman of Sona Comstar, Sanjay Kapoor, has raised questions about the manner in which people were appointed to the board of directors at a time when she was mourning and not fully in control of how things were happening. She is alleging that signatures were taken from her on pieces of paper which she was not fully aware about, did not fully understand as she was grieving at that point. She's asking for the deferment of the annual general meeting, which has to ratify the appointment of Priya Sachdev Kapoor as a non-executive director on the board of directors of Sona Comstar, and also James Overley as chairman. She's saying that she wants to get her hands on all the letters, all the documentation to understand why these people have been appointed to these positions. So she is contesting this, and she is saying that in case this AGM is not deferred, and the AGM goes ahead and takes decisions to ratify these appointments of Priya Sachdev Kapoor, then she will have no choice but to take legal action. We spoke to her lawyer, who said that she doesn't have any access to any will, which says that she has to decide the successor or why Priya Sachdev Kapoor has been appointed. But we've gone through the documents of the company. The shareholding pattern suggests that almost 72% of the company is, of course, owned by public shareholders. 28% is held by Aureus Investments. Now, Aureus Investments is the promoter entity of the Sona Comstar Group. And Sanjay Kapoor was the director or was the head of this entity, Aureus Investments. You always had Priya Sachdev Kapoor as one of the directors, as one of the officials on Aureus Investments. She was on the board of directors of this entity. And the ownership pattern and the directorship pattern of Aureus Investments also shows that she has to be the director in the absence of Sanjay Kapoor. Now, the board has actually taken a decision to appoint her because she was heading the promoter entity Aureus Investments. Rani Kapoor, so to say, has about 79 shares in Sona Comstar altogether. So, legally speaking, currently, she doesn't seem to have a stake in the company until unless she has some sort of will or documentation to prove that she has to decide who Sanjay's successor has to be. But we must tell our viewers that Priya Sachdev Kapoor has been appointed as a non-executive director, someone who will be a part of the Corporate Social Responsibility Committee. She does not have a day-to-day role in the running of the company. Even Sanjay Kapoor was a non-executive chairman. He did not have a day-to-day role in the running of the company. It is currently headed by Vivek Vikram Singh, who is a CEO. The chairman of the board is James Overley, who was also on the board earlier and has now been appointed as the chairman. Today's AGM is very crucial, and we can tell our viewers that this AGM has gone ahead according to plan. Priya Sachdev Kapoor, her appointment today has to be ratified by the board. Let's see what happens over the next half an hour or so, whether there will be any response or address to the letter that Rani Kapoor has written. That remains to be seen, but any decision on that will be taken by the company because the letter has been addressed to the company, not to Priya Sachdev Kapoor directly. Priya Sachdev Kapoor, we believe, is also attending this AGM, which began at 1 p.m. in the afternoon.
Well, thanks so much for that update, Parikshit. We'll keep coming back to you for more on this as the story unfolds. But let's also listen in to what senior advocate Vaibhav Gagar, who is Rani Kapoor's counsel, had to say about these allegations. Listen in.
So Mrs. Rani Kapoor was the sole beneficiary as far as the will of Mr. Surinder Kapoor, late Shri Surinder Kapoor, is concerned, which was a registered will. You're aware that she's written a letter to the shareholders and the board of directors. She has put down on paper quite explicitly how things have transpired, how there are, serious apprehensions as far as she's concerned in terms of the circumstances leading to the death, what has unfolded immediately post that. As written in the letter as well, lots of suspicious circumstances have unfolded and are coming to light now. How various appointments were made, what the role of certain individuals that you have named in just right now, how did they come into being where they are, what were the documents which were signed, what was the manner in which they were brought about. All of these are matters which have to be looked into very carefully.
Well, that was the update we have so far on the matters going on in Sona BLW. The stock has taken a knock in today's trading session, down almost 2.7%. But let's slip into a short break. But as we do that, now it's time to recognize the champions. Get ready for an evening that honors India's most promising SMEs, the champions behind our nation's remarkable progress. From groundbreaking innovation to grassroots impact, these businesses have powered growth, inspired change, and redefined ambition. HSBC presents CNBC-TV18 SME Champion Awards Season 2. India's most coveted SME Awards platform is all set to finally announce the winners later today, 3 p.m. onwards.
Welcome back. Now, the much-awaited India-UK Free Trade Agreement has been signed. It has been in the works for over 3 years, with talks starting in January of 2022. And since then, the UK has seen a change of 4 Prime Ministers. Now, Prime Minister Narendra Modi said that there may be a swing and a miss, but India will always play with a straight bat. Keir Starmer, the British PM, also said that the deal will create over 2,000 British jobs. Commerce ministers of both nations signed the agreement earlier today, and the deal is estimated to boost bilateral ties between the two nations by $35 billion and bring down the tariff guardrails to a large extent.
We in fact spoke to corporate India Hong Kong's Sunil Bharti Mittal and Anish Shah to understand what the deal with United Kingdom means for Indian companies and which sectors are likely to benefit. Let's listen in to that conversation.
Be a very special, advantage for India to get access to technologies for its own needs, own markets, but more importantly, exporting across the world. I personally feel the bigger advantage will come from UK companies investing in India and creating bases in India, which will be high talent pool that they can access, low manufacturing cost, and make the world their market, which I can tell you, having now worked in UK for several years, is hard for UK companies to come to those levels of competitiveness that India can offer them.
All I would say is that it has been done in a manner that really strengthens the auto industry in India and is a win for both countries. That actually put the question the other way around. Is the UK car industry ready for the challenge that we will pose to them by sending cars from India?
The corporate India heads after the India-UK agreement, but Cipla's numbers flashing at the bottom of your screen. The net profit of 6,957 crore. It was compared to a CNBC-TV18 poll estimate of 7,106. So marginally below expectations. The EBITDA turns out to be slightly better than what the street was expecting at 1,778. There was a 1,714 crore estimate that the CNBC-TV18 poll was anticipating. It will be interesting to see what kind of number the US sales have managed to deliver this time around. The stock, though, has seen a spike towards the highs of the day, and that's Cipla. For you, one of the 3 Nifty companies reporting results today, and margins, 21.6% on the margins front, and that is significantly lower compared to what the poll was anticipating. The poll anticipated levels of around 24%. So a margin miss that has come in on the operational front. The EBITDA is slightly better. Will be interesting to see what kind of number does the US sales figure throw up. We are still awaiting the investor presentation, but prima facie, the EBITDA is marginally better than expectations. The revenues are slightly below. The net profit is slightly below expectations, and of course the margins is what is turning out to be a big miss, Vamakshi. So we are awaiting the investor presentation from Cipla, but from what I can see is that there has been a significant rise in the total expenses of the company, and of course that too may have weighed
actually the margins have come in at 25.56%. It's actually better than what the street was anticipating, and overall, the numbers will again flash for you on the screen. The EBITDA has also come in slightly higher as compared to the poll. There you go. The margin is at 25.6% as compared to our own poll of 24.1%. So, it's relatively better as far as the street expectations were concerned, and thereby you're seeing a spike in the stock as well.
The highest point of the day is Cipla. We'll get more details on this as the investor presentation comes in as well. But for now, it looks like an operational beat for Cipla in the first quarter. Now, Commerce Minister Piyush Goyal, in an interview with CNBC, briefly touched upon where India and the US trade talks lie. Listen to what he had to say.
I think it's a wonderful relationship that the United States and India share, a very special relationship. And I'm very confident we'll do a robust and good deal where both countries benefit and where businesses on both sides are happy. India will get a preferential tariff compared to our peers and our competitors because we were amongst the first to get into negotiations, and our discussions, our engagement is truly very, very significant.
Well, the US President Donald Trump arrived at Federal Reserve, which is the first visit by a sitting president in roughly 2 decades, to tour the site of a $2.5 billion renovation of 2 historical buildings that the White House has been criticizing. At the venue, Trump and the Fed chair had a disagreement over the renovation costs. Let's listen in.
So we're taking a look, and it looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out. I don't know who does that.
You're including the Martin renovation. You just added.
That's our entire capital.
Yeah, you just added in a third building. Is what that is. That's a third building.
Well,
including
no,
the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to take a look. We're going to see what's happening, and it's got a long way. Do you expect any more additional cost overruns?
Don't expect them. We're ready for them, but we have a little bit of a reserve that we may use, but no, we don't. We expect to be finished in 2027.
Donald Trump and Jerome Powell, the viral moment of the day. Take a short break. For now, more news and updates on the other side. Stay tuned.
Welcome back. You're watching Business Lunch on CNBC-TV18. Well, a couple of earnings have just come in. Cipla, of course, we mentioned, is beat as far as the margins are concerned. The stock is 2.5% higher. Very sharp spike seen out there. But apart from that, take a look at Solara Active Pharma Sciences. The company reported its numbers just a short while ago. Margins have improved here from 11.5% to almost 17.8%. Solara Active Pharma is the stock that I'm talking about. It'll come up for you on the screen for now. It's a very sharp spike here. The stock is up almost 7.5%. In fact, earlier on, when the when the results had just come in, the stock has surged to a day's high of almost 11%. Apart from that, take a look at Sharda Crop as well. The company reported its numbers just at the beginning of this show. The stock continues to trade with a gain of almost 8%. Now, let me just point out a few other stocks as well. Many stocks in an otherwise weak market have managed to hit a 52-week high. One such stock is eClerx Services. That stock is trading higher by almost 2%. But that's all we have on this edition of Business Lunch. We're leaving you with the Nifty with a 200-point cut. Mid-cap radar will now come up next to take the action forward. Stay tuned.
Good afternoon. Welcome to Mid-Cap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. We are ending the Friday or closer to ending the week on a negative note. It is a 210-point cut that we are looking at the Nifty. There was a wee bit of a recovery, but that again seems to be getting sold into across the board. There is a big pressure that is coming by. Nifty Pharma is the only one which is in the green right now. We of course have Cipla's US sales number which has come by, which is higher than what the CNBC-TV18 poll was suggesting as well, between $218 to $221 million. The stock is spiked to the day's high. We'll of course get Winnie in just a bit to decode those numbers for us as well. But while we talk about mid-caps which are taking a bigger hit, overall, a lot of stocks which are reacting to positive earnings. Be it Sharda Cropchem just reported numbers, Tattvachintan Pharma up 16% after numbers reported yesterday. We do have a lot of these names in the pharma space which are doing well as well. So a lot to talk about.
That's right. Good afternoon, Sonal. Quite a lot lined up on the show. In fact, Hormuz has neatly compiled a whole host of list of stocks, the broader end of the market that are making all the moves. Hormuz, I'm assuming most of them are dominated by results impact.
Oh, yes, they are. And that has been the case, right? Good earnings are getting rewarded, but the bad earnings are getting really, really punished. And we start off with the result. Look at the negative reactions there. Intellect Design Arena just reported results, 6% lower here. HFCL as well, a loss compared to a profit last year. So 4% lower on that stock. UTI AMC and KFinTech, both numbers came out yesterday. They too are seeing knocks in today's session of up to 5.5% each. Positive earnings reactions, though, you mentioned Tattvachintan Pharma, 16% higher still. Phoenix Mills, after the upgrade that came in from HSBC, both Anant Raj and E-Clerks are off the highs of the day, but Solara just reported numbers that has seen a very sharp spike in today's session after the results. The newsmakers dominated, of course, by IEX. Of course, the reversal that we have seen after the pummeling that it took yesterday. Sona BLW is at the lows of the day, as is APL Apollo Tubes after cutting its volume growth guidance for the full year. Stocks that are doing well and not so well on the volumes front. Trident is an earnings reaction. Metro Brands, of course, a beneficiary of the India-UK FTA, and Ajmera Realty too, 4.5% higher after strong numbers yesterday and doing well on strong volumes. And lastly, he spoke about pharma names. They continue to do well. It's Syngene at the highs of the day, Torrent Pharma at the highs of the day, and Mankind Pharma too ahead of results, reaching towards the day's highest point. Back to you guys.
Well, thank you so much for that, Hormuz, for joining us and taking us through all of the stocks that are moving around in the session. Well, a couple of stocks, have a look at APL Apollo Tubes. That particular stock came out with its results closer to market close last evening. A guidance cut over there, and APL Apollo Tubes now trending near the day's lowest point. But with that, we'll slip into a short break. We'll get you more on the markets and corporate conversations on the other side.
Welcome back. You're still tuned into Mid-Cap Radar. KFin Technologies reported a weak set of Q1 number. Revenue has dipped for the second straight quarter. Margins also are under pressure. We are joined by Srikanth Nadella, who is the MD and CEO at KFin Technologies, joining us now. Srikanth, good afternoon. Thank you so much for joining in. But it's the second consecutive quarter of revenue fall that we've seen. It's driven by issuer solutions, international and other investor solutions. The domestic MF business has grown 3% sequentially. What is the outlook going ahead? Do you maintain your guidance that you had shared earlier, 18 to 20% growth in FY26?
Thank you so very much, and good afternoon to one and all. Our line of business always tracks to year-on-year growth and not so much on quarter-on-quarter growth. It's financial services. Typically, in our line of business, Q2, Q3, Q4, are always far more aggressive in terms of the growth as compared to the Q1. So we have seen a good growth in the context of some headwinds that we have seen overall in the markets in the month of April. Markets have picked up subsequently. But an overall revenue growth, over 15.5% and a PAT growth of over 13.5%. August, basically is an indication of a good season ahead of us. If you look at FY25 and FY24 too, the trend is pretty similar, which is basically a Q1 start with a PAT margin of close to about 30%, EBITDA about 41 to 42%, which eventually means it will probably end up anywhere around 43 to 45%, which is pretty much in the line of the guidance that we have.
So you're sticking to your guidance, all of the guidance, earlier revenue guidance you had given in the range of 18 to 20%. The other question is, we want to understand from you, as far as the mutual fund revenue yield is concerned, it's actually dipped on a sequential as well as on a year-on-year basis. What is the reason for that, and can it move up sequentially?
Very good afternoon, Venkatesh. So yes, mutual fund basis yield is a factor of the growth, that has, been witnessed in the industry. If you would recollect the previous year that had gone by, the overall industry had grown up north of 32, 33%. And in line with that growth has been the market intermediary participation entities such as ourselves, we too have grown. What we always look at is a moderated and an average growth over a series of years and not just an individual year, which tends to gravitate towards near about 20% growth. So if we have seen a 30 plus, 32% plus growth previous year, I think it is only reasonable that, a year or so you might see a near about 20%, not a exuberant 30% plus every single year. The basis point yield, is a factor of the telescopic pricing, which is akin to that of any business. Higher the volumes, there is a certain amount of discount that the manufacturer or the outsourcing entity tends to provide and pass back. And we are always very mindful of helping our clients to grow faster than the industry. And it is in that regard that giving any amount of discounts is in terms of improving their market position, which will help us to grow eventually in which way.
Okay, all right. So the growth coming in is on a higher base, and that's why it looks lower in comparison to the older years as well. You're awaiting regulatory approvals which have to come by for integration with Ascent Fund Services. When is this likely? What will the impact on P&L be once this approval actually comes by?
About 5 weeks back, we have completed the transaction with Ascent Fund Services. It's a near $150 million transaction to be completed over a 5-year period. We have acquired majority stake. We have already secured all the regulatory approvals in India, which is effectively SEBI, PFRDA, and the RBI. Whilst we have 3 regulators here, given Ascent Fund Services is a global company which has presence in 18 different countries, there are far more number of regulators. The approvals are yet to come from. So in that context, I think we are waiting about 3 different countries, mostly in the Middle East. We expect anything in the next 4 to 6 weeks, those approvals to come through. Once that is done, the integration will be completed. From the standpoint of impact on the P&L, the organization is a young organization growing at nearly about 35% year on year on the top line growth. Annualized revenue addition would be roughly about $20 million plus. That is what we would expect to integrate depending upon which month the integration gets completed.
Okay, going forward, will higher growth come in at the expense of more margin pressure? And number 2, what we want to know is that what is the kind of market share that you intend to maintain, given the fact that the growth has been quite strong, especially outside India as well?
So we look at market share, differently from different business lines, right? I mean, so mutual funds is one of our larger business, which gives me about roughly 60% of the market share. Post-integration, it will be down, to close to 50%. International business would have then accommodated to be roughly about 25%. Issuer solutions, which is dominantly looking into IPO market and the secondary, market solutioning and services, is about 15%. The remaining is all alternatives, pensions, private retirement schemes, what have you. Our position has been either number one or number two in every one of these business lines. We obviously intend to become the number one in the business lines, where we are number two at this point in time. So broadly, we are objectively looking to create the first large global fund administrator based out of India. That's our vision. And that's a 5-year, vision. And I think the acquisition that we have done and our own organic expansion into 5 different countries, into Malaysia, Philippines, Hong Kong, and Singapore, and Thailand, paves way, and provides us the right kind of tailwind that is required for us to achieve that particular goal. Market share, as I said, depending upon which country you move into, we'll have the market share there.
Got that point. Thank you so much for joining in today with the outlook going forward and the details on different aspects of business as well. That's Kefen for you. We'll address Shriram Finance's numbers in just a bit, but let's talk about SBI Life because that reported an inline set of earnings with its APE growing and VNB margin 2 expanding 70 basis points. Our colleague Yash caught up with Amit Jingran, who is the MD and CEO of the company, and began by asking him about premiums in FY26, growth outlook, and the guidance or expectations from APE growth and VNB margin. Listen in.
If you look at our past discussions, whatever we set for the year, healthy growth with healthy margin numbers. I am happy that in the first quarter we have been able to stick to our guidance, and our top line as well as our margins have gone in line with our goals that we set at the start of the financial year. We want a growth which is optimum for everybody. We want an optimum mix of top line and bottom line, and that is what we have been driving through the quarter. Our aim was to have a healthy product mix where ULIPs and non-ULIPs product both are provided to the customer in an optimum way. And during the first quarter, we have been able to drive that kind of product mix with the help of the products that we launched in the last quarter of last financial year and some products in third quarter also, both in non-participating product, participating product, and protection products also. So these products have contributed a lot for a healthier product mix, and that had resulted in substantial improvement in our VONB margin also.
Now, if I speak about the numbers, APE for FY25, the previous financial year, was about 9%. The VNB was 7%. When you say healthy growth will continue in FY26 as well, what is the growth that you anticipate?
So during the quarter, we have given a growth in VONB, which is in line with our growth in the top line.
Correct.
And that is what we are looking for the current financial year also. We had projected APE growth in the mid-teens, 13 to 14%. And though the first quarter was a little lower, but that was on a very strong base of the first quarter of last financial year. So I am sure that for the full year, we will stick to our budgeted goal of mid-teens, 13 to 14% growth.
Okay, that is APE, and VNB would be around how much then in that case?
Around the same level.
Around the same levels. Now let me speak to you a little about the product mix. ULIP share, that in the first quarter on a year-on-year basis came down by about 400 basis points when compared. Do you expect ULIP share to pick up in the second quarter and then in H2 as well? And, do you think FY26 will be a year where ULIP again picks up, and could that put some pressure on the margins?
Our product concentration and new product launches are more focused on the non-participating, participating and protection products. In next month, August first half, we are coming out with participating product. on the money back lines. And we are also introducing a new product in the mid-range of the protection, that is from 50 lakhs to 2 crore, where the pricing is very competitive and has very good features for the customer. So our aim in the company is to provide a full bouquet of products for the customer. The focus on these non-traditional traditional products, non-ULIP products, has brought down the contribution of ULIP in the first quarter by 400 basis points. This has largely been driven in our agency channel, where the ULIP contribution is now below 60%. There has been improvement in the banca channel also, and where we want to further improve the sales of non-traditional product. So this focus on the product mix will ensure that we stick to our margin range.
Could, when you say 26 to 28%, could it be closer to 26 or could it be closer to 28?
It is very difficult to put your finger on any one particular number, because there are seasonal variations also in the sales. So we will be broadly sticking to our guidance of 26 to 28%.
Okay. As far as, what has worked for you in terms of margins also is attaching a lot of riders into products which don't naturally give higher margins. Could that process continue in FY26? And tell us something about the whole process in FY26. How much riders, what is the size of it that you look to do?
So we introduced riders for almost all the products. For ULIPs, it came in the last quarter, I mean the first quarter of this financial year. For other products, it was attached from third quarter and fourth quarter respectively. We are happy to inform that for the first quarter, the rider attachment is 35% approximately across products, and these are now available for ULIPs and non-traditional traditional products also. So going forward, we are aiming for improvement of this 35% to above 50%, and that is providing a good leg up in the margins also.
Okay. One question as far as, you spoke about the margin band between 26 to 28%. What is the impact of surrender value that you are accounting for when it comes to this number of 26 to 28% in FY26?
Our company has been maintaining that surrender value norms, the new surrender value norms, are not going to have major impact on SBI Life's performance. And you have seen that the product pricing, etc., for the new products that were launched post implementation of these guidelines were also not majorly different. So we stick to the statement that we have made, that we were already providing better surrender values in our policies, and therefore there is no major difference in the margins.
One question as far as bank assurance is concerned. All the worries which emerged at one point of time with statements coming in from the finance minister, from the regulator, reports suggesting that the regulator was looking to put restrictions also on bank assurance. With your conversations after that, are all those worries around bank assurance channel now behind you?
We have been maintaining that the regulator's approach has always been very consultative kind of approach, and we had not formally heard from regulators anything about any restrictions on the banca channel. There were some concerns being reported about mis-selling, especially in the banca channel. Here we are happy to say that the mis-selling ratio for SBI Life is at 0.023%, which is one of the lowest in the industry and almost 1/10 of our nearest competitor. That is because for SBI Life, customer centricity is one of the objectives. We always take very good care of our customers, and we provide solutions as per their needs, as are suitable to their financial goals. So that was the reason that company has been seeing a consistent growth in the banca channel also in last financial year, despite all the murmurs about mis-selling or restrictions.
Well, some very encouraging commentary coming in there from SBI Life, especially doing very well as far as the VNB margin front was concerned. The stock near the day's highest point. Well, even as that particular conversation was being transmitted, you had two important results come about. The first one was Shriram Finance. Remember, this particular stock opened the day on a very negative note, taking a negative read-through from Bajaj Finance results, but post the results largely in line with the CNBC-TV18 poll, that particular stock has rebounded quite sharply off the day's lows. And the other stock, that has just gone ahead and reported its numbers is Chennai Petro. It appears there is a loss as far as the bottom line is concerned. That particular stock has seen a sharp fall in the last 5 minutes to the day's lowest point. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello and welcome to Your Stocks live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and this is the show where we answer all your individual stock queries and talk about it both from the technical and the fundamental level as well. For the Nifty, let's first talk about that. There's been some recovery from the lows, but still for the majority part of the day, we've seen that massive cuts come by. 187 point gone on the Nifty currently, and we did have important results which just came by from the Nifty pack. Cipla, which was better than what the street was working with, led by their US sales, which was higher than estimates. So Cipla is a stock which is doing well. In fact, the entire pharma pack has been doing well since morning, but Cipla just aided the gains that we've been seeing right now. Shriram Finance, on the other hand, didn't do so well. So Shriram Finance, after taking cue from Bajaj Finance, the numbers have been lower than what the street was working with. So that stock, after seeing that spike, has come off and is down now around 1.5%. From the broader markets, we have Chennai Petro also, which just reported numbers. It's a massive cut that has come by. It's a loss this time around of 80 crores versus a profit of 469 crore rupees. GRMs have halved on a YY basis to come in at $3.2 per barrel. Similar was the story for MRPL as well. So that stock should come up for you on the screen because MRPL fell the day it reported numbers. But from those levels, it saw a massive recovery come by. But now, even MRPL has seen that fall. Also, courtesy markets, which have been seeing a big red through the course of the day. Mid caps have not been doing well, but yes, for Chennai Petro, on the back of these numbers, the stock is seeing a cut of around 7.5%. This is about markets, individual names. Let's talk about your queries now. Joining us today to answer those queries is Shaina Mukdam, independent market expert, and Vaishali Parekh of Prabhudas Leeladhar. They'll be answering all your stock queries. Ladies, good afternoon. Thank you so much for joining in. Let's get started then. Amrit is writing to us from Mumbai. He holds 500 shares of IndusInd Bank at 1,500 rupees a share. Asks whether he should worry about his investment after the recent accounting fraud in the bank. Shaina, let me come to you first up, and then Vaishali, I'll take this question to you.
Well, I would suggest that he switches from IndusInd Bank. If the stock could consolidate at current levels, there are too many ifs, buts. I think ICICI Bank, which has reported very good numbers in the Q1, that could be a good switch. You're seeing margins improve. You're seeing a decent growth in terms of the overall loan book. Even HDFC Bank, which will go ex-bonus sometime over the next quarter, I think that also offers a good investment opportunity over IndusInd Bank. So I would suggest a switch.
Okay, you suggest a switch, considering also how HDFC Bank reported numbers, ICICI Bank, good numbers. But do remember, IndusInd Bank also comes out with its numbers on Monday. Vaishali, your take? How is this stock looking when it comes to charts?
So technically, I think IndusInd is very well placed, but well, it's always disappointing us. So I would say let's shift into a stock which has got a lot of clarity. And of course, ICICI is a no-brainer. And along with that, even SBI would not be a bad idea at this level. But IndusInd is going to take its time. So I would say switch.
Okay, so the technical and fundamental advice is to switch from IndusInd Bank into other larger banks, the likes of HDFC Bank or ICICI Bank as well. Let's move across to the next one. Sai Prakash is writing to us from Hyderabad. He holds 530 shares of Reliance Industries at 1,560 rupees a share. He is a long-term investor and wants to know whether to hold or sell at current levels. Vaishali, your take? The stock saw a sharp fall post-results, down 5% or 6% since then. It's a heavyweight as well on the Nifty. But is that selling done now? What are the technical levels suggesting?
So, well, we are just seeing some profit booking coming in almost all these frontline stocks. So it's very hard to tell whether we are going to bottom out as far as Reliance is concerned. We could see further more downside coming to 1350. But the long-term trend is pretty much intact. So I don't think if it's a long-term perspective that one needs to worry. I'd rather say you add more in depth.
Okay, add more at current levels is the technical advice coming in. Before we go to Shaina, let's just quickly take a look at which stocks from the Nifty pack are touching day's low. We have Infosys, which is lower. HCL Tech is the other one. Tech Mahindra too is at the lows of the day. So some of these IT names are putting some pressure on the Nifty currently from these levels. On the flip side, we do have, not on the flip side actually, going the same way, we have Trent, HUL and Nestle India, which are at the day's low currently. So these are some names which are batting for the bears right now, all these stocks at the day's low. Let's go across to Shaina and ask her about Reliance Industries. Since Sai Prakash has a long-term view on the stock, what's your take?
I would say Reliance Industries, you should keep adding at every dip. While the first quarter numbers were disappointing in terms of the OTC business, O2C business, I think if you take even for that segment, if you take a little longer term, take a 2 to 3 year view, the opportunity for growth is very good. There are plants for energy. They're putting up electricity, the renewable energy plants of 20 gigawatt. That will come in stream over the next 2 to 3 years, which will substantially add to the revenues and profitability of that segment. Of course, Jio remains, a very strong part of the overall business. For the first quarter, we saw 208 rupees ARPU, but I believe a 10% increase year over year is absolutely possible. There is a potential also for value add once the Jio business is listed. Retail itself is doing better in terms of margins. Valuations not expensive. It's just about 12 times EV by EBITDA over the next year. So I would say that you keep adding Reliance and build it into your long-term portfolio.
Okay. So Reliance is a part of your long-term portfolio, and oil to chemicals was also impacted this time because of the maintenance shutdown that had happened. So that is something that took away some of the throughput growth as well. But let's go ahead and talk about the other name. Sudhir is writing to us from New Delhi, who has 37 shares in GMM Pfaudler. He also is a long-term investor and asks if he can buy more shares from these levels. Vaishali, let me come to you. What are the charts suggesting for this one? This is usually for a long-term investment when people look at this particular stock. But if we look from a technical level?
I would say definitely this is an attractive level to get into the stock because it is already, after seeing good corrective move, it has got into a trend and it is currently at a good support level of a 50-day moving average. So I would say, yes, continue buying. Even if it drops to 1250, I don't think there is any cause of concern. One should add at every level because now that we are seeing the reversal, this stock can go towards 1500 or so.
Okay, towards 1500. And fundamentally, Shaina, how do you look at GMM Pfaudler? The selling from promoter has been done. What are the fundamentals to watch out for when it comes to GMM Pfaudler?
See, the valuations are extremely expensive. So even, of course, the fourth quarter numbers were disappointing. Q1, we will have to see when they come out with their numbers. There was some one-time write-off that they took in the fourth quarter last year. See, having said this, I think in terms of valuation, if you look at it, EV by EBITDA, it is 20 times FY27. Even, if it shows a decent growth in the current year and next year. So I would say you can keep a stop loss, you can hold because they do have, leading market share both in US, in Europe. They have got a new order of about 350 crores in the last, I think in June they got it. So that will support growth in the current year. But I would say keep a strong stop loss because it is a very expensive story, even at current levels, though the stock has come off a bit from its highs.
All right, take that point. So expensive valuations for GMM Pfaudler at current levels, but technically it is a good price to buy it for a short term. Let's talk about the next query that we have. Karan is writing to us from Bengaluru with an investment query. He wants to invest 10 lakh rupees, asks which hospital stock can he invest in at current levels. Very interesting question because it has a specific amount that the investor wants to invest in a very specific sector as well. Vaishali, let me come to you first up.
So I would say, of course, Apollo Hospital being the frontline stock and technically also very well placed. So I would say not to put in all just right now. Start accumulating because 7,000 is a very crucial support. And what I see, the projections that coming from here on are 8,000 plus. So I would say keep 7,000 as a support and keep accumulating at every tranche. And besides this, then there is KIMS. That is another stock which looks technically quite attractive. Fortis has already done its move. So Krishna Institute of Medical Science, that is. I think this stock also has got scope for further upside. This can be accumulated with 700 as support.
Okay, take that point. What about you, Shaina? Any fundamentally strong hospital stock where he can invest 10 lakh rupees?
Yeah, I would go with Vaishali and Apollo Hospitals. There the beds are closer to 10,000. They have got other businesses which could value add over the medium to longer term. You have your diagnostics, you have pharmacy. So both these businesses also are pretty valuable if you look at it in the overall contribution. So if while it looks very expensive, just if you look at pure numbers, P basis, but it is not that expensive if you do a sum of parts valuation. So I would add Apollo Hospitals. You could also look to add, create a basket of stocks of 2 to 3 three hospital stocks. Another one could be Fortis. There also, I think, the number of beds is 4,000, around 4,000 beds. And in terms of valuation, I think, you could get some upside positive news in terms of you have IHH, which does hold quite a substantial 31% equity in Fortis. So at some point, if they were to, increase their stake or a bit of M&A activity takes place, I think you could see that upside. And of course, Rainbow, as Vaishali mentioned, that could be another addition to create a portfolio.
Okay, all right. Those are some interesting names, and hope it helps the viewer as well in making a smart decision. Rainbow Medical, by the way, for now is down 5%. It's a sharp downtick that we are seeing, and it is at the day's low as well. We'll get more queries on board, but for now we have to get into a break. Before that, a small programming note for our viewers as we do that. As the workplace transforms, so must leadership in the Bengaluru edition of Future Female Forward Season 3. India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on July 29, 5:30 p.m. onwards, only on CNBC TV 18, CNBC-TV18.com and YouTube. Welcome back. You're still tuned into your stocks and earnings. They're coming in thick and fast. We'll keep addressing them for you. But for now, we'll address your queries. We still have with us Shaina Mugdam, independent market expert, and Vaishali Parekh of Prabhudas Leeladhar. They are here to answer all your queries, both from a technical angle and fundamental as well. Let's get to the first one now. Manoj writes to us from Hyderabad, holds 2,000 shares of Sun Pharma Advanced Research Center at 165 rupees a share. Wants to know what is the outlook on this one. Vaishali, this time let me start with you because the stock, largely reacts to some research and development activity. Is it that active from the technical aspect as well? And if yes, how do you view the stock?
I definitely agree. Actually, the stock is too iffy. I mean, it's prone to a lot of, pros and cons. I would rather say, because overall, just today I was observing that whole of pharma sector is showing an up move. I think it's signs of revival in pharma sector. I would say switch to the frontline pharma stocks instead of Spark, getting into perhaps a Sun Pharma or a Lupin or so. That would give quicker and better returns.
All right, so that's the view coming in from Vaishali. Shaina, what's your take?
Yeah, I would say an exit. There are a couple of issues. The net worth has actually been eroded with the losses. Negative net worth is now almost 200 crores. Now the parent is pretty strong. They've got Sun Pharma as their parent. So yes, it can be recapitalized at some time in future. There are some negatives and some positives. One of its large molecules that was under development for sclerosis, that actually was discontinued because it did not meet the necessary clinical trials. But they have got others also in the pipeline, in terms of cancer molecules, which they are tied up now in clinical phase 1. Now, all these things are positive, negative, it will be news driven. So I would say that it is better for a retail investor to switch to a safer pharma stock.
Any safer pharma stock that you would suggest?
I would say stocks like Biocon are good. In fact, even Sun Pharma, which is the parent of Spark, that also could do better. You have Cipla, which actually the numbers just came out, which was a mixed bag, but in terms of revenue, slightly disappointing, but otherwise margins were better. So I think there are larger pharma stocks which you could switch to.
Take that point. Thank you so much for explaining that to us. Let's go across to the next one. Milind Deshmukh is writing to us from Maharashtra, holds 1,000 shares of Raymond Lifestyle at 2,250 a piece. Wants to know whether to hold or sell, where there has been that massive demerger activity that took place for this group. Vaishali, let me start with you first.
I think the stock is quite oversold and, you can see some revival coming in, but keep a stop loss of 1,000 levels because I think it's showing signs of bottoming out at 1,000. Below 1,000, it negates my view, and even the indicators, what I'm seeing, it's ready for a sign of reversal. So keeping 1,000 as stop loss, look for a target of 1,300, 1,400. That would be the level and the range that I would be looking at right now.
Okay. What about you, Shaina?
I think a safer strategy would be to just book half the loss because investors got in at a pretty high price. The remaining half he can hold to see what the Q1 numbers will be. Because if you see the last 2 quarter numbers, they were pretty disappointing. And on a fundamental basis, we have no clue as to whether they will make profits or losses in the first quarter, second quarter of the current year. Textile overall sector should do better on a general basis because of the trade agreement that we've had with UK. But at the same time, I think it is better to book half your loss. On pure valuation based on the turnover, it's just about the market cap to turnover is just about 1.5 times. So it is not expensive. But I think there's lack of clarity. So I would say book half the losses and hold the rest, keep a watch, review post numbers.
Okay, so book half of your losses and wait for the numbers as well. The stock is also falling in today's trading session. Saharsh is writing to us from Hyderabad. He wants to know whether the right time to invest in CCL products. A lot has happened with UK-India FTA as well right now. Shaina, let me come to you first up. Do you think that is something that could be helpful for a stock like CCL products?
Yes, that also, valuations also attractive, balance sheet is very strong. Last year, despite coffee prices being high, they did pretty well in terms of numbers, if you saw the FY25. And now with coffee prices also coming off, with raw material prices coming off overall, I think the current year will be much better, both in terms of domestic as well as in terms of their international sales. So CCL products is one I would hold as of now.
Okay, so hold CCL products right now. Vaishali, from a technical level, what does the pricing suggest?
I think it is showing resistance at 900 levels, and right now we are seeing some consolidation taking place. So I would say book partial profit and get into the stock. Once again, we see a little bit of a dip, say perhaps 780, 750. That would be an ideal level to get into the stock.
Some of the stocks that we have queries on today are at the day's low. So a lot of action happening in the mid-cap space right now. When we started the show, the index was down around 187 points. That continues to be the case. Some recovery that we saw, but it hasn't been maintained at those levels. So we'll watch out for what's happening. The mid-cap index is down almost 900 points as we speak. So let's go across to our next query. GH Rao is writing to us from Vijayawada. He wants to know whether he can enter IEX at current levels after the recent market coupling news. It's a very interesting question. China, we spoke to the management today as well. They said they will be able to contain the loss and they'll not look so much at the day ahead market but the other market. Do you buy into that thesis? Do you think fundamentally it will be good to look at the stock from these levels?
I say that I would think it is a risky strategy to enter into a stock where there is some very big negative potential. Yes, the management will definitely try to contain the negative impact, but the coupling information that has come out now that will be implemented in the near term by they have it's going to affect them because their transaction income is about 70% of their total revenues. So we will have to wait and watch and see. Besides that, competition in terms of other entrants and the efficiency that they can bring up, there's a lot of ifs and buts. So I don't think you should enter IEX as of now. Valuation also is not cheap. So why would you do that? Just wait and watch. Let's see how it evolves.
All right. We'll wait and watch. What about you, Vaishali?
Yeah, actually, from what we saw yesterday, the fall, even on a longer term time frame, I think 130 acts as a very good support level. But having said that, it doesn't mean that the trend is changed or it's going to consolidate. But purely on a technical trading strategy, I would say keep 130 as a stop loss. We may see further bounce back coming in, and that would create a favorable risk reward ratio. Otherwise, there's no significant up move or that can be expected in near future.
All right, take that point, Vaishali. Let's go to the next query now. Riya Sen is writing to us from Kolkata, has 300 shares of Suzlon Energy at 15 rupees a share, has a profit, a decent profit, 15,000 rupees, wants to know the future prospects of her investments. So, Shaina, your take?
Yes, Suzlon Energy, the growth remains very strong, and they are talking of a new management to be put in place, which is also, I would say, a positive. Parent is strong, business potential is good. They have got very big orders in hand. Having said all that, I would still say take part profits because valuations here for Suzlon are very expensive, and there are a lot of options that you can diversify, add to your portfolio in the similar sector. So I would say book half profits, and you can keep the rest for the longer term.
And book half your profits and keep rest for longer term. That's the fundamental advice. What about charts, Vaishali?
Well, I agree with China because today's candle is a bit sounding a word of cautious. I would say book partial profit and wait for a dip if one needs to add more.
All right. So wait for the dip, book half your profits. That's the advice coming in on Suzlon. Ladies, thank you so much for joining in today with your expert advice on different queries that our viewers sent us. Hope it helped all of them. With that, we'll take your leave on this edition of Your Stocks. But do remember to email us your queries and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A slightly bit of a muted start is what is coming in for the Asian market.
India can be a trusted supplier in your supply chains.
If the 25,018 level breaks, you basically are looking at a retest of 24,882, 24,968 on the Nifty. The Nifty Bank is absolutely flat.
Directional element of earnings, the directional element of liquidity and sentiment are all turning positive.
Since it's a 1/3 of the total segment, it is not going to be substantial. That is one.
It's a massive selling that we're seeing across the board. It's a broad-based selling, actually.
This is actually going to create completely new models in the traditional GBS world.
Allegation that Rani Kapoor has made is that she was basically coerced into signing documents behind locked doors. Contents of the documents she had to be signed were not revealed to her, and she has been denied access to her account.
A 210-point cut that we're looking at the Nifty.
Well, there you had it. Glimpses of the day gone past. It's not been a good day for the bulls. The market has been struggling with the near 200-point cut on the Nifty. But then it's Friday. And in the form of that last piece that you heard Mangalam talk about, Sona BLW, well, Nigel, we have a bit of a, pot boiler. And we hope it gets resolved. And we hope shareholders' interests are always paramount and are kept in mind. But yeah, that was a twist in the tail today.
Well, that's right. I think the disappointing part of the day, Surbhi, is that earnings have been a little bit disappointing. If you look at Bajaj Finance, if you look at Shriram Finance as well, that came out with a set of numbers, those asset quality issues, a little bit of a miss in terms of profit. Both those two, that's weighing on sentiment. And the Nifty Bank itself, it's a very, very crucial mark. Both the Nifty and the Nifty Bank, the bulls will want, on both these two indices, by the time we're wound up, which is in the next 60 minutes, both of them will be off these lows. That's the important mark, because otherwise the structure is getting pierced and it's looking very, very big. So we'll have to keep an eye out on that front, whether or not there is something that the bulls have. But otherwise, the fear is that we could be heading to lower levels on the Nifty itself, since the 20 and the 50 DMA have been breached. But we've got an action-packed show for you on closing bell. First up, we'll focus on Bajaj Finance, which is reacting to the Q1 numbers. It's one of the top Nifty losers today. The company points to growth challenges as stress continues to persist in the MSME segment, as well as in the 2- and 3-wheeler space. Gaurav's going to be joining in to help us out with details. Post that, we'll focus on Cipla, which is reacting to its Q1 numbers. While the company revenue comes in below expectations, margins, profitability, well, that's beats expectations. Vinny will join us to run us through that fine print, and those numbers look quite good. Shriram Finance, well, that's the other one on our radar, reacting to mixed set of earnings. While profit comes in below our estimate, we have asset quality that's largely stable. Gaurav will be joining in to give us the earnings fine print on that front. And we'll also talk about earnings expectations. Kotak Mahindra Bank, that's the big one that is expected tomorrow. We'll tell you what all to expect on that front.
Okay, so earnings and more earnings. And it's not been that great. And, the market is near 1 month lows. The last time we revisited these levels, it was around the 23rd of June. That's when the low on the Nifty was around 24,800 thereabout, 824 to be precise. And we're flirting around those levels again. So let's see, the next 1 hour is critical. As of now, over the last 1 month, we've once gone to these levels, but we've managed to hold the range. We haven't broken below it. Let's see if that will happen today or not. On Shriram Finance, the net interest income was a good 200 crores short of estimates. So that didn't go down too well with the street. And anyway, Bajaj Finance has had its own woes with respect to asset quality, and we'll talk about that. The other facet of trade is that the mid-cap market is falling more once again. Mid-cap index is underperforming the Nifty by a decent stretch, about 1.5% down on the mid-cap index. And the Nifty is down about 1% as we speak. If I talk about some of the key movers and shakers, particularly talk about mid-cap banks or mid-caps in general, look at a Union Bank down about 6%. Hexaware and some of these very sharp IT reactions that are playing out, 9% down on Hexaware. Chennai Petro's numbers came out and they've also posted a loss. So Chennai Petro is in focus. MRPL is down another 6%. That's what happened to Chennai Petro as soon as the numbers came out. So largely speaking, earnings have been a bit of a bleak spot throughout this week, actually, much of this week. We'll talk about this as we go forward. Let's straight away get to the action then. How should you position yourself in the last hour? Mitesh is with us. As always, Mitesh, not easy for the bulls. It's been a slow grind down. Any advice on the index, Nifty, Bank Nifty, any trades there? Of course, if not the indices and stocks.
Good afternoon, Surbi. My sense is that, we are now comfortably below the 24,900, 930 zone, which is what I had indicated as the support area. And I said if we start breaking below that, highlighting that there's a good chance of that happening eventually, we might even go down to about 24,550, 600. So I think another 200 odd points kind of a cut could still happen from current levels. The two important things. One, there is a short-term moving average around 24,940. And then there's this gap which was made today at 25,010. So I think these are the two levels. Pullback to these levels are likely to attract strong selling. And if you don't start getting past 25,010, then maybe, we'll not only go to 24,550, 600, but maybe even below that. For the timing, there are some weekly averages around those levels. So we'll keep that as the first target on the downside. On the stock side,
yeah, just one question on the index, Mitesh. So you'll recommend taking a short position on every bounce?
That's true. That's one way of trading it, that you can short futures at pullback closer to about 24,900. Or you can also do put spreads. That is slightly less aggressive position. You can buy into 24,900 puts and sell into 24,600 or 500 puts and make a spread out of it. So I think yes, very clearly. But in both the cases, the bias is on the negative side.
Okay, Mitesh, got it. So that's the index. What about stocks? What are your trades last hour?
I have one buy and one sell. In fact, Cipla was just being discussed. Good price and volume breakout happening over here. Recommend buying this one with a stop below 15.15. So 1515 is the level. Stop loss level, and on the upside would look at targets of around 1590 to about 1600, and on the selling side is Power Grid. That's a stock which is given some multiple negative crossovers on the hourly and the 2 hourly charts. So keep a stop at about 295, half 296, and look for a target below 285.
Okay, all right. Thanks a lot for that. Mitesh, well, let's focus on a couple of those earnings. Shriram Finance just came out with its numbers. It's reacting to those numbers. Gaurav joins us to run us through the fine print. Gaurav, it appears that margins a little bit lower and there are some asset quality issues yet again. Tell us more.
Well, yes, when we talk about Shriram Finance number, now in this quarter specifically, asset quality, I would say it was a little bit of on a positive side because credit cost decline has been higher than what the street is expecting. But what is negatively playing out here is that net interest margin. So let's understand the numbers first. Net interest income increased by 10%. It was below the street's expectation. When it comes to net interest margins, now they have declined almost by 14 basis points on a sequential basis versus the estimates that net interest margins would stay stable, or even they were expecting net interest margins to go up almost by 5 basis points. So that was something which was disappointing. Let's also not forget that management had also guided net interest margins to remain somewhere in the range of 8.45 to 8.6%. On the other hand, when we talk about other income, we did not see any kind of big show there, and as a result, pre-provisional operating profit increased only by 8.5%, which is again lower than what the street is expecting. What remained positive in this quarter is the credit cost. Now, on a calculated basis, credit cost has declined almost by 40 basis points. Now it comes to 1.9% versus the street's expectation of the fall of around 20 basis points on a sequential basis. And this is something which is boosting the profitability. It is up, the profit is up almost by 8%, which was actually in line with what the street was expecting. On the AUM side, we saw again in-line set of numbers. We saw a growth of around 17% on a year-on-year basis, and this was led specifically by PV and MSME. Two-wheeler growth was also healthy. On the other hand, we saw a decline in the growth of gold loan segment. So definitely, growth was also something which was not a concern. But at least at this moment, net interest margins is something which is weighing in on the stock price. As we speak, the stock is down more than 4%.
Okay, so there's a margin concern at Shriram Finance in Q1 that explains the fall. Gaurav, just quickly on Bajaj as well, Bajaj Finance, when now that the call is over, you've seen all the notes as well. So is the issue only with the slight asset quality, credit cost, and what they're saying in the a few segments? What is the takeaway, final takeaway on Bajaj Finance?
Right, as you suggested, the issue is specifically because of the commentary that has come from Bajaj Finance. Because when we look at the numbers, now AUM growth is at around 25% on a year-on-year basis. Profit has increased almost by 22%. The numbers seem to be in line with Street's expectation. In fact, when we talk about credit costs as well, now this number is also in line with what the Street is expecting. What remained actually negative about the stock is the commentary from management. What they have suggested is that there is some stress specifically from two-wheeler and three-wheeler segment and from the MSME segment. They are highlighting that this stress is likely to remain for the next quarter as well. In second half, we may see this stress easing up, but for now, they are also saying that there will be some slowdown specifically in these segments. As a result, when we look at the brokerages, they also became a little cautious. In fact, we have got JM Financial who said that there will be a little bit of room for growth going ahead because the triggers for re-rating are limited. In fact, we also have a bunch of brokers like Morgan Stanley, UBS who maintained their sell rating. So there was a little bit of pessimism from brokerages as well. And specifically on the back of the commentary from management, we are seeing this fall in Bajaj Finance today.
Okay, all right, Gaurav, thanks very much for that. Great to get some perspective on those numbers. Let's discuss this and more with our guest on the show. We have Dharmesh Kant, Head of Research at Chola Securities, joining in. Dharmesh, let's start right there. Two big Nifty NBFCs. What did you make of the numbers and what's your call on both the stocks?
Yeah, good afternoon, Survi. Thanks for having me for the show. See, the numbers were fairly in line with what the expectation was, and the contraction in NIMs was expected. The only surprising element was the deterioration in the asset quality in case of, say, Bajaj Finance. Shriram Finance did pose better numbers as far as asset quality is concerned. And this has to be read in line with, see, in the environment, when there is a deflationary kind of environment, I mean, when the inflation is falling rapidly, and then you have an interest rate cut, it's usually not good for the economy, specifically for the lower ticket size kind of a loan. So what we have seen across the financial sectors, be it public sector, private sector, or NBFC space, the problem is coming from lower ticket size kind of a loan. I mean, 50,000, 20,000, going all the way up to say 5-6 lakh kind of a loan ticket size if it is there. Because there the income reduces for, the rural India largely depends on the monsoon and all. If monsoons are not that deteriorating, not menacing in nature, then what happens is the per capita income of the farmers go down. The reason is, I can give you a small example, a quick example. If you are producing 10 kg of a potato and selling it at ₹10, so 100 is what you get. And if there is a spoilage of 20%, 2 kg or 3 kg because of transportation or warehousing because of monsoons, the same 10 rupees potato goes up to 30, 35 or 40 rupees. So the overall income is far higher than the normal produce. This time, this has not happened. Till now, there has not been any spoilage or things like that. And that is what is causing the worry. And our collection checks does suggest that collection efficiency ratio is coming down. And the other trend is the provisions have gone up across the board. So whichever financial company is reporting, even if the asset quality is fine, but the provisions are going up, that does indicate there's a pain in the upcoming quarter as well. And that's a reason why with expensive valuation of Bajaj Finance, we are seeing a correction. As far as Shriram Finance is concerned, I think with this correction, one should be buying into that. It's always the valuation multiple is always around 2 times price to book, but it's a good opportunity to acclimate the stock.
Okay, got it. All right. Well, Dharmesh, stay with us. IEX has rebounded today after a 30% plunge that we saw in market coupling development. Earlier today, we spoke to Mr. Rohit Bajaj, the joint MD at IEX, who explained that it was too early to challenge the CERC order and clarified that it would impact their business there would be some impact from market coupling. Let's hear out what he had to say.
So bit early days to comment on that, but let me quickly try to rephrase what is there in the order. So CRC issued order for implementing of market coupling for day-ahead market on 23rd July, day before yesterday. And it talks about initiating the process of market coupling for day-ahead market. There are a few more elements in this order where they said that due to shorter time frame available for bid submission in real-time market, and also because of other operational complexities, coupling of real-time market will be considered at a later stage. So yes, there is going to be some impact on our business for sure. But if we see the whole thing, in the recent time, we have seen day-ahead market is not everything for us. There was a time when day-ahead market contribution in our total volume was 80-85%. But today, this number has come down to less than 35%. We would try to maintain where we are. But yes, if the competition is going to be there, definitely there could be some drop. Very difficult to put number to it. Very difficult to quantify this at this point in time. Single entity who is participant in the market, they cannot hold more than 5%. Otherwise the window is 25%. If there is competition, there could be possible reduction. So I'm not saying that it cannot be reduced. It will take its own course.
Let's get to Dharmesh's view. Dharmesh, what's a little bit of a sticky zone, right? For IEX shareholders, the stock falls 30% in a day. Their moat itself is gone if this coupling issue does take over and it actually gets into play. Your view on it?
Yeah, Dr. Nigel. Earlier how these companies were operating is they were operating as an exchange, as a broker as well. Both the functions were performed by the same entity, and with this market coupling coming into place, what will happen is the exchange part will be created by an artificial entity. All this data will be collated, and then the price differential advantage won't be there. So this definitely will lead to some competition, going up. Competition taking market share from the IEX, definitely that will be there. But the future of this entire business depends upon how effectively this entire synergy happens and how effectively online real-time transactions happen, because it's not only day-ahead market or term ahead market kind of a synergy, but even real-time market, if it is synergized, then I think the volumes will go up. If you look at short-term market, earlier it was, 10 years back, it was around 8%, it has gone to 12.5%. Of that exchange-traded volume, which was from 1%, it has gone up to 7% kind of a market share. So 5% organic volume growth on the exchange-traded electricity units, still that opportunity size is there. So not everything is lost for the shareholders of IEX. Definitely, the margins will decline. It has, in 2018, they were getting around 5 paisa per unit, kind of a commission, which has come down to 4. Going forward, I do believe that as this pricing mechanism advantage goes away and it's just a volume game between the players, it will come down to say 2.5 to 3 paisa in say next 3 to 5 years. And technology, as has been cited, that it's a challenge. I don't think technology is a challenge. Technology is meant to improve things going forward, and this will be put in place. So for shareholders, they should be prepared for this thing coming. But my own sense is volume will take over. It's a time-wise kind of delay now. You have to wait and see how the competition plays out. And 2 to 3 years is definitely lost for IEX as far as price action is concerned on the upside.
Guys, market breadth like yesterday is once again terrible, huh? 4:1 declines to advances. Some actually more. 20, almost 5:1 actually, if you look at the overall NSE listed space. And lots of stuff moving down with volumes, which we'll get to. This source-based information, meeting between Chinese foreign minister and external affairs minister, is likely we should put those flashes back up.
Ended on a positive note. I think that's what our colleagues in Delhi are picking up. And this is being seen as, some are interpreting this as maybe a bit of a reset for the better between India and China in terms of our relations. And I think some breakthrough on import of rare earth magnets may happen. So, yeah, I guess...
Industry hopeful of some breakthrough. Yeah, but industry has been hopeful for a while. EM took up the issue of rare earth restrictions during his meeting with the Chinese foreign minister, and it ended on a positive note. So, yeah, hopefully things will start to ease out a little bit in that sense. And we're talking about the broader market, right? Look at... lots of stuff. CPCL, Chennai Petro is down 10%, 683 or so. It's a sharp cut. I'm not sure if numbers have come.
Yeah, numbers came. There's a loss.
Okay, so that is one. Hexaware, we spoke with the management, is down 10%. Of course, it was a week since the morning. Intellect Design is another one, which is down 10. So this mid-cap IT business, yesterday was Coforge, Hexaware, Intellect. Emphasis, of course, was higher. And we've spoken with most of these companies after their earnings. So there is pressure. Nuvama is down 5%. MRPL is down 7%. But I think it had a bit of a run-up as well. So some profit taking in the broader space. SBFC is down 4.5%. Actually, it's a pretty long... So it's not a thinly traded losers list today. And it's for the second day running. Yesterday again, broader markets were looking pretty poor out there. Dharmesh, a lot of stuff is getting sold. And any thoughts on what's happening in this small and mid-cap space, and anything else looking interesting to you?
Yeah, Prashant, good afternoon. See, we were just studying around 119 companies from the basket. And what we figured out that the top line growth was around 5.5% to 6%, and operating profit growth was around 7.5%, with hardly any increase in the operating margin. So that was fine. But the problem is with the kind of commentaries and the analyst call which these companies are, if you're attending what they have said, is not very encouraging. And that's the problem which we have seen with the NBFC space as well, because the lower end of the market has not been performing well. So overall, that selling pressure has accentuated because most of the valuation multiples were far higher. However, having said that, I think still there are, pockets of green shoots. For example, Sharda Cropchem came out with a good set of numbers. And today the stock is doing well. But again, the type of traction which we are seeing in the entire, agrochemical space, in the specialty chemical space, the numbers have been good. Stock prices may have not performed the way the numbers have come out. For example, Ether Industries also come out with a good set of numbers. So that is one area which, in case of a correction or decline, one should be looking into acclimating your value picks out there.
Sharda, by the way, is the third largest volume-led gainer on the NSE, which Dharmesh just told us. 18% higher on Sharda Cropchem. So yeah, it's a pretty large move on that one. Actually, there's enough stuff on the upside. Vimta Labs is up 14%. Small name, right? But look at the volumes on Vimta Labs. Humongous. Tattva Chintan, I think, for the second day running. 3 days back, stock was about $700, and Tattva is now 1,150. So Home First is up about 6%. So it cuts both ways. Although, I mean, the number which are on the downside is much longer today. As I said, 5:1 as opposed to the stuff which is gaining at this point.
Just a few more names, Sambhav Steel Tubes, the issue came at around 80 rupees. The stock ran away to around 140 rupees. The numbers look pretty good. The management joined us earlier today. They as well sounded quite optimistic, in terms of their growth numbers. They're guiding for around 300 to 350 crores of EBITDA. But that as well, from the highs of the day, it's corrected, I think, close to around 8%. So it seems where there is some money being taken off the table, where there are some profits. And the word on CPCL, it's surprising that actually the numbers are so weak, though we don't have the inventory loss number. So we'll have to wait for that, and keep in mind that, that is the important number. There was no shutdown. So some clarification from the management is something that we'll be waiting forward to as well on that particular name. MRPL as well as down, CPCL as well in reaction to its numbers. So some clarity will be awaited on that one. Well, we'll thank Dharmesh on that note. Thanks, Dharmesh, for joining in. Wishing you a good Friday evening and weekend ahead. We look forward to chatting
Thank you so much.
next week itself. For the time being, slip into a short break. We'll get back with Sanjay Parekh, founder and CIO of Soham Asset Managers, on the other side.
Okay, welcome back. There's what, markets, of course, not doing very well at all. I mean, 200 points lower, but it's a broader market breadth which has been especially problematic, as we've been pointing out. Numbers keep coming in. GNA Axles is the next one. Margins look better, about 100 plus basis points on a year-on-year basis, though profits are slightly lower. Unusual movers is what we address at this point of the day, at this point of the show as well. Hormuz is here on the wall with that. Hormuz.
Well, earnings reactions and stocks have been taken to the cleaners, but we'll take a slightly broader view today, and especially because of the month coming to an end as well. You start off with JTEKT India, another auto component manufacturer. It's 7% lower today. It snapped a 5-day gaining streak after today's fall, among the top losers on the small cap index, and courtesy of this fall, it is now testing a very important support zone of the 100-day moving average, which is at 133.1. So it's very close to that level. And as of now, the stock is down 15% on a year-to-date basis, and this is going to be possibly the first negative year after 2020. So JTKT is one, Paisalo Digital is the other name, and that has snapped a 3-day gaining streak as well. Before this fall today, the stock was up 15% in 3 trading sessions, and all 5 days this week has seen volumes in excess of 1 crore shares. So activity this week has been on the heavier side. It continues to move around its 50 and 100-day moving average as well, and down almost 35% on a year-to-date basis, and it's likely to be the first negative year after 2016 for Paisalo Digital. Vimta Labs, you just heard Prashant talking about it before the break, and that stock has snapped a 4-day losing streak today, 13.5% higher on the stock. Very heavy volumes today. Almost 95 lakh shares have been traded so far, a 20-day average of just 5 lakh. And as a result of this, the stock is up almost 30% in the last 4 weeks. And courtesy of this move, the stock has turned positive on a year-to-date basis as well. So after this surge that it has seen in the month of July. Now, Nugent Software has been sulking ever since it reported results last week, and it continues to sulk. This is the 7th day of losses today. It came out with results last week, and ever since it has not gained in a single session, down 2% today as well. And it's down, it has halved so far this year. It's 50% fall this year already, and this is the worst calendar year that the stock is likely to have ever since it listed back in 2018. And between 2023 and 2024, the stock is up almost 10x. So it also shows that it's coming off very elevated levels as well, the run-up that it has seen in the last 2 years. And lastly, Cupid is the last name on this list. The stock is up moderately today. You can take that as a win considering the broader market breadth. But the stock is up almost 40% in the month of July. The stock has almost doubled in this year so far in 2025. And it's between 2022 till date, the stock is up almost 12x. At the start of 2022, the stock was at 12 rupees. Today, it stands at around 150. So plenty of stocks being taken to the cleaners, but there are some pockets of winners emerging as well.
Okay, as always, it's an interesting bunch with Hormuz. Wakes us up. Hormuz, thank you very much for that. Not that we are saying we're dozing off, but I think we are. It's a good.
Charges us up, Hormuz, yeah.
Recharges us. Sanjay Parekh is with us, founder and CIO at Soham Asset Managers. Sanjay, good to have you with us here on the program as always. Appreciate your time, and it's good to speak with you as well, Sanjay. I was looking through your portfolio and I found one stock which perhaps is new. Maybe there are more. I could spot Oswal Pumps, which is also a recent listing, Sanjay, which finds its way into the portfolio. So tell us a little bit about it. And it's like, I mean, there's Shakti Pumps, which I guess is in the same space. Why do you like this one? Why do you own it?
Yeah, so one is, this company, as you said, got listed, IPO price was 614. Immediately after the listing, we could add at lower levels, so that was good. Basically, the opportunity in this segment is very, very large. There are almost, the opportunity can be as large as 11 crore pumps. Either not having pumps, farmers not having pumps, or they are running on diesel sets, or the pumps with the grid connected, which can eventually move to solar pumps. So the pump manufacturing part was smaller, but with the solar modules getting attached, the opportunity is pretty large, because an average pump for a 3 HP size is around 2 lakh rupees. And this player is completely integrated. It makes its pumps, it makes it motors, the connectors, and the module. And last year, before raising the capital, They had a 400 crore net worth and 260 crore was the profit last year. So that was as high as that for the ROE. So the return ratios were very, very good. Even after the capital raise, even if you take lower margin, the return ratios can be in mid 25% or so. So the fixed capital intensity is low, but the working capital intensity is high because it's B2G. The dependence on state government for payment is there. And there it will be ranging from 150 to 160 days. But the fixed asset turn can be even 8 times, 10 times, So the return ratios are good. The opportunity is large. This player is completely integrated. There will be on net cash and it will only get better despite the need for working capital, and the growth will be very high. So, and it's a very large player, almost the second largest player, and extremely efficiently run. And as I said, integration, because of the integrated nature that they have, and they want to keep doing better and better, the margins are as high as 30%. But even if you take 25, 26% as a sustainable EBITDA margin, there is a clear runway for growth. And the market cap when we bought was 7,000 crores. Hopefully this year they'll do 500 crore EBITDA, and next year 700 crore EBITDA. So in this market, we found it to have better character of the business and very reasonable on valuation. And the risk, as he said, is it's a B2G, so dependence on government for new orders and continuing subsidies and the payments that you need to collect from them is always there.
Hi Sanjay, great to have you on. Good afternoon. I wanted to discuss two of your holdings and whether recent events at all change your view in any way, or what the investment case continues to be. So one is Axis Bank, and we saw what happened with this whole technical adjustment and the way they've changed their NPA recognition process. Whether that kind of made you rethink it all, because I think it's one of your largest banking holdings. And the other is Bajaj Finance. Nothing wrong with the growth, but today the market's very upset, saying, oh, but they're guiding for some stress in MSME, in two-wheelers, etc. So pretty sharp reaction. You think it's overdone on Bajaj Finance? But what's your sense? And a quick word on Axis as well.
So Axis, yes. I mean, I don't think it was technical write-off in all jargons. According to us, it's a clear recognition of the NPA that they should have done, and they rightly did it. More than that, I think, the balance sheet is very, very strong. That's not a problem. They're actually very, very conservative. They have a buffer which they're not using it. But just that growth, the trinity of growth, getting the capital, I mean, since the CASA, right, and, the NIMs, the whole trio, it has to fall in place. And that is where, and then, of course, also not asset quality not deteriorating. So what our sense is that they are clearly tilting towards asset quality not deteriorating and taking a view that it's okay to have less growth or less profitable growth. So that is where growth is not as much as they should have been. And that is where it's a little disappointing. But I think, that, as I said, asset quality is in place. We are very hopeful that slowly and steadily the growth will revive, and then ROEs would look better. The most important thing is what is in the price. You get Axis Bank at 1.3 times, which is almost very, very reasonable. And that's where we would want to, even if you take, 1.6, 1.7, there's room to money to be made, and hence we own 4% of it, which will continue to.
And Bajaj, any concerns, or you think this is a 1 quarter, not too much to...
Bajaj Finance was, certainly from the lows, you saw the run-up, which was quite well. It's done exceptionally well, in fact. So, now valuations are not that cheap, You take, you're just looking at 24 times on 27, you get a target price of 10,000. On price to book is also around 4.3, 4.4 times. So on that 1,000 rupees of target price. So it is not cheap. Yes, they said that growth would be in the range of 23-24%. And MSME and SME, they're very, very transparent and honest. And that's where they said we want to watch it. So we would, I mean, they're the best in class of governance, transparency, which is very, very good. And they did say that give us 1 quarter and we'll talk about growth and asset quality as well. But for now, it looks this way. So we are okay. We have a small weight because we reduced the weight because of valuation, not because of the results earlier. And at the right time, we'll actually increase our exposure to Bajaj Finance, but that would be much lower, not at the current price.
Okay, got that. Sanjay, just hang on. We'll try and squeeze in some more questions in just a bit. But quickly, let's head across to our F&O desk and see what's the latest action like. Manglam.
Well, there is a fair amount of selling that we're seeing in the market, but that selling seems like it is contained at a certain level. At lower levels, the Nifty is finding some support. The question is till what point? Because if you look at it, the Nifty Bank and Mid-Cap Index, every time they've made a bit of an attempt towards an up move that has been sold into. But lower levels, the market's holding on so far. So July 21st low, what it broke, 24,882, and today's low of 24,806. It's been meandering between these two levels on our market itself. The India VIX, which was at levels which were factoring in complacency at around 10, that has spiked. So that's telling you that, it's making the option writers a little more active in today's trading session. But you corroborate that with the put-call ratio on the Nifty, which is now at the lower end of the band at 0.7. It tells you that the option writers are more call writers than put writers. In fact, just as we speak, we've seen a fair amount of action at the 25,000 call and the 24,900 call, both of them telling you that any sort of up move that we see on the Nifty beyond 24,950 thereabouts, there could be some selling that would take place. Put writers earlier had written the 25,000 and the 24,900 put. Now it's the 24,850 put. With the markets moving lower, the street believes that maybe the next leg of support that comes in, if we were to break below that 24,800 mark, would be closer to 24,750, 24,600. On the way up, the 50-day moving average of the Nifty, extremely important to cross as a resistance. But on the way down, the 50-day moving average of the Nifty Bank as well is equally crucial to track. A lot of stocks on our radar. APL, Apollo Tubes, seeing some long positions being unwound after a big gash that we're seeing. Sona BLW, the family drama that is taking place right now, as a result of which the stock is at the low point of trade, some short positions being added out there. And ABFRL is a stock which is very close to its market-wide position limits when it comes to open interest. So open interest is close to 93, 94%. If it does go across that 95% mark by day's close, then we may see that stock come into F&O ban. But the stock that is likely to come out of F&O ban today with a fair amount of certainty is IEX, because the open interest now is at 77%. Remember, below 80%, the stocks usually get out of F&O ban. So with the kind of up move that we're seeing on IEX, now in double digits, after a big cut that we saw yesterday, the stock mostly likely to come out of F&O ban today.
All right, Mangalam, thanks very much for that. That's the latest from the F&O desk coming through. We'll take a quick break here. We're going to come back. As always, get you what to buy or sell today for a reverse trade. When you come back on Monday, short-term trading ideas with our technical experts.
Welcome back. Well, the markets, trying. There is some kind of a pullback. At least the lower levels are getting defended. By the way, you have Laurus Laboratories that's delivered its numbers. The net profit number looks good, and we'll wait by for the commentary, which in the past has sounded quite optimistic. So let's see what's that number. Net profit number improving. In the last few quarters, actually, they've got their act together. Revenue growth of close to around 31%. So that's good. Let's wait by for the margin number because that dwindled a little bit for a few quarters. And post that, you had the stock that saw a sharp correction from that ballpark, 500 odd mark. It went down to 300 rupees odd. But as they've got the act together and they've been guiding for better things, better times ahead, we have seen that the stock has bounced up as well. Currently, it's holding higher. We'll wait by for the margin number. For the EBITDA number, that comes in at, that number goes down as a beat. It's Laurus has now started to outbeat. There were quarters where, in fact, they were, undershooting. Margins are at around 24%. I think that would be the highest that we've seen in multiple quarters. So we'll have to see whether or not there is a one-off or anything. But otherwise, these numbers look very, very good. And if I have to pull it up, I've not seen margins like this of 24%. The fourth quarter was 24% odd. The street was wondering whether or not it's a flash in the pan. But it appears they're getting back to these numbers of around 24% after a period of close to around 3 years. Because last time around they were doing this run rate was in December 2022. So good going out there. The stock has already seen a bit of a run from the last quarter to this quarter. But these numbers go down as a beat. Mitesh Thakur joins us back. Mitesh, any calls that you have for us? And we're analyzing Laurus Laboratories on the fundamental basis, which the numbers look good. Do you have a technical call on it?
Laurus, certainly long-term charts are excellent. We kind of identified the current level of optimum around the 615, 620 mark. And the highest ever of the stock had traded before this move happened was way back in 21 when you got a closings of around 700 on the monthly charts. Now we are beyond that. So maybe, this rally started from 620, gone to about 840, 850, and maybe you'll get a pullback. But I think on the longer-term charts, this looks like a stock beyond 4 digits, and therefore any significant decline of 5 to 7% would be a welcome buying opportunity. People are holding to hold on to this.
I think Mr. Chava's number on margins, the promoter of Laurus, his number has been that 25%, that we'll get to 25%. He's been sort of talking about that for a while, but I think now he's closer to it at the 24 point something percent number. More on this later. But another pharma name which reported is Cipla. And Vinny's here with details on this one. Vinny, take it away.
Hi, Cipla reported a good set of numbers this time, especially on the margins and the profitability front. It was a good number. Revenue, a slight bit of a miss versus what the street was expecting, as well as what we were expecting at CNBC-TV18. So revenue growth of just 4% year-on-year basis. Margins have come in at 25.6%. Profit growth of approximately 10%. Now, factors that come into play. India business, how did that do? India business saw a growth of around 6% on a year-on-year basis. Slower growth was mainly due to the respiratory side of the business, as well as anti-infectives versus other therapies. These two businesses saw a bit of a slow growth in Q1 FY26. US business, obviously, it came in at around $226 million, which was slightly in line, we could say, with what we were estimating at CNBC TV18. Lanreotide, that was a concern coming in for the company in terms of market share. There were supply chain issues and challenges that were there. Now that has been solved, and Lanreotide market share has come in at around 19.5%. The company has spoken about how their launch pipeline for the rest of the year for FY26 is quite exciting. They have a lot of generic drugs that are going to be coming in terms of launches. That will be the key to watch out for in the US business. Overall, in the press conference also, there were certain highlights that came in. What they said was they saw good growth in India in generics business as well as the consumer segment, while branded prescription, especially the acute segment, where most of the business comes in from, that was a bit lower in terms of growth, and that is why India business saw slower growth this time. But for FY26, they're expecting good growth coming in there. So 8 to 9% by the end of the year is what they expect to achieve in the India business. Currently, it was 6%, so they will be back to that 8 to 9%. Other than that, Braxin, generic Braxin in June, which was the export data that came in, Cipla has managed to see some sales coming in on that front as well, so that was a positive over there. And all in all, good set of numbers. GLP-1, they're seeing a big opportunity coming in for the company, and they would look at maybe innovators as well as more launches coming in on that front.
Thanks very much. Very quick one. Mitesh, sorry, we didn't ask you for your specific trades, stock trades. You want to just run us through them?
Yeah. I have one STBT and one BTST call. On the buying side is Apollo Hospital. That's one stock which is doing very well in a weak market. So BTST here, the stop just below 74.50, 74.48. Look for a 7,500 kind of a target, for tomorrow. And on the negative side, on the sell side is in copper, which I would suggest taking STBT sell positions with a stop at 263 for targets of around 255 for tomorrow.
Got it. Okay. All right. Thanks a lot, Mitesh, for joining in. Well, let's welcome Sudeep Bandyopadhyay, who joins out on the show. Hi, Sudeep. Good afternoon. Good to see you. It may be Daru over the weekend, but it's Dawa for now. Those stocks are doing well. Cipla and Loris, both of them doing well. Loris, in fact, for third quarter running, the margins have held above the 20% mark. And for the second quarter running, it's holding at around 24%, which is after a period of many, many quarters. Your view on both these two names, and which one do you like?
Well, I think I do like Loris. This company was somewhere in between. They lost the way and they were wobbling. But things have started improving, and last few quarters have been pretty good. Even this quarter, I think you can't find fault with the numbers. Pretty good number on top line, bottom line, margin. I think they've started doing the right things, and way forward should be good. Management had always indicated of an aspirational margin of about 25%. They're very close to that. And I think, Loris is one company which I'll be watching carefully. I think valuation is not cheap, but I think from a long-term perspective, it does look good, provided they can maintain momentum. There's nothing to fault at Cipla as well. I was, watching the US business, and I think there also they have been by and large close to what was being estimated. So yes, even Cipla is good, but if I have to buy one, I'll go and buy Loris.
Okay. All right, so Loris is your pick over Cipla, so they've got that. Just stay on, we'll come back to you for more questions. But let's address those important updates that we had on the screen just a while back with respect to India-China relations and what perhaps is the next step on the whole rare earth magnets issue. We have both Ashmit as well as Parikshit joining in with the latest updates that they're picking up. Ashmit, let me come to you. I mean, as far as engagement with China is concerned, I don't know, too early to say that there is some sort of a rethink or maybe, a move to reset to an extent. What are you picking up?
Well, electronics industry is something that, in fact, has long been crying that, look, it's not just the auto space that's getting affected. Electronics players are also getting impacted due to these Chinese restrictions. Now, we raised these questions within the government, and what government officials are telling us is that given the size and scale of the electronics industry in China, there has to be some engagement, there has to be flexibility in terms of engaging with Chinese entities, with Chinese players. In fact, the government officials tell us is that overall, more than 60% globally of electronics manufacturing sits out of China, sits out of Beijing, and therefore engagement with Beijing cannot be avoided. Now, these statements coming out from government officials come on the back of three very interesting triggers. Well, number one, let's bear in mind that only as early as last night, we saw Dixon announcing that they have managed to get the government's blessings and the government's approval for a JV with a Chinese entity called Longcheer. So we're already seeing this engagement translate into action. Dixon already getting an approval from the government, from METI. Number two, bear in mind that only recently we've seen travel by the Indian foreign minister to China. And it is on the back of that we began to see relaxations like we did in the form of visas being allowed to Chinese tourists. So there is already some amount of thawing of ties, perhaps, some amount of engagement that we're already beginning to see. And let's also not forget that at this time, with the industry reeling under the impact of restrictions from China, there is already solutions being worked out. METI is already in conversations with the Ministry of Electronics, with the Ministry of External Affairs. They're discussing how, in aspects such as rare earth, perhaps components can be imported to be.
On rare earth, Ashmit, I'm so sorry butting in over there because we're running into market close as well. But specifically on rare earth, I really want to quickly hop across to Parikshit. Parikshit, you've been picking up inputs from your sources as well in terms of this meeting that the External Affairs Minister had with the Chinese counterparts recently. So, I don't know, is there any hope on the rare earth issue?
Well, this meeting between Chinese Foreign Minister Wang Yi and Indian Foreign Minister
S. Jaishankar, took place in Beijing on the 14th of July. This was the first foreign ministers' meeting in Beijing after the Galwan clashes, and the issue of rare earth restrictions was raised, and India urged the Chinese not to put these restrictions and barriers on trade, so to say. We believe that the meeting ended on a positive note. There were a few asks by the Chinese side. One, to give permission to set up plants in India by Chinese companies, free movement of people, and border disputes should not be allowed to derail the larger relationship, and we should keep on talking. So we're already seeing some movement in terms of JVs with Chinese companies being cleared. Visa for tourists is already being allowed now. So the industry is confident that there may be some positive messaging on the rare earth front in the coming few months. As of now, the situation hasn't changed, but the hope is that this meeting between the Chinese foreign minister and the Indian external affairs minister will lead to something positive.
All right. Good to get that update. So basically, trade is in that sense the great leveler in a way, at a slightly philosophical level. But as Parikshit said, obviously it's going to take time, it's going to take nuanced negotiation, but this is the general direction of travel as far as India and China is concerned. Parikshit and Ashmit, thank you very much for joining us with that. Just a quick programming note for our viewers as we slip into a break. As the workplace transforms, so must leadership. In the Bengaluru edition of Future Female Forward, Season 3, India's top business leaders gather to reimagine what inclusive leadership looks like and how women are powering the future of work, capital and innovation. Catch it live on the 29th of July, 5:30 p.m. onwards, only in CNBC-TV18, CNBC.com and, of course, the YouTube channel.
Welcome back. Well, a couple of stocks actually are catching your attention. I was looking at the open interest as a percentage of market-wide position limit. And earlier today in my F&O chat as well, I had mentioned that there's a possibility that IEX comes out of the F&O ban. Going by current reading, 3 minutes before we close, it appears that's probably the case because it's done enough. Currently, it's around 75-76%, sub that 80% limit. The other one is Autumn Investments. Nimesh earlier today had put out that there was a large trade that took place and institutions had bought. The stock was down, I think, 18%. Now it's down 2%. So big recovery from the low of the day. The big number, though, that we're going to be looking forward to over the weekend is Kotak Mahindra Bank. Gaurav's back to run us through the big numbers. Gaurav?
Well, yes, when we talk about Kotak Mahindra Bank, we've already seen a positive surprise in advances and deposits, where we saw growth of around 14.5% on a year-on-year basis. Now, considering these numbers, Street is not expecting any kind of negative surprise, at least from Kotak Mahindra Bank. When it comes to net interest income, they're expecting around 7% growth. Now, this translates into net interest margin compression of around 18 to 20 basis points on a sequential basis. Let's not forget, in the last quarter, Kotak Mahindra Bank enjoyed 4 basis points extra because of the accounting policy, and that is the reason. If we exclude that, 15 to 16 basis point of fall is what we're expecting. When it comes to operating profit, we're not expecting any kind of jump in other income, and as a result, operating profit may increase just by around 3% with some positive bias. When it comes to asset quality, now here we are expecting around 10 to 15 basis point of easing in terms of credit cost. We are not expecting any kind of slippages, any stress in the recent fresh slippages, and as a result, profit. Now, when we look at this number, it may decline almost by 2% on a year-on-year basis. But apart from numbers, we will be watching out on how the commentary is going to be on the growth front, how they see advances growing, how the NIMs are going to be as per them, because let's not forget Kotak Mahindra Bank has taken the deposit rate cut higher than its peer banks. And third thing to watch out for is the outlook on the asset quality. Now, that is also something that we will be keenly watching out for as how the management commentary is going to be. But all in all, good set of number is what we're expecting from Kotak Mahindra Bank this quarter.
Okay, all right, got it. Thanks for that, Gaurav. So finally, it's been a string of bad earnings. But you tell us, anything that stood out, anything bright this week where you are thinking of buying the stock?
Well, I think, Surabhi, I continue to remain positive on cement, and I've been talking about cement for quite some time now. And look at the cement company numbers, whether it's Ultratech, Dalmia. I think pretty much the entire cement pack is turning out good set of numbers. And look, remember, this is a kind of a monsoon season. So I will be very keenly watching the progress of cement over the Q3, Q4. We will definitely see a lot of good numbers and a lot of activity in cement. So that's one place. And remember, this is also Trump proof. So the tariff tantrums doesn't derail their progress.
Okay. All right, Sudeep, thanks very much for that. Well, we are down to the last couple of seconds of the week's trade. 230 points gone and ending at the day's lows, also ending right at the lowest level of the last 1 month trading range. It's not broken, but yeah, we are right at the bottom of the 1 month trading range as well. Weakness today coming in basically from all quarters, really. Bajaj Finance, Shriram Finance, after these numbers, stocks down between 3 and 5%. IndusInd Bank, weak. There's Infosys on the lower side. FMCG didn't work. Names like Nestle, Trent, many of them on the lower side of the screen as well. Or, those are the big losers. Actually, the market had no counter whatsoever. The only sector that's seen some buying today is pharma and healthcare. So Cipla, Apollo Hospitals, Dr. Reddy's, and Sun Pharma. Those are your 5 Nifty winners. So it seems, Prashant, market needs for some, I don't know about Daru, but Dawa for sure.
Need for speed. Speed was on the downside this week, right? Actually, for the week, if you want to just look at some outsized movers, Eternal stood out on the upside, large cap, right? 21% higher, Friday to Friday. And that's it. I mean, otherwise, you're looking about 21% gains on Eternal, and then next is 3%, 3.5%, Cipla, ICICI Bank, etc. Reliance was a slow but steady it drifted lower, 6% down, and that's the reason why the oil and gas index was down, one of the top sectoral losers today. As far as the small and mid caps go, the outsized move is on the downside, and IEX with a 28% cut Friday to Friday is the big one. Z was down 13, Chennai Petro was down 12, and a bunch more. So yeah, that's the week. Ends on a kind of disappointing sort of note with no real energy or vigor. We'll wrap up on this edition of Closing Bell, but don't go anywhere. You'll hear from Pankaj Tibrewal on the other side on the Editors Roundtable. Coming right up.
welcome to Morning Call. The Sensex and the Nifty are down for the fourth straight week. This is the longest losing streak so far in 2025. 35 out of 50 Nifty stocks are down this week. Barring banks and pharma, all sectors have ended negative. That is, the sectoral indices, they have posted losses. How long will this weakness persist? Are there lower levels in sight, or is the market about to bounce back? What about the triggers ahead? Hello and welcome to this week's edition of Editors Roundtable. I'm Surabhi Upadhyay. With me as always, Prashant Nair and Nigel D'Souza. Lots to talk about, folks. And today, to help us map through this slightly tiring, grinding market, we have Pankaj Tibrewal joining in. Pankaj, welcome to the show.
Thanks, Surabhi. It's always a pleasure to be on the Editors Roundtable.
Too tired? Like the market? No, guys, come on.
I think Pankaj is going to be the energy booster.
No, wait. Let me start off things. Let me just lay the context for the week, and then we'll go ahead. If we go to Pankaj. Pankaj, you're set for the weekend or not?
Yes, always. But earnings season is on.
Yeah, earnings season, really, the weekend you appreciate it even more. But Pankaj, I'm just going to do a quick...
Nigel, what context? I just say thanda tha. And I think go on.
Okay, all right. Let's just tell you what went on in the week, and then in fact we'll get Pankaj's view how he's feeling. You know, the Nifty ended at a 1-month low, and the problem was the last trading session of the week was the weakest, because the last tick was close to the low point of the day, and all those averages, 20, 50 DMA, both got broken out on the Nifty itself. And if you just look at that chart, the Nifty ended with a 0.5% cut. The Nifty Bank actually did a relative outperformance, because that held one end up, it was up close to 0.5%. The problem is tech. Tech got sold into, even good numbers got sold into. You know, the street was quibbling about various other factors. There is no big pickup in terms of discretionary spending as well. You know, so that's a bit of an issue out there. So tech was a sore point. And the broader markets, you know, which were holding up actually, individual stocks did well, but there were a lot more losers than winners. And that's why the mid and the small caps were down between 2 to around 3.5%. What's weighing on sentiment? One is there's no positive trigger. The street is searching for some kind of positive trigger. That's not really coming about. Q1 numbers were expected to be subdued. One would say maybe it's a little bit more subdued. Pankaj will tell us about how he's reading the season so far. And India-US trade deal, that's not yet coming about. We're hearing about, you know, various other countries striking deals, but our numbers not yet come. And the FI selling as well does continue. So for the Nifty, the problem is the structures got punctured a little bit, and we'll have to see some kind of a bounce from these levels, because now the 20 DMA, is far away. The 50 DMA as well is far away. And if we don't bounce from here, then the call is maybe we go and test the 200 DMA, which is a good 800 points away from current levels. So that's why it's essential that you see some kind of trigger coming in. For the Nifty Bank, though it outperformed, it broke the 20 DMA on a closing basis. So that's the other one, because the bulls will be counting on the Nifty Bank to bail them out. All in all, a weak trading session, a weak week. India underperformed the globe, and sentiment is a little bit weakish. Pankaj, how are you reading things? What do you make first of the earnings season of all the companies? I'm sure you're going to give us a number. Companies till now that have delivered, what is the number in terms of growth or degrowth, and how do you read it?
So, Nigel, I don't think earnings season has been as bad as what market is projecting it to be. Just to give you some numbers, till yesterday, 118 companies have reported their numbers from the BSE 500 companies. And revenue growth is approximately 7%, and PAT growth is about 13%, which is not bad as far expectation is concerned. But the sectoral trend has been quite mixed, and within sectorals also, we are seeing a bit of a divergence in many companies. So, for example, the good company result, because of a low base and incremental improvements, we have seen in cement. Across the board, cement companies have reported very strong numbers. Even metal companies, because the base was very bad, if you remember, in June and September quarter last year. So metal companies are also looking quite good on the growth front. What has been a mixed bag is IT. I think large companies have struggled, where some of the mid companies have fared well compared to the large cap peers. BFSI again has been a mixed bag, but our sense is that there's 1 or max 2 quarters of pain from a NIM perspective. But coming FY27, I think banking will be a very strong growth area. And just to give you some numbers, just a little bit of digression, that in the last 2 months, which is April, May, which we have the data for, banking system has seen 5.5 lakh crores of deposit accretion, whereas the credit growth has been only 45,000 crores. So because of the interest rate cut, I think deposit accretion has been very, very sharp, and that will start showing in terms of deposit rates coming down, which has been a challenge for the banking industry for the last 3 years. So our sense is, once this NIM pressure goes away in the next 1 or max 2 quarters, you should see banking earnings rebound very strongly from March or early FY27. So banking has been a mixed bag. On consumer, we have seen mixed trends in terms of staple companies having a tough time, but discretionary actually outperforming, whether it be hotels or some other industry. So I think I'm not very disappointed as of now. It's early days. Another 380 companies still to go. But let's watch out how the earnings season span out. But one thing is very clear, Nigel, Prashant, Surbhi, that I think many mid and small cap companies are faring better in terms of earnings growth compared to the large cap peers.
So the 120 companies, revenue growth of 7% and PAT growth of 13%, right?
Yeah. I guess, Pankaj, yeah, okay. So 13, that's a nice stat and a good one, helpful one, that BSE 500, there's 7% top line growth, 13%. Profit growth, which is not bad actually. So thanks for putting that on the table. I think, Pankaj, the issue is why everybody is feeling glum and tired is that it's not an easy market to make money in. Now you need to go deep down and find the guys who are giving you the good returns, right? No longer the easy, where everybody feels like a king or everybody feels like a queen. You know, on mid-cap earnings, I want to talk to you about mid-cap IT specifically. So let me just quickly recap the numbers. So because what's happened is that this is a bit of a new blow, so to speak, for the market. Till now, one could always make the argument that the weakness was restricted to large cap IT, and you had players like Persistent, Coforge that were doing well. So just a quick recap of what has happened. Look at the cuts in terms of the weekly loss in these stocks. Persistent 6.5%, Coforge about 10%, Hexaware 12%, Emphasis 7%. Mastech has been flat. Now, what have the companies said? Is the market getting too pessimistic, or is it a real issue? I've just picked up some examples. So Persistent, actually, top-line growth 3.3% is better than what most are doing. Their margins were steady. The commentary was very positive, saying that the order book and the pipeline is healthy. They're targeting 19% CAGR growth over the next 2 years. But what was the problem? The market just focused on the hit. And what was the hit? That they've deferred the wage hike. They've called out weak macro environment. So that was Persistent. Coforge, 8% constant currency growth. Promise of 14% EBIT margins by the time you exit this year. But the market is just not in the mood for any misses. The miss here was that adjusted margins in the quarter were weak. And of course, that issue of capital allocation and whether they're putting too much money into building data centers. That became the focal point for the stock. Hexaware, here, of course, there was a issue of growth. Top-line growth was below estimates. Margins were under pressure. The company itself has toned down its expectations from the whole year. They're not as optimistic as they were at the start of the year. And they're acknowledging that. Emphasis, only 1% constant currency growth. Clearly not enough to inspire any confidence in the market. And finally, Mastech. The revenue itself is down about 1%. And Mastech actually is one company that's clearly called out the weakness in IT spends, particularly in sectors like, ramp down of a client in healthcare, weakness in retail in particular. And then if you round it off with, of course, Infosys actually was best in class. That top-line growth was better than any of the other large companies at 2.6%. They increased their guidance. It's still only 1 to 3%, but for whatever it is worth, it's up. And even the commentary, they said they're getting good traction across BFSI in North America. They're seeing new possibility of revenue streams in AI. None of that was enough for the market. The stock ends 4% lower. So, Pankaj, is the market's pessimism on all things IT justified?
So, Surbhi, if you look at a common thread between any IT company in their commentary was that the macro and the discretionary spend is a challenging one. And things are not improving as far as US is concerned. Having said that, there have been differences in terms of growth between mid and large caps, but the price reaction is more of a result of the price to perfection. So if you look at most of these names which you mentioned, for the last 1 year, they have been one of the top performers in the sector they operate in, which is IT. And the divergence of valuations between them and large cap has been quite startling because of the growth which they have been delivering. So I think a slight miss out maybe on the order book, maybe on growth, or maybe margins to the expectations market was carrying towards the result season, I think is leading to such kind of a correction from a positioning perspective. But if you look at most of the results which you mentioned on the companies, I think structurally they are doing right things. I think sooner or later markets will take cognizance of that, and probably things will come back. So I'm not so worried about the market reaction. I think in a couple of companies the cash flow conversion was almost 100%, which was never the case for many quarters in the past. So I think companies are moving in the right direction as far cash flow conversion is concerned. Maybe markets have reacted maybe to a weak commentary or some margin miss. That's okay. I think it's more of a positioning and valuation concern rather than anything else.
Yeah, no, absolutely. The other thing which we've not talked about is, which does not, I mean, it's kind of faded in the background, is that we don't have a deal yet with the US. Not that we're desperate for a deal, but it's not at some level, it's not a good feeling, right?
Yeah.
That it's
everyone, like... No, the problem was when he was talking about deals, we thought we were going to be top of the pops.
That's what I'm saying. Expectation was that right at the front of the line to get a deal. And the problem is that not that we don't have a deal. That is, of course, I mean, just sentimental. The real thing is what happens on the 1st of August. Is it going to be base tariff of 10%? Is it going to be in that reciprocal, we were at 26.
Yeah.
Will it be 26, which will be imposed? Or will they say, we're still talking?
Yeah.
So there is actually a sort of real uncertainty as well. What is going to happen for those who don't get a deal because they've said it's a hard deadline.
But just a counter for the sake of debate, Prashant, should that be such a big overhang on the market? Because barring textiles and pharma, from a pure market EPS perspective, you don't have so many electronics exports. It's only a few companies. Dixon has just started, for instance. So is it fair to say that this is a justified market overhang?
I'm not saying it's the dominating driver, but I'm saying it's one more thing, it's one more irritant.
Negative,
right? And actually, it is not just about the dollar value, billion-dollar value of the thing, right? It's about, the relationship was being seen as this really, at many levels.
Absolutely.
Defense, trade is one, and that's what you spoke about, but at many layers. And now, and you just hear President Trump, what he said over the last 3-4 days, right?
Yeah.
At that conversation with David Sachs, he said, he specifically mentioned Indian workers.
Right? Yeah, that was quite scary.
It's not a great thing.
Yeah, markets don't like uncertainty.
Exactly.
And this is an uncertain event.
Yeah.
The day he announces that uncertainty is behind us and the market will choose to look ahead. For the time being, though, on the day-to-day basis, we're wondering, is it this weekend? Is it next?
No, absolutely. And, you can always say that he's there for 4 years. 2028, he can't get another term.
Yeah.
But the point is, once you, say, for example, tariffs, etc., once they go higher, it's like taxes. Once they go up, they don't come down very easily. You need something to bring them down. Anyway, it's just one more thing which I think, as I said, is a bit of an irritant more than anything else. We'll take a quick break here. Pankaj, of course, is still with us. We've asked him about specific sectors. We come back, we'll ask him what he's really doing in the market, things that he's been buying in his fund. Coming right back. Okay, welcome back. You're with us here on the Editors Roundtable. And Pankaj Tibrewal, of course, has been running us through his views. Pankaj, thanks for staying on. On that US bit, which we were discussing, chatting about here, I mean, I don't know if you have any thoughts, but beyond that, I want to ask you what you are doing in the market, Pankaj. What are you bullish on? What have you been buying? Pankaj, I think you'll have to unmute yourself.
So Prashant, before moving on to the where does the value lie in the market, I think it's very important to dissect the market into three parts: macro, micro, and then valuations. And on the macro side, I think the economy is making a trough, and incrementally whatever has happened in the last 4-5 months has been super for economy, both on the macro and the fiscal side. And hence my belief is that whatever on the micro weakness you are seeing, whether it in terms of earnings, high frequency indicator, is a result of the tight policy we ran for the last 18-24 months before January. And whatever good you are seeing, with the lag of next 2-3 quarters, you will start to see on the micro side. And my belief is that Street is underestimating that pickup over maybe December or March quarter. And hence, my belief, FY27 earnings can actually surprise on the upside. So my belief is that from here on till the next 6 months, market may be in a consolidating mode. And there you will get an opportunity to pick up your stocks, your sectors at your prices, because volatility is there to stay. And easy money is behind us. That's what we have been discussing for the last many months. I think it is going to be a stock pickers market. Where does the value lie? If you ask me heart in heart, I think the market caps between 6,000-7,000 crores to 30,000 crore is a sweet spot where I'm seeing value emerging, where many companies are sectoral leaders in the sector they operate in, and great leadership, great balance sheet, great cash flows, and valuation looking reasonable compared to many other market cap segments. The second point is I don't think it will be a sectoral biases. I think market is moving towards bottom-up stock picking, and that's what we are seeing within a sector also, that performance of one company versus other is so different. And hence, I think rather than wearing a sectoral hat, have a bottom-up approach. What we are seeing is the low-ticket purchases on consumption should do well. And I think there's an opportunity there, whether it's a consumer durable, whether it be value retailing footwear. I think that's where the opportunity will lie from a consumption perspective. And my sense is this Diwali is going to be a good one compared to what Diwalis we have seen in the past 3-4 years. The second, we have been talking about healthcare. Within that, generic pharma plus your CDMO plays, I think results have been very, very good for domestic as well as CDMO plays, and that continues to see very sharp earnings compounding as you move ahead. And the third phase is the chemical space. I think the chemical space right now, 2-3 results have only been declared. A couple of them have been very strong. And I believe that over the next 12 to 18 months, this segment is likely to make you money. So if any correction happens in good companies where compounding of earnings is there, I think one should look to increase position. That's broadly is there, and financials towards the year end, I think large private sector banks are looking really good, and FY27 could be a very strong growth year for them. That's broadly is the place where I think from a sectoral bias perspective, but still I repeat, between 6,000-7,000 crore market cap to 30,000-35,000 crore market cap, there's a lot of opportunities emerging after a very long period of time. And if you remember, Prashant, when the entire market narrative was sell mid and small, buy large cap in Feb and March, we turned constructive. Since then, I think broader market has done much better than the leading indices. And our views is that from here on for the next 6 months, market will be in a consolidating phase and bottom-up stock picking will be rewarded. Easy money is behind us. I think you have to work really hard at the ground level to pick up your stocks.
All right, Pankaj, every week we get a new deal, and I believe in the next few weeks we're going to hear a few more deals as well. This week, the deal of the week was from the alcohol space. So I know we haven't caught up for a drink for a while. Normally it's coffee, but we could test that as well. But what do you make of this deal? Because you have Tilak Nagar Industries in there. It's had a very, very rough past. But now they've turned around. They became a net cash company and they're going to bite big. They're looking at a 4,000 crore deal. However, if they are successful in it, then it puts them into another orbit. So from the mid-cap space, that was the stock of the week actually. What do you make of the alcohol theme? And would you look at the smaller names? I recall when Radico Khaitan started running, that ran a good bit. Or would you look at, the larger names, the United Spirits of the world? How do you approach this theme?
So if you look at the alcohol industry globally, they are struggling. Okay, among the entire beverage space, if you look at the stock performance of Pernod, Diageo, all are having a tough time because the per capita drinking between cohort of 18 to 34 globally has been coming down. That's a surprise. People between 18 to 34 are drinking less in US and Europe compared what we have seen in the previous decades. And that's weighing on the profitability and growth of global alcohol companies. But in India's context, I think volume growth is good. And that's why I said, look at a company which you mentioned, which has just bought a brand which is double the turnover of what they are doing today. That's the aspiration of these companies. And if they can turn it around, they move into the large league. But it's a significant acquisition by a very small cap company. And time will suggest whether things have been proved or not. But our preference, I think, is positive on alcohol beverage industries. We have done a lot of detailed work from a ground level perspective. And I think global TAM is very big from an industry perspective. And the white spirit space, which most of them are in, I think will be a decent growth opportunity from an overall perspective in the next 5 to 10 years. So I think whenever market gives you that opportunity, I think we should look at. But valuations today are not so cheap. Let me be very, very upfront with you guys that today valuations are prohibitive because people also know the long runway of growth. So whenever any state subject problem happens, like the way it happened in Maharashtra, for example, I think those will be the opportunity to buy some high quality franchise in this space.
Pankaj, on that point of 18 to 30-year-olds consuming less alcohol, I can just tell you this, that all the hosts on Editors Roundtable are above that age band. So I think that supports your thesis of being very positive on the alcohol sector overall. Well, on that note, I guess it's a cheers, guys. It's time to say goodbye to Pankaj as well. Pankaj, thank you. Thank you so much for joining in.
Pankaj. Thank you.
Thank you. So, well, coffee for Nigel now, right?
Absolutely. Green tea.
Green tea and coffee.
All of 18 to 34.
All right. Well, thank you so much for being with us on this edition of Editors Roundtable. Many thanks for joining in. Stay tuned. Lots more coming up after the break.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Market at a one-month low ends in the red for the fourth consecutive week, marks its longest losing streak of the year so far. All major indices except banks and pharma end in the red for the week.
We were amongst the first to get into negotiations, and our discussions, our engagement is truly very, very significant.
Commerce Minister Piyush Goyal bats for preferential tariffs from the United States ahead of fresh round of talks next month. Says India was amongst the first to enter into negotiations with Washington. That's a CNBC exclusive. Days after ending the 5-year freeze on Chinese tourist visas, efforts are underway to speed up economics re-engagement with China. Government sources say India cannot avoid working with China since it hosts 60% of global electronics manufacturing. Calls for considering greater engagement and flexibility with China. That's a CNBC-TV18 exclusive. Rift within the Sona Comstar first family. Rani Kapoor, mother of late Sanjay Kapoor, writes a letter to the board seeking a deferment of the AGM that was scheduled today. Alleges she was made to sign documents under coercion. Hints that she is opposed to Sanjay's wife, Priya, being appointed to the Sona Comstar board. Claims that her son passed away in the United Kingdom under highly suspicious and unexplained circumstances.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
A stunning exchange between US President Trump and Fed Chair Jerome Powell as they spar on camera over the renovation costs of the central bank's headquarters. But Trump backs off from his threats of firing Powell even as he continues to pressure him to cut rates. At least 7 children killed in Rajasthan's Jhalawar after the roof of a government-run primary school collapses. 14 children injured in the dilapidated building. Prime Minister Modi expresses condolences. The monsoon session of Parliament remains paralysed for the 5th straight day as both houses get adjourned amid opposition protests. Lok Sabha Speaker Om Birla meets leaders of all parties to discuss the functioning of the House. Government agrees to opposition's demand for a debate on Operation Sindoor on Monday. More people die of starvation in Gaza as Israel continues to block food assistance. Canada's Prime Minister says the denial of humanitarian aid is a violation of international law. France recognizes the state of Palestine despite opposition from the US. And Prime Minister Modi arrives in Maldives as both nations attempt to reset bilateral relationship after a diplomatic row. He is the first foreign head of state to visit the Maldives during President Mohamed Muizzu's tenure. Right, let's start with today's market action. Market ends at a one-month low with Nifty ending below the 24,900 mark. IT stocks remained a major drag for the market, largely led by weak earnings for the week. Market slipped for the 4th straight week, making this the longest streak this year. Sensex and Nifty slipped 0.5% each, while Nifty Bank gained 0.5%. Prashant Nair joins us with all the market action. Prashant.
Well, it sort of ended the way it started, right? I mean, there was little hope, sporadically maybe intraday, but in a sustained way, the market didn't really at any point during the week give an indication that it was ready to recover and sort of move higher. So it was a slow drift down. And actually, if anything, the broader market space started to look poorer and poorer over Thursday and Friday when market breadth looked pretty bad. So the numbers for the week will come up on your screen. Not very much in the Nifty, actually. Just a 0.5% cut Friday to Friday. The Nifty Bank also around that much. The mid-cap index a little bit more, about 2%. And the small-cap index, as I said, the last 2 days made a difference there. 3.5% for the week, down on the small-cap index. I just looked at sectorally, right? Where did things lie? Real estate cracked. I mean, the index was down 5% through the course of this week. Of course, IT, and it was large cap first, then of course it became mid cap IT, and Friday was particularly bad as well. 4% cut on the Nifty IT index. Capital markets is a space of about 4% cut. And the oil and gas index, Reliance, of course, has been under a bit of pressure. 3.5% is a heavyweight as far as that space goes. Now, large caps, and where do we see strength? It was, of course, Eternal, Zomato, which was up 21% this week. There was Cipla. I mean, actually, look at this, right? I mean, Eternal, the top gainer in the large cap pack for the week with a 21% gain. And then there is Cipla at 3.5%. So just tells you, ICICI Bank was up 3.5% this week as well, coming off, of course, the numbers which were reported over last weekend. Weakness in the large caps, Nestle, Trent and Reliance, 866 respectively. Those are the cuts that we saw on those three names.
Thank you, Prashant, for that. Union Commerce Minister Piyush Goyal has hailed the India-UK Free Trade Agreement as a win-win deal for both nations. The India-UK FTA will boost bilateral trade by $35 billion annually. The deal reduces the average tariff on UK products from 15% earlier to 3%. Meanwhile, India's labour-intensive sectors will benefit from zero duties in the UK. Indian fruits, vegetables and cereals will also get cheaper in the UK. Now, speaking with CNBC, Goyal also said that UK offers several high-value products which India can benefit from. The Commerce Minister added that both India and the UK are also eyeing to double bilateral trade by 2030.
Plethora of items which are uncompetitive to manufacture in UK today, which India can be a trusted supplier in your supply chains. Likewise, they're very high value medical devices, many products that the UK is known for, high value special medicines, where India can benefit from the UK story. UK also is a largely service-driven economy. Another area where we hope to expand our relations so that all in all, by 2030, we can double our trade.
It's got to be a win-win. You just can't take all and not give anything. I think it's been a great balance. On pure supply of goods, which is a trade block, I think in that the whole trade deal is very nicely balanced. And if I may hasten to add, perhaps more in favor of India.
And speaking of trade deals, Commerce Minister Piyush Goyal has also said that the Indian government is expecting a robust and a good deal with the US. Speaking with CNBC, Goyal added that India will eye preferential tariffs over its peers because it was one of the first countries to come to the negotiating table with the Trump administration.
I think it's a wonderful relationship that the United States and India share, a very special relationship. And I'm very confident we'll do a robust and good deal where both countries benefit and where businesses on both sides are happy. India will get a preferential tariff compared to our peers and our competitors because we were amongst the first to get into negotiations, and our discussions, our engagement is truly very, very significant.
I think India is gaining ground, and if EU was to happen in the coming months, I think one of the big US trade deal would have covered the globe. And I remain hopeful that despite some of the inseamers and curveballs that are coming from the US, Indian negotiators will be able to come to a balanced outcome there as well.
Right, moving on, India's manufacturing sector activity hit a 17-year high in July with the HSBC Flash Manufacturing PMI rising to 59.2. The surge indicates that rising demand drove a strong improvement in factory operations. The composite PMI output index, which tracks both manufacturing and services, reached 60.7 in July. This is the index's sharpest growth in over a year. Remember, a reading above 50 indicates expansion, while one below that suggests contraction. All right, moving on to a CNBC-TV18 exclusive. The Indian government may have to consider greater engagement and flexibility with China. We learned from government sources that India cannot avoid working with China since it hosts 60% of global electronics manufacturing. Sources have also indicated that the industry is hopeful of some breakthrough in imports of rare earth magnets. The foreign minister took up the issue during his meeting with Chinese Foreign Minister Wang Yi. This comes days after both nations ended the 5-year tourist visa freeze on one another. Ashmit Kumar joins us now with more. Ashmit, India and China, are the ties slowly thawing between the two countries?
Well, electronics industry is something that, in fact, has long been crying that, look, it's not just the auto space that's getting affected. Electronics players are also getting impacted due to these Chinese restrictions. Now, we raise these questions within the government, and what government officials are telling us is that given the size and scale of the electronics industry in China, there has to be some engagement, there has to be flexibility in terms of engaging with Chinese entities, with Chinese players. In fact, the government officials tell us is that overall, more than 60% globally of electronics manufacturing sits out of China, sits out of Beijing, and therefore engagement with Beijing cannot be avoided. Now, these statements coming out from government officials come on the back of three very interesting triggers. Well, number one, let's bear in mind that only as early as last night, we saw Dixon announcing that they have managed to get the government's blessings and the government's approval for a JV with a Chinese entity called Longcheer. So we're already seeing this engagement translate into action. Dixon already getting an approval from the government, from METI. Number two, bear in mind that only recently we've seen travel by the Indian foreign minister to China, and it is on the back of that we began to see relaxations like we did in the form of visas being allowed to Chinese tourists. So there is already some amount of thawing of ties, perhaps some amount of engagement that we're already beginning to see. And let's also not forget that at this time, with the industry reeling under the impact of restrictions from China, there is already solutions being worked out. METI is already in conversations with the Ministry of Electronics, with the Ministry of External Affairs. They're discussing how in aspects such as rare earth, perhaps entire components can be imported to beat the impact of rare earth restrictions.
Right, thank you, Ashmit, for that. Shifting focus to earnings now, shares of pharma major Cipla surged today in response to its first quarter earnings. The pharma giant reported an overall beat. However, revenue slightly missing the mark there due to muted India business. Net profit jumped over 10%, while revenue rose 4% on an annual basis. The company expects the India business to bounce back with a full year growth of 8 to 9%. Right, moving on, Bajaj Finserv's first quarter net profit surged 31% year-on-year. Revenue from operations in the quarter also rose 12.5% compared to last year. Now, gross written premium of its life insurance business rose 9% year-on-year. However, that figure fell 41% sequentially. Meanwhile, gross written premium from its general insurance business surged 20% compared to last quarter. ITC Chairman Sanjeev Puri has said that the company will invest 20,000 crore rupees over the medium term to expand its manufacturing footprint across sectors. Speaking at the company's AGM, Puri said that the company has already set up 8 new manufacturing facilities in recent years as part of its growth strategy. He added that the company will focus on a Bharat First to strengthen its domestic presence. The Enforcement Directorate has conducted raids on Anil Ambani-owned Reliance Group across multiple locations for the second day. The ED began its operations yesterday and searched 40 locations across Mumbai and Delhi as part of a money laundering probe. Sources have said that the ED has alleged that the company diverted public funds by cheating banks, claiming that they received information from various agencies, including SEBI. Shares of Indian Energy Exchange rebounded after a 28% fall yesterday, closing with gains of 12%. This after the power trading platform's first quarter net profit rose 25% year-on-year. Remember, the stock clocked its worst single-day fall yesterday after CERC approved the implementation of market coupling. The mechanism allows energy markets to create a single uniform price for electricity across different trading platforms. Speaking with CNBC-TV18, Joint MD Rohit Bajaj said that market coupling of real-time markets will be implemented at a later stage.
So, bit early days to comment on that, but let me quickly try to rephrase what is there in the order. So, CRC issued order for implementing of market coupling for day-ahead market on 23rd July, day before yesterday. And it talks about initiating the process of market coupling for day-ahead market. There are a few more elements in this order where they said that due to shorter time frame available for bid submission in real-time market, and also because of other operational complexities, coupling of real-time market will be considered at a later stage. So yes, there is going to be some impact on our business for sure. But if we see the whole thing, in the recent time, we have seen day-ahead market is not everything for us. There was a time when day-ahead market contribution in our total volume was 80-85%. But today, this number has come down to less than 35%.
All right, the big corporate story we are tracking. There's rift within the Sona Comstar First family. Rani Kapoor, mother of late Sanjay Kapoor, wrote a letter to the board urging them to defer company's annual general meeting hours before it was scheduled to take place. The Sona Comstar AGM was held this afternoon in a virtual setting. Rani Kapoor alleged that she was made to sign documents under coercion which she claimed are being misused to, and I quote her here, usurp her family legacy, end quote. In the letter, she hinted at being opposed to Sanjay's wife Priya being appointed to the Sona Comstar board. She also claimed that her son passed away in the United Kingdom under highly suspicious and unexplained circumstances. However, sources tell CNBC-TV18 that according to company documents, Priya Sachdev Kapoor has to act as the director of Sona Comstar in the absence of Sanjay Kapoor. Sources add that Priya is also the director of Oris Investments, the promoter entity which owns around 28% stake in Sona Comstar. We spoke with Rani Kapoor's counsel. This is what he told us.
So Mrs. Rani Kapoor was the sole beneficiary as far as the will of Mr. Surinder Kapoor, late Shri Surinder Kapoor is concerned, which is a registered will. You're aware that she's written a letter to the shareholders and the board of directors. She has put down on paper quite explicitly how things have transpired, how there are, serious apprehensions as far as she's concerned in terms of the circumstances leading to the death, what has unfolded immediately post that. As written in the letter as well, lots of suspicious circumstances have unfolded and are coming to light now. How various appointments were made, what the role of certain individuals that you have named in just right now, how did they come into being where they are, what were the documents which were signed, what was the manner in which they were brought about. All of these are matters which have to be looked into very carefully.
Right, at least 7 children were killed after a roof of a government school building collapsed in Rajasthan's Jhalawar. 14 children were injured in the incident. The school building was reportedly in a dilapidated condition and its structural quality was affected by heavy rainfall. News 18 India's Tarun Kumar Sharma is here with the latest.
राजस्थान के झालावाड़ जिले के लिए आज का दिन काला साबित हुआ है। जिले के मनोहर थाना उपखंड क्षेत्र के पिपलोदी गांव में आज एक खस्ताहाल स्कूल सरकारी स्कूल भवन की बिल्डिंग धर-धरा कर गिर गई। इस हादसे में मलबे में दबने से 7 बच्चों की मौत हुई है, जबकि 22 बच्चे घायल हैं। इन घायल बच्चों में से 11 बच्चों का झालावाड़ के मेडिकल कॉलेज अस्पताल में उपचार चल रहा है, तो बाकी बच्चों का मनोहर थाना के सरकारी अस्पताल में इलाज जारी है। सारे मामले में ग्रामीणों का कहना है कि सरकारी बिल्डिंग की हालत लंबे समय से खस्ता हाल थी। इसके लिए वे सरकार से बजट की भी मांग कर रहे थे। वहीं स्थानीय लोगों ने और जनप्रतिनिधियों ने भी सरकार से इसकी मरम्मत की मांग की थी। इसके बाद कई बार मरम्मत की मांग के बाद कुछ ही बजट इस स्कूल की मरम्मत के लिए मिला।
The US Federal Aviation Administration has said that the Air India plane crash was not due to mechanical failure in the fuel control system of the Boeing 787 aircraft. Speaking to reporters, FAA's new administrator, Brian Bedford, has confirmed that there was no inadvertent manipulation of fuel control switches. He added that the switch mechanisms were functioning normally and showed no signs of a failure. Prime Minister Modi landed in the Maldives for a 2-day official visit. He was greeted by President Muizzu with 2 other leaders who shared a warm hug on arrival. This is PM Modi's 3rd visit to the Maldives and the first by any foreign leader since Muizzu took over. Prime Minister Modi will be the guest of honour at the Maldives' 60th Independence Day celebrations on July 26th. Right, time for a short break. Coming up next, a stunning exchange between the US President and Fed Chair Jerome Powell as they spar on camera over the renovation costs of the central bank's headquarters. More on that when we return. Welcome back. You're watching Business 360. US President Trump and Fed Chair Jerome Powell sparred on camera over the renovation costs of the central bank's headquarters. The exchange happened during the president's visit to the US Federal Reserve. However, Trump backed off from his threats of firing Powell even as he continues to pressure him to cut rates.
So we're taking a look, and it looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building, is what that is. That's a third building.
Well,
including
no,
the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to take a look. We're going to see what's happening, and it's got a long way. Do you expect any more additional cost overruns?
Don't expect them. We're ready for them, but we have a little bit of a reserve that we may use, but no, we don't. We expect to be finished in 2027.
That keep going for another 8 months. Why not just fire them?
Because to do that is a big move, and I just don't think it's necessary. And I believe that he's going to do the right thing. I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing.
Jerome Powell is doing a commendable job in maintaining independence, quote unquote. That's the word coming in from the RBI governor, Sanjay Malhotra, when asked if he has any advice for his US counterpart. This comes amidst growing pressure from President Donald Trump to cut rates. Take a look.
I don't think he needs advice. I think he's doing a very good job. So,
okay, fantastic.
Maintaining the independence of the central bank is very important. I think he has done a commendable job. There was, some 40, 50 speakers, and Jay Powell was also there, and he spoke about, what he was doing about central bank independence. And out of everyone, he was the only one who got a roaring applause. No one else. So I think, he's doing a good job.
Palestinians continue to die of starvation in Gaza. The chief of the UN agency serving Palestinians said his staff are fainting from hunger. As per reports, at least 45 people have died of hunger in the last 4 days. Ukraine and Russia traded drone attacks after brief direct peace talks between the two sides in Istanbul failed to make any progress. Ukraine said that Russia launched 103 drones and 4 missiles during its overnight attack. Meanwhile, Russian authorities said 2 people were killed in an overnight Ukrainian drone strike on Sochi. Thailand and Cambodia have continued to exchange heavy fire for the second day. Thailand's acting Prime Minister has warned that fighting with Cambodia could develop into war. At least 15 people have been killed in Thailand, out of which 14 of them were civilians. According to the country's health ministry, 1 person has been reportedly killed in Cambodia. More than 1.5 lakh people have been displaced on both sides. Iran has agreed to restart technical level discussions on its nuclear program with the International Atomic Energy Agency. Iran and the United Nations nuclear watchdog will discuss how to restart inspections again. Tehran has said that the delegation will visit Iran but not to go to the nuclear sites. Pro wrestling legend Hulk Hogan, arguably the greatest WWE superstar of all time, has died at the age of 71. A vocal supporter of Donald Trump, he suffered a cardiac arrest at his home in Florida. Hogan, whose real name was Terry Bollea, was key in making professional wrestling a mainstream phenomenon in the 80s and 90s. A controversial personality and a pop icon, Hogan's career was dogged with allegations of drug abuse, racial slurs and sex tape scandal. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
Let's Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Have you ever felt as if you are running on a financial treadmill of sorts? By that I mean you work hard to earn adequate income, but then your expenses also keep shooting higher and higher, burning your finances. I call this the earn and burn syndrome. Yes, I've coined it myself. There's no such official term. But it's something that many in urban India seem to be feeling as of now. And that's exactly what we're addressing on the show today. How do we exit this syndrome and how do we move to a path that creates real assets and lasting wealth? Well, joining me to talk about this are two experts, two women who've watched the financial landscape, personal, financial planning landscape for a long, long time. I have Preeti Rathi Gupta, founder of Lakshmi, right here with me in the studios, and Rin Agrawal, who's a well-known financial educator. Ladies, thanks so much for joining in. So I want to get your first opening thoughts on whether you think this is a problem that affects only a very few, maybe young, or is this something that you come across a lot as well when you speak to, your catchment area, your clients and your circles? Preeti, let's open with you.
Absolutely. First of all, love the topic, the earn and burn syndrome, because that's what we see all around. And just like we were talking, Surabhi, I think the realization also that I'm earning and burning happens after a few years you've got into earning your money, right?
Yeah.
Because the first few years are normally spent in saying, okay, I've got money in my hands. How do I make the best of it?
Yeah.
The world doesn't make it easier because every morning you open Instagram and it's pushing something towards you, right?
Yeah.
And you are impulsive at that moment, right?
Yeah.
It's only when you get into your late 20s, early 30s that you realize, oh, now this is catching up. I can no longer keep pace with my spends. So absolutely. First of all, I think this topic by itself needs to be something that we teach in schools or have household, conversations on. Because the day you start earning is the day you start your journey towards your, what I call your financial map.
Yeah.
Right?
Yeah.
That's the starting point where
Yeah.
you say, okay, these are my financial goals, and therefore these are my money maps.
Yeah.
It's only when you know a destination that you know exactly how to get there. If you have no destination in mind,
Yeah.
then you obviously are saying, okay, I have the money, let's just spend it.
Money maps, I love that term. We need to find our individual money map, and no, you can't go to Google and ask for it. You have to sit down and do some homework on this, and that's what we'll get to in just a bit. But Rin, on that, you're based out of Bangalore. What do you hear around? I don't know if it's a Bombay specific thing because rentals are high here, housing costs are high, or whether you hear this among your community as well.
Absolutely, Surabhi. And I think this is playing out in the numbers as well that we are seeing on household savings, right? Where household savings as a percent GDP is at its lowest, whereas the liabilities are just moving, household debt is moving up and up and up. So yes, very, very common for people to be saving less than 10% of their income. In fact, I see a lot of early wage access companies, which are also coming up, and, good amount of demand from people to actually take a loan against their wages. So, this is where the situation is that there is absolutely very, very little focus on savings at this point in time.
Imagine us saying that. And I'm not saying that, the experts are saying that, and we were such a savings-driven economy, but so much has perhaps changed in the last 2 decades or so. Okay, let's kickstart this with a question that one of our younger viewers sent in to us. Isha is now joining us on the phone line, and I think her query really symbolizes what a lot of people are feeling or expressing or going through, especially in urban India. Isha, so glad that you can join us on the show. Tell us, what is exactly your question?
Hi, I'm Isha. I'm 24 years old and I currently live in Mumbai. Every time I get a hike, my spending seems to outpace my earnings. Now, how do I break the cycle?
Okay, there you go. Sums up exactly what we're trying to discuss over here. So let's start with the beginning, with the problem itself. How do you look at it, Preeti? This facet, is it just about we're spending too much, or is it intrinsically our behavioral problem, or is there something more to it?
I think, like I said, once we start earning, there is a lot of pressure, whether it is the financial world, which is selling us credit cards or saying, buy now, pay later, or just, the access to money or to sort of postpone your spending is just so high, right? Which is why people feel that, okay, this is the great time for me to buy this. This is a great time for me to spend here. So your lifestyle takes over more pragmatic goals. And I think to Isha's query, you know, the best way to do this is really sit down. It takes you about half an hour to say, okay, these are my financial goals. This is what I want to do. You're 24, you may want to study more, you may want to start your own business, you may, irrespective, whatever, right? But there are 2 or 3 important financial goals, which are your emergency fund, start creating it, build your safety nets, because those are very important. I think one of the things that a lot of people don't do, and actually which can dent your savings and investments, could be not having the right insurance. Look at tax breaks efficiently, because you're starting earning. Ask the right questions, you know. When you're renting, for example, we spoke about how costly it is to rent a house in Bombay. Can you actually look at how paying a rent could actually be, you know, it could be used to save tax for you. So look at all of that, and most importantly, start working on your retirement. And I think once you have, sometimes when we don't have a financial goal, I tell young women that, you know, if you saved 5,000 rupees every month for 40 years, you would actually have 7-8 crores by the time you retire, right? Sometimes just having that big number and then saying, how do I work towards it, right? So I think financial goals, financial mapping, and then budgeting very effectively. Once you know the destination, it'll encourage you to budget, right? Then you say, okay, I know that I have to save. There is a golden rule of budgeting, which is proven that if you follow that, you will get to where you want to go, right? Which is at least put aside 20%. Of your earnings when you begin, especially at Isha's age, to start putting aside 20% as your savings and investment, and do it before spending. What most of us do is we spend, and then we say, okay, whatever's left behind, maybe I'll think of saving, right? And that also rarely happens at this age. So, you know, I've automized, and I really suggest this, that instead of making it a chore, automize your saving and investment process by just mandating your bank that 20% of all my earnings that come in will go into an investment instrument. And then you sort of are able to spend with less guilt, because you know that my savings have already gone.
That's an interesting idea, just automate it. So whatever hits your bank, or if you're a salaried person, whatever hits your bank on the 1st or the 2nd of the month, 20% just goes out. Maybe in a different, you know, maybe in an investment product or a savings account or whatever, something else. It's just not there for you to spend. That could be an interesting aspect. What you've mentioned, Preeti, is very interesting. So you're saying at least 20% of your income must go towards savings and investment. Actually, we have a query from another viewer on precisely this. Let me take that up and we'll ask Bryn about it as well. This is Bala. And he wrote into us on Instagram. You can, of course, reach out to us, to me specifically, or you can any of our channel handles as well on Instagram with your question. He's saying, what is the best method or rule to ensure savings? So we've just heard from Preeti. She's given her basic rule of thumb, at least 20%. Mrin, come in on this. I think this is a bare basic beginning. I have to divide between how much I can spend and how much I need to invest or save. What's your math or formula to this?
So I think the first thing is to always remember that savings is always the foundation of your financial life. And unless you have a good amount of savings, you know, you really cannot think of having a good financial life. So I think first is that realization that savings is really, really important, and it is not one of those old-fashioned things that used to happen in the past. Now, I have always propagated the 30-30-40 rule, which is 30% of your take-home going towards expenses, 30% going towards EMI. So that is like a maximum of 30% going for expenses, a maximum of 30% of take-home going towards loan repayments, and try to save 40% of your take-home. I know trying to save 40% of the take-home is a big ask, you know, given just large expenses like rent alone. But I think, you know, start with the 20-25% and have that goal, right? So I also truly believe that it's always important to think beyond, you know, what you're doing today, and really look at the larger picture and think big. And the only way that you can fire or, you know, have financial freedom it starts with actually having a good amount of savings. So while you can start with a 20-25%, your ultimate goal needs to be about 30 to 40% going towards savings. Now, on the discretionary expenses, because you see, we do see a large amount of the spending going towards non-essential expenses, which are not essential expenses, right? So I think, within the whole expenses gamut, have a percentage that you're going to keep aside for non-essential expenses, which is your fun expenses. It could be 10% of your take home. It really depends. But, somewhere it's like your physical health, right? So if you know that you have to remain fit and there are a set of things that you need to do, as much as you would like to, have your fun, but you know that you have to have it in limits. So it's the same thing with money. Have these basic numbers in mind, saying maybe 10% going towards fun expenses, 20% for essential expenses, 30% for low payments, and then the rest of it for saving.
Mrind, I think the question is, I think you raise a great point, at least thematically having a division in our heads of what is essential, what is non-essential. Though people will ask these days, right? I want a new sneaker. Is that essential, non-essential? I want to upgrade to a better gym. Is that essential or non-essential? So I think these lines, Preeti, especially, and that's what we're grappling with, right? They're really blurring in terms of what is essential, what do I deserve? I deserve this, I should upgrade to, whatever, a better bag or something like that. That's why we get really confused.
No, I think first of all, let me lay it out that financial planning or planning for your future doesn't have to be boring, right? It doesn't have to be a drab conversation. You have to have fun with yourself doing it, right? And one of the things that we do is that apart from automizing, saying just automate it.
Yeah.
So you've put aside money for your savings. Make sure that those savings are going into inflation-beating instruments, growth instruments, because you are young. This money definitely needs to grow. You don't want to save and then realize, oh my God, I lost. Anyways, that money is depreciated, right? So I think that is the first thing. Second, I also believe this conversation between needs and wants. There's a very difficult line, and all of us are guilty, right? So therefore, having broadly a budgeting tool, right? Let's automate that also. There are a lot of budgeting tools that are available. Use that to say, okay, these are my limits, right? And then once in a while, it's okay to allow yourself those limits, but I think a tool will highlight to you how many times you've, stepped over that budget. And I think one of the things that people should do, which I feel we don't do enough, is have these money conversations. Because why do you need a new pair of sneakers? Why do you need a new handbag? Is because that's what you're talking about. Right? I mean, I sit with my friends, we're talking about, okay, where do we go for a holiday, or what is the bag that you buy? Why don't we have conversations around saying, what are you doing with your investments? How much have you saved? So have those conversations. I think make it more fun. Gamify it for yourself. Compete with yourself every month. Have I saved a little bit more? And the second thing, I think, again, to our viewer Isha's question, is that every time your salary or your package gets upgraded, the first thing to do is to upgrade your investment.
We upgrade a lifestyle first.
Yeah, but we upgrade our lifestyle first, right? Now I've got more money to spend. So instead of that 20%, I think, how can you upgrade that? How can you increase that percentage?
Investment part of it.
I think take care of that piece first. So then you don't feel guilty about living your life in the today.
I think it's a great way to go about it, that the way you can strike that balance is just think investments first and then think fun and spends and all of that. I'm completely with you ladies on it. So what we'll do is, after the break, we pivot this conversation to the investment side, and the question, the toss between taking a loan to fund an expense versus saving for it, investing for it, and then funding that expense. How do you get the right balance? We'll discuss this after the break.
Let's talk money. talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are talking about how to escape this earn and burn syndrome, which affects all of us living in urban India. How do we break beyond forever chasing rising expenses and move to real long-term wealth creation? Well, we've discussed how obviously budgeting and cutting back on unnecessary expenses is the first step towards it. The second step is getting smarter with your borrowings and your loans and asking the right questions every time you're heading to the bank to take a loan. Rin, let me open with you because I know you've run some numbers on this in terms of how EMIs can either contribute positively to asset and wealth creation or contribute negatively and take us away from our goals. So what's the framework with which we can look at it?
Yeah. So let's take this example of a person, let's say, earning 55 lakhs. So, the net take home would be somewhere about 36 lakhs. Let's just assume some nice round numbers of saying that a person has a net take home of about 3 lakhs per month. Now, there are two ways to go about it. So typically what you will see is that with that sort of a take-home income, I have seen people having 50 to 70% going towards home loan EMIs, right? So I have taken one example where, let us say a person has taken a 1.5 crore home loan. They've done some down payment, so they've got 1.5 crore of home loan. The EMI on that actually works out around 1,40,000 rupees per month. And then, when you add up all the essential and the non-essential expenses, what you actually see is left over is only 10,000 rupees per month. So, just to give you an example of the percentage allocations, you will typically see about 30-35% going towards expenses. You have about 50% which is going towards the EMIs, and then you have about 17-18% that you're saving for other large expenses like vacation, right? So end of the day, what is typically happening is that you're left with 3% of money that's going towards expenses. Towards investment. And towards investments. And what is happening over here in this case is like when you look 20 years down the line, right, the interest that you've actually paid is far outstripping the interest that you're earning on your investments. And at the end of 20 years, and of course, you will have salary increases and stuff like that. But what happens is that when you have the salary increase, again, a very large portion goes towards, luxury expenses. And of course, you upgrade your lifestyle and everything, right? So end of the day, with this very large allocation to loans, you're actually ending in a negative territory. Now, the same thing, where I said live within your means, and let's say you try to follow the 30-30-40 that we are talking about, so just to give you an example, like, with this 3 lakhs take and with 10,000 rupees going into investments, at the end of 20 years, you're ending up negative 1.5 crores. Of course, you have the house, the asset in your name, you're probably living in it, right? On the other hand, if you actually had 30% going towards investments and taking into account the home loan, you would actually end up with 17.5 crores at the end of 20 years, right? So that difference of having that 30% going towards investments.
It's all a toss of the coin. I mean, really what you want to do. And, we're running out of time, but really, weigh in on this. This choice of how much a loan to take, should you take it for an asset only like a home? Should you take it for other expenses? Say you want to fund a holiday. You get loans for everything in the market today.
Sure.
Again, a loan can be your friend. It can also be your worst enemy. What is your approach to taking on borrowings?
Absolutely. I think loan is a double-edged sword.
Yeah.
You've got to use it. In fact, you can use it very wisely for your financial planning, right? I think, first of all, you have to ensure, like I said, when you budget, you say, okay, maybe 15% to 20% of my earnings will go into EMIs. Once you put a cap there, I think it helps you understand affordability, right? Now, when I say affordability, it also means what is the right time to buy a home, right? And what is the home that I can afford? For example, I do choose at 27 to buy a home. Can I afford a home in like the, in Worli, or should I buy it slightly further away. And what does that do to my finances? I have a very classic example of a couple who actually moved from renting in Parel to, Kharghar. They bought a home because the pressure to buy a home was so large, and it was a little early in their career. Now, what they landed up doing is taking an EMI, which put a pressure on their lifestyle. They started living very far away, so their, travel expenses, commute, all of that increased. So I think first put a cap. Take loans only. There are good loans and bad loans. The good loans means typically where you are paying interest lower than what your money otherwise would earn you in a fixed deposit, for example, right? So a home loan, a car loan. But does that mean, when do I buy a home? When do I buy a car? Is when I can keep that EMI within, 10 to 15% of my outflow. That will help you make a decision on what kind of loan, for what do I take it. When it comes to, I think, loans for holidays, there's a new category, loans for weddings, right? I think all of these, to me, is what we bucket under the not so good loans. These are typically loans that are not going to increase, your productivity or your asset, etc. So therefore, think very, very deeply when you take these loans. Again, if they are between your 10 to 15%, you can still consider it. But holiday, wants, bag, consumer products, wedding lehenga, all of these, save, plan for it. I think you'll enjoy it a lot more. And that's the right way to sort of look at credit and loans.
You want the glow to last. You don't want it to fade with the thought of, oh my God, I have to pay all these EMIs.
Well, I tell young women that, you'll buy a lehenga, but, you'll be paying EMIs, and this day and this age, you don't even know whether the wedding will last, but your EMI will last. Be very, very careful about it.
Absolutely. Okay, ladies, this is a fantastic one. Just very quickly, last 10 seconds left. So, Mrin, let's recap the rules and those percentages which help us budget better and live within our means. Go on.
Yeah, so 30-30-40, which is 30% going towards expenses, 30% going towards EMIs, and 40% going towards savings. And I think, as long as we are very clear that we are kind of doing this on, a regular basis, I think, it should be good. Of course, automating investments goes a big way in ensuring that the money is not spent on anything else. And I think this whole question of, should I buy a sneaker or should I upgrade? I think as long as it fits between, in these numbers, I think it's okay to do
40. Got that. So 30-30-40 is Mrin's rule. Preeti is a little more lenient. She's saying, okay, at least 20% should be investment, if not 40. Final advice, Preeti, from you.
So I think that's where it is. First, draw out your financial maps, right? I think keep that, because sometimes it always helps to have that larger goal in mind when you're saving. Otherwise, saving can become very daunting, and it can be something you deprioritize. So keep that. To me, I think keep it easier. Begin with 20%, automating the rest of the money. You decide how you want to spend it, as long as you keep your EMI bucket between the 10 to 15%, right? And of course, as your career grows, upgrade that 20% to maybe 25, 30, because your liabilities will grow, your expenses will grow, and it'll be very easy to move money from the savings bucket to the spend bucket. So I would want people to keep it really simple and not make it too complicated. Just say, okay, every time I begin with 20, every time I earn more, I upgrade my investing, and I keep my EMI bucket to 10 to 15%. Yes, in places like Mumbai, or when you're buying a house, it could go up to as much as 30%, but that should be your cap and not beyond.
Not more than 30%. Got it. Very, very helpful rules. I think we all need to keep this math at the back of our heads as we go about planning our investment savings and, of course, our spends. Ladies, thanks very much. Very, very enlightening conversation. And viewers, we'd love to know your feedback, what you think about it, and whether you're willing to follow some of these rules. So keep writing into us. And of course, we'll see you same time, same place, with another financial conversation next week.
Let's talk money.
India's electric vehicle revolution is no longer a distant dream. Yes, the EV story is picking up serious momentum. From just 0.7% of motor vehicle sales in 2020 to over 6% in 2024. In fact, in 2024, the EV penetration had reached 7.8%. EV adoption has clearly shifted gears. Nearly 5 million electric vehicles are now on Indian roads. In FY25 alone, we saw over 2 million electric vehicle sales. That's right, the Indian government has set an ambitious goal to make 30% of all passenger vehicle sales electric by 2030. This is an important goal that the Indian government has. It has also provided policy support in the form of the FAME scheme, and now you have the 10,900 crore rupee PM E-Drive scheme to boost domestic electric vehicle adoption and manufacturing. India is also eyeing a larger role in the global mobility race. From sealing major FTAs like the one with the United Kingdom to negotiating tariff deals and tariff reduction agreements with the United States to enhance market access. Hello and welcome. I'm Parikshit Luthra, and you're joining us in our brand new series, our show called Charging Up India's EV Journey, in collaboration with the Mahindra Group, where we put the spotlight on where we are in India's journey right now, how do we compare to global examples, and what more does India need to do in terms of reaching its 2030 goals. Joining us is Pavan Goenka, an industry veteran. He is the former managing director of the Mahindra Group, former president of the Society of Indian Automobile Manufacturers. He spent 3 decades at the Mahindra Group. Thank you very much, Dr. Goenka, for joining us. Let me begin by asking you about where we are in our EV story right now. 7.8%. Do you think more could have happened? And where can we realistically reach by 2030? The reason why I ask you this question, because China today is already at 25%, Europe is at 15.5%, US is at 8%. And by 2035, we're expecting China to reach 52% EV penetration.
Thank you, Parikshit, for having me on this show. It's always a pleasure to talk to you, whether it's a space or automotive. So to also clarify that I just realized this show is sponsored by Mahindra, and there's no connection in me being here as your first guest and Mahindra, just a coincidence. And as you know that I have been sort of an EV proponent for the longest time, starting in 2010. So it's been 15 years that I have been watching the EV story evolve in India. And I think now we can confidently say that we are in the fast lane. I don't think there's any doubt about that. Yes, of course, there are some hiccups like the rare earth metal situation that we have right now. But leaving that aside, we are definitely in the fast lane now. If you look at the first quarter, and as you have talked about in the preamble to the show, we have now reached a penetration of more than 4% in the passenger vehicle segment. Three-wheelers have always been doing very well, more than 60%. Two-wheelers are also grown quite rapidly now, reaching a high single-digit percentage. So overall, I think the momentum is picking up, and there are several reasons for that we'll talk about. But yes, today I feel very, very positive that the Indian EV movement, though it took a long time, much longer than anyone had anticipated, certainly much longer than I had anticipated, but now I think we're getting there.
Right. How do you feel about the India-UK FTA? Automobiles, for the first time, the tariff there has been reduced by the Indian government, but not immediately. It's going to happen in a graded manner over a 10-year period. You have quotas for ICE vehicles, especially luxury vehicles, high-capacity engines, and also for EVs only after 6 years of the free trade agreement, and that too, electric vehicles which cost upwards of £40,000 and £80,000. So do you feel that this also gives enough time to the domestic EV industry, homegrown EV makers like Tata Motors, the Mahindra Group, Maruti Suzuki, all of them, time to grow their domestic footprint?
See, I have not read the fine print on the UK FTA, But clearly the first time ever that Indian government has given relaxation on import duty for CBU import of any kind of vehicles, coming down to 10% at a point of time. In fact, there are two events that have happened lately. One is the FTA signing that happened yesterday, and second is the launch of Tesla Model Y that happened last week. And both of these events will have a positive impact on the EV movement in India, and we can talk about that. But I don't think that the homegrown manufacturers need to be too concerned about it. If anything, it's going to be a positive rub-off because it's going to bring in more awareness and more visibility to electric vehicles. And when people start realizing how far the Mahindras and Tatas have come in electric vehicle technology and the product and the aesthetics of the vehicle, they would perhaps be looking at these vehicles even more. And if I see what is coming out in the last 6 months, I think 5 new models have been launched in the 6 months. And the 3 companies, India, Tata, Mahindra, and MG, have, I think, 95% of the total passenger vehicle market share in electric vehicles, and for a reason. They are putting out products, very good products that the consumers are liking. And there are many other reasons also why consumers are now taking to the EVs. I would say 2 of those which have been concerned for longest time, and something that I have talked about several times in the past. Number one, the range anxiety. And now getting 500-kilometer range is a breeze. Everyone is offering that range. I have traveled in my electric vehicle from Mumbai to Pune and back without having to worry about recharging on the way. Second is the lifetime warranty that some of the makers are offering on the battery, which takes away a concern as to what will happen when I have to replace the battery. And third is number of models that are coming out. And none of these models are compromised in any way, shape, or form. They're as good as ICE engine model in terms of features, the looks, the digital technology that's gone into them. And since the time I bought my EV, I have not gotten into any other car.
Right. But Dr. Goenka, don't you also believe that while we are chasing a domestic market share, shouldn't we also be targeting EV exports, considering electric vehicles are at still a nascent stage in the world? EV adoption is still lower compared to ICE in most geographies, except for China and Norway for that matter. Don't you think India should be leveraging the export opportunity? What's really the hurdle when it comes to growing our export footprint of future vehicles, futuristic vehicles, electric vehicles for that matter?
Parikshit, see, everything has the right time. And if you start trying to export before we're ready, we will fail and then we may not be able to recover. If we look at where we were 2 years ago in terms of products that were available in India, I would not say those were export-worthy products for export market. Just like for ICE engine vehicles, if you were to go back 10 years ago, we didn't have export-worthy products in India. Now we do. Now we can go to any country with the products that we make in ICE engine in India and compete anywhere. Same thing will be happening in electric vehicle, is beginning to happen now. The models that have been launched in the last 3-4 months from Mahindra, from Tata, from MG for that matter, and of course all the others which are basically coming as a CBU or some SKD form. These are models that can easily be exported. And I'm sure that the companies now will be looking at how to start exporting. But right now, I think the focus is to build the domestic market. And until we have a scale in the domestic market, just to make few vehicles for exporting to few countries will not be business-wise viable. So I think they're doing the right thing by first getting out the right products at the right price with the right range. Range is very important for electric vehicle. Getting a scale, getting the cost in check, and then start exporting. So export would definitely happen. I don't know what the numbers of export today are. Exports will definitely happen, but I'm not going to be too much in a hurry to start jumping onto the export bandwagon. And I would like to see the domestic situation come fully under control. The domestic customers become very comfortable with electric vehicles, which is beginning to happen. And then we can export in a big way. The products that are coming out right now,
I would
extremely well in export.
All right. I would also like to ask you about this debate between electric vehicles and hybrids. Now, the industry is divided over it. Many believe that hybrids will eventually help us reach our carbon emission goals. Some believe electric vehicles are the right way. Do you believe that government should be supporting both technologies, or we should be only focused on electric vehicles?
Well, Prakshit, my view in this has not changed in the last 10 years. I will say the same thing. If you check my interview 10 years ago on whichever channel or publication, I would have said the same thing 10 years ago. Hybrid, the reason we are looking at electric vehicle in India are twofold. Number one, to reduce our dependence on imported oil. And number two, to make our cities clean in terms of tailpipe emission. Electric vehicle do both of them because zero oil import and zero tailpipe emission. Hybrids are not a solution that give us a perfect 0-0. Thus, they improve on the petrol consumption, but they do not make it anywhere near zero. Therefore, I do not see the hybrid vehicles, even strong hybrids, as the solution to the problem that we are trying to solve. Of course, they're better than non-hybrid. There's no doubt about it. Okay, but they're not solving the problem that we're trying to solve. To some extent, plug-in hybrids do. And I'm beginning to look at plug-in hybrids as a potential sort of parallel solution, parallel to electric vehicles, but not strong hybrids because they don't solve that problem. So the way I would like to see things progress is that ICE engine vehicles should mature to hybrid vehicles and not remain just simply non-hybrid ICE engine. But the government thrust has to be for supporting electric vehicles and perhaps plug-in hybrid vehicles with enough guardrails defined so that plug-in hybrids do not become a backdoor entry for a strong hybrid. That has been my view 10 years ago, 5 years ago, 2 years ago, 1 year ago, and today.
Okay, thank you so much, Dr. Goenka, for joining us with your views as an industry veteran, telling us about where we are in our EV journey and what will it take for India to be a leader in electric vehicles as well. We're taking a short break, but don't go anywhere. When we return, we will be joined by industry stalwarts to discuss what kind of supply chain readiness does India need to show, especially in light of restrictions on rare earth magnets. We've seen shortage of semiconductors post-COVID-19, so the supply chain can be disrupted anytime. How should we be future ready? We'll be right back. Welcome back. Despite the growing adoption, the industry is going through a lot of challenges in terms of supply chains. We have seen how restrictions on rare earth magnets by China have really disrupted electric vehicle production, and some automakers are actually staring at production stops in the month of August. So how does India overcome these challenges in the long term? How do we build up Atmanirbharta. Let me now go across to our special panel of industry stalwarts. We've got Nishant Arya with us. We've got Rajiv Chaba, and Anandya Deb is also joining us. Let me go across to Nishant Arya first. Nishant, thank you very much for being with us. What's the kind of disruption you're seeing because of this supply chain issue related to rare earth magnets, and how are you overcoming this?
So we had been working with our suppliers actually even after COVID to really see that how could we de-risk our supply chains and have more resilient supply chains where we were sourcing from different countries. So we had been able to address this problem in a bigger manner than what we had envisaged, where we were sourcing from multiple regions in Asia initially.
Right, and we are getting some positive noises when it comes to the Ministry of External Affairs after the meeting between Subramaniam Jaishankar and Chinese Foreign Minister Wang Yi in Beijing on the 14th of this month. Rajiv Chaba, if I can come to you, what would be your view on this? Is this now an opportunity for India, the automotive industry, to get stronger? It is a moment of reckoning, of course, for many with these disruptions due to rare earth magnets.
Is it better?
Mr. Chaba, if you can hear us, do you believe this is a moment for the automotive industry in India to rise up to the occasion, look for self-reliance? We should see this rare earth restriction as an opportunity to innovate and grow faster?
Yeah, hi. Can you hear me? Can you hear me?
Yes, Mr. Chaba.
Yeah, hi. I think so. You know, in fact, we had a meeting with the minister and other relevant authorities few weeks back in which we talked exactly on the same issue and said that in short term, in the next few months, we may have a problem. But if suppose we handle this issue from a long-term perspective, definitely as a country, as an industry, we are going to be in a stronger position. So yeah, there is a threat at this point of time for short-term production halts. But in the long run, I think it provides us a very good opportunity.
Right. Anandya Deb, what do you believe that India now needs to do in order to be more self-reliant when it comes to electric vehicles and have a domestic supply chain? What all do we need to focus on, according to you?
Yes. So actually, I would say that some efforts are already going on in this direction to find alternatives to this, say, permanent magnet-based motors. And but I feel that, you know, economy and profitability, so these things tend to drive a lot, you know, industrial considerations. On the other hand, these things take a little bit of more time when we try to develop things on our own. But one very positive thing that I have seen in the recent past is that startups are actually trying to develop motors such as switched reluctance motors and then synchronous reluctance motors. So these are the motors where actually you do not need these rare earth type materials at all because they don't have permanent magnets. On the other hand, you know, these need to be nurtured more, these need to be tested, tried out, and then they have to be actually put in the vehicles for trial. So here I feel that these smaller companies which are actually more savvy towards trying out new things and are willing to take more risks should be supported, and they should work. I mean, government is already supporting them, but then investors and others should also rise to the occasion, and they have to work in conjunction with the OEMs to make these things a reality. And even there are other types of conventional motors such as the three-phase induction motors and AC synchronous motors. So people have almost like written them off just because they are somewhat less efficient as compared to the motors that we are actually using today, driven by, you know, foreign countries like China, for example. So I think, you know, we have to work very hard and we have to put a lot of efforts ourselves to come up with, you know, technologies, grassroots technologies of our own. And then I'm sure we have all the talent, we have all the resources, we have to just work together and make this happen. And I'm sure that it will happen. because now there is a lot of energy and lot of motivation that has been created by the various initiatives that the government has launched. And also we are seeing companies such as Mahindra and Mahindra, Tata Motors, etc. So they have already shown that our electric vehicles can do very well. And another thing that I would like to point out to you here is the growth that is being propelled by the two-wheeler and three-wheeler segments. So we have actually in 2024, more than 2 million vehicles were electric vehicles were sold in India. And much of this has been due to these electric two-wheelers and three-wheelers. So in combination, they have actually accounted for more than 1.5 million sales of electric vehicles. So we have to actually also concentrate, in my opinion, on affordable, compact four-wheelers. And that I feel is lacking currently, and which is kind of stifling our, adoption of more electric vehicles in the Indian market. And this is one thing that, again, I was seeing, and while I was comparing with some data, globally, and I was very surprised to see that in China, they are having electric vehicles which are much less costlier as compared to ICE-based vehicles. So I think that is also another great opportunity.
Right.
So our established OEMs can do a great job, I think, because we had in the past vehicles like, say, Mahindra E2O, Reva, Mahindra Bijli. We also have vehicles like Tata Tiago. So all these things I can propel the growth, and in this segment also, where vehicles are to some extent lacking in terms of affordability. And even startups should be encouraged, in my opinion.
All right. Let me go. Right. I'm going to come back to you, Mr. Deb. Let me go talk to Rajiv Chaba once again. Mr. Chaba, when it comes to electric vehicle sales, what kind of percentage and adoption are we likely to see in FY26? Where are we likely to reach in terms of EV penetration, according to you?
Yeah, so, last year, the industry in passenger vehicle segment, we were about 2.5%. This year, I think is going to be anywhere between 4 and 5%. Already, we are seeing approximately 12 to 13,000 cars every month. So we would end up at 150,000 approximately, which means a growth of almost 50% over last year, which it depends how you look at it. Some guys were thinking probably it will double. So it's not doubling, but it's almost 50% growth. So, so growth, I would say, is pretty good. And by this rate, I think we'll end up at about 20-25% by 2030. So coming to one point which, one guest is offering, I would say in EV, the three things are important on the product side: the product, proportion of the car, and the pricing. And I think you need to get it right. So product, proportions, and pricing, if you get it right and you're in the sweet spot, the way MG Windsor has become at this point of time, I think you will see more adoption. Obviously, there are some other issues about education, battery life, and the charging thing. But I think this three P's, I think, need to be need to get right for more adoption, I guess.
Right. Let me go across to Nishant Arya once again. Nishant, what more do you think the government needs to do at this stage in order to support OEMs, both localize and find markets abroad?
I think ensuring that electric vehicles become an integral part of the free trade agreements being negotiated with different countries is very essential to gain scale and competitiveness. On the other hand, when the government has launched the R&D DLI, where they have put 1 lakh crores, I think a large chunk should go to EV industry and the EV ecosystem, where the huge investments should be made in India for proprietary IP and designs and engineering. Thirdly, there is a huge opportunity to see today that the kind of skilling challenges which we face in the industry because of dearth of people available, I think similar initiatives need to be taken where rapid skilling initiatives can be taken for people to really be available as per the growing markets. And fourthly, I think clear roadmap of deployment and mandates which can come for heritage sites, for tourist spots, and for many such areas which can be totally zero emission and green zones could be a big game changer going forward, where they are promoting Indian companies to deploy vehicles not only in India, but promoting these concepts across the board.
All right, we've run out of time, but thank you very much, Rajiv Chaba, Anindya Dev, and Nishant Arya for joining us on the program, Charging Up India's EV Journey.
When he embarked upon this journey sometime in 2022, nobody would have thought that it will come to such a comprehensive economic trade agreement, So first up to the Commerce and Industries Minister, hearty congratulations to you and your team on this deal where Prime Minister Starmer has said that this is the biggest and the most comprehensive deal post-Brexit that the UK has entered into. So, खुश तो बहुत होंगे आप?
बहुत खुश है और in a way it vindicates what Prime Minister Narendra Modi had said way back in 2015 when he came to London and addressed a huge crowd at Wembley. He said, we may be two nations, but we share a glorious future. And मैं समझता हूँ कि वास्तव में प्रधानमंत्री मोदी जी की जो दूरदृष्टता है, जिस प्रकार से उन्होंने भारत को अब साझेदार बनाया है विकसित देशों का, जिससे हमारी मानसिकता भी विकसित बने, जिससे हम भी सोचे अच्छी चीजों की, बड़ी चीजों की, छोटा ना सोचे. तो मैं समझता हूँ ये जो पूरा बदलाव आया है भारत में, ये मोदी जी की सबसे बड़ी ताकत है, देन है देश के लिए, और भारत का भविष्य उज्जवल है.
But it's not a free trade agreement. It's a CETA because there are certain sectors that you have protected for Bharat. And which are those sectors? And let's try and put that out. When it comes to produce, so apple growers and then there are
all these sensitive sectors. For example, dairy is not.
Yeah, dairy.
No rice, no sugar, no apples. Every country, you have to look at the strengths of the country. See what are your offensive interests, कि आपको क्या market access चाहिए, and what are your defensive interests, कहाँ पे आपको खोलना नहीं है या बचना है. वैसे ही दूसरी तरफ के भी दोनों होते हैं.
Right.
एक अच्छी बात जो माननीय प्रधानमंत्री नरेंद्र मोदी जी ने मुझे सिखाई है कि सेंसिटिव रहो दूसरे के प्रति, तो वो भी आपके प्रति सेंसिटिव रहेगा. और एक प्रकार से वो हमारी आज के दिन नेगोशिएशन में सबसे बड़ी ताकत वो है कि दोनों देश शुरू में ही तय कर लेते हैं कि एक दूसरे के सेंसिटिव सेक्टर्स को हम रिस्पेक्ट करेंगे, प्रोटेक्ट करेंगे. जैसे ही आप वो शुरुआत वहां से करो तो आगे का रास्ता बड़ा ही स्मूथ हो जाता है.
You've engaged with the conservatives, you've engaged with the labor leaders. The conservatives feel this deal was inked a year ago, and the labor is eating getting the cake and having the last laugh. How would you look at that?
But I would like to say it's interesting to see the bipartisan support that this deal had from both parties. The Conservatives were in government. Mr. Rishi Sunak was Prime Minister.
Yeah.
About a year and a half ago, my current counterpart, Jonathan Reynolds, who was then the shadow
minister.
Trade Minister, along with the then shadow Foreign Minister, David Lammy, both were in India. They were having dinner somewhere. And I got a call that they would like to meet me. I was busy in office, so I was getting late. So finally, I was able to meet them at about 11 or 11:30 in the night when I invited them home for coffee and dessert. So much so that Mr. David Lammy must have been tired with the time change and all. He was almost sleeping on my sofa. But Jonathan was up and about. And you know what Jonathan told me that time? He said, look, we encourage you to finish the deal, finalize it with the then government. But if you do it, we will come into power after the election. They were so confident. And we will approve it in Parliament. But should you not succeed, I assure you, we will accept whatever is decided between the two governments. We'll build upon it and we'll finalize the agreement. You have our assurance that we want to do a deal. And they put it in their manifesto. To do a deal with India. And he became the trade minister, and today he has delivered. My compliments to him and to Prime Minister Starmer. But clearly the kind of guidance, the kind of support, the empowerment that Prime Minister Modi gives you when you're negotiating or when you're doing any such work is phenomenal.
So Bharat and Britain have shown the art of the deal. So is there a message going somewhere?
Well, the message is clearly for the people and business persons of both countries. Because a deal can only be stuck when it's a win-win for both parties. कभी भी जीवन में एक तरफा सौदा नहीं होता है. मूल दोनों का एक दूसरे को सही दाम मिले तभी सौदा हो सकता है. And this particular deal is a win-win. Both countries are stakeholders, our businesses, our farmers, our small and medium enterprises, our startups, our workers, everybody stands to benefit. And a very balanced deal, fair, equitable, gives preferential access for areas of our interest in UK, gives them an opportunity to do more business in areas of their interest. But we don't compete with each other. We complement each other. A $50,000 per capita economy cannot produce the kind of goods we want to sell to them. Textiles, footwear, toys, furniture, leather products, food processing or processed foods, agricultural products processed, auto parts, aircraft parts, the engineering stuff, gem and jewelry, intricate jewelry. There's so many things. They just can't compete.
Right.
We can't make the kind of high-flying medical devices, for example, that they want to sell to us. They're GI products that they want to sell to us. So I think it's a win-win, and that's the beauty of this agreement.
So the European Union is in Beijing, the head of the European Union. Then the head of the United States is going to land in the UK in less than 15 hours, 10 hours, if I may say. So are they also going to come across to the table to make it win-win? Is this going to be a queue?
Well, I do think that the European Union Trade Commissioner, Maros Sefcovic, and I have hit it off on a very, very strong wicket. He's a great guy.
Yes.
Wonderful friend of mine. And we both have a commitment that we're going to cross the hump and make this deal happen. So I think maybe we should be able to do it soon. They are in holiday season till August. After that, we're going to get cracking on that.
So you're more positive in the Europe scheme of things with UK and the European Union compared to what...
I'm positive about all countries, including the United States. The United States Trade Minister, Commerce Secretary Howard Lutnick and I have become really good friends. He's a great guy. The USTR, the Trade Representative, Ambassador Jameson Greer and I have been friends since Trump won. When he was in the administration, I've known him well since then. So I am very comfortable working with the United States, and I'm enjoying working across the world with trade agreements happening as far away as New Zealand on the one side, Chile and Peru on the other side, and Europe somewhere in between.
Lovely. So final question. As we speak, we are into the 25th of July in Bharat. And technically, Prime Minister Narendra Modi becomes the second longest continuous term serving Prime Minister after Pandit Jawaharlal Nehru. So he eclipses Prime Minister Indira Gandhi. Your thoughts on his leadership and how much of a difference his leadership has made in Bharat also straightening equations with politically adverse leaders, nations. Maldives, he's in Maldives right now. The Labour was against a trade deal in the first place in Britain. Now they've signed the trade deal. You see how Canada has turned around with Mark Carney. So Maldives, yes. Maldives, Sri Lanka, yeah. So
Prime Minister Modi is truly a statesman, a visionary, a very sensitive human being, caring, concerned about smaller countries, the global south, the less developed countries. And more importantly than anything else, he's a good human being. He has completed his term so far as the second longest serving, but this is only the beginning. He has a lot of ambition, a lot of dreams for our country. He wants to make this country the most consequential and most important country. And the people of India deserve a better life, a better future, which Prime Minister Modi is committed to giving. So he is going to become the longest serving Prime Minister in this country. He has miles to go. He has huge aspirations for the country. He's committed to working the way he usually does to strengthen our relations across the world. He's received 27 international honors.
Yes.
I don't know of a parallel anywhere in the world of that kind of respect and adulation. He's been the most popular leader for the last 11 years across the world. Undisputedly, a person who is shaping the destiny of 140 crore Indians And that destiny under his leadership is going to be great.
Well, if he's going to be continuing to work hard, that means you've got your task cut out. So, Honorable Minister, it's Britain now and hoping that it's Europe next. Congratulations. Thank you so much. Thank you. Thank you.
Hello and welcome to our very special broadcast here on CNBC-TV18 on a historic day. I'm Shireen Bhan. It's taken 14 rounds of negotiations over 3 years and 4 British Prime Ministers, but the much-awaited free trade agreement between India and the UK finally inked. Prime Minister Modi and Prime Minister Keir Starmer today inking the FTA at Chequers House in the UK. Well, essentially, this does bring down tariffs on both sides, and it also opens up the opportunity for additional exports. And of course, both sides hoping that this will increase bilateral trade by £35 billion annually. Joining us now to talk about what this means for both sides is Sunil Bharti Mittal. He was leading the business delegation. He was there when the FTA was inked by the two Prime Ministers. Mr. Mittal, many thanks for joining us here on CNBC TV18. As I pointed out, it's taken 14 rounds of negotiations over 3 years and 4 British Prime Ministers to finally get the India-UK FTA done. You were there when both Prime Ministers were signing this. Take me through that moment to start with.
Well, as you rightly said, this is truly a historic moment, and a lot of work has gone behind the scenes over the years. And you rightly said, it's gone from multiple prime ministers on the UK side, and wherever we had a solid continuity of leadership for 11 years, actually. And the last 3 years were, in particular, very hectic. Trade deals, Shreen, are never easy. They're very difficult. How do you match aspirations of two countries, its people, its requirements? Businesses have different pulls and pressures. What you want is what they resist, and vice versa. So to start with, let me say, I must applaud the leadership of both the prime ministers to finally come together to get to a conclusion of this historic deal. This, to my mind, could actually set up a real roadmap for many other such deals with the Western world. And today, you could see in that room, in the very intimate setting at Chequers, a tremendous amount of energy between both the sides, bonhomie, friendship, exchanging commitments between not only the political leaders, but business community to take the trade, investment, and trade both in goods and services to the next level.
Mr. Mittal, as you pointed out, trade deals are complex and, of course, it takes a lot of negotiations on both sides. Both sides believe that this is a win-win. But let's talk about some of the specifics. Now, average tariffs to be reduced from 15% to 3%. Tariffs have, in fact, been removed on 99% of goods and services. But in the immediate term, there are concerns, for instance, on the Indian side. What happens to the Indian automobile sector? What happens to the Indian alcohol beverage sector? I mean, those are two sectors that have expressed their concerns. What we have seen as part of this FTA is a kind of phased reduction of tariffs as well as a quota system. So if you can explain to us where you believe the most opportunities lie, but also whether the vulnerabilities have been addressed.
I think you rightly pick up that there will always be concerns whenever such trade deals are signed. Let me start by saying that the British tariff for Indian goods have almost always been very, very low, and India has continuously enjoyed the low tariff entry into the UK for its products and services. Now, while granting lower tariffs on multiple areas like Scotch and automobiles and some other areas like soda and soft drinks, etc., I think India very nicely calibrated the impact of that on the local industry. I think each one of these industries that you have named have tremendous amount of local manufacturing with very high degree of local content. So I think the Indian industry need not worry in these areas. If UK products were to come to India, even with reduced duties, that the cost of manufacturing in UK is extremely high compared to India. Transportation, logistics, insurance, a lot of things come added on top of that. So other than a very niche upper crust market, which will want very expensive British products, I don't think so in terms of mass consumption, there should be any cause of concern. And on the other side, the opening up of services agreement, which allows Indian chefs, musicians, teachers, nurses to come more freely into the UK, to my mind, actually delivers a significantly higher benefit for India. As in the end, you rightly said, it's got to be a win-win. You just can't take all and not give anything. I think it's been a great balance. We will, during this interview, talk about other significant issues of benefit like cooperation in defense and space and many other things. But on pure supply of goods, which is a trade block, I think in that the whole trade deal is very nicely balanced. And if I may hasten to add, perhaps more in favor of India.
Perhaps more in favor of India. That's an interesting comment there coming in from you, Sunil Mittal. You address the issue of defense, you address the issue of aerospace, etc. And these are, of course, areas of mutual interest as well as perhaps more deeper mutual cooperation. Now, in light of this FTA, but also in light of the geopolitical dynamics and the ever-changing geopolitical dynamics, what does this FTA do specifically to deepen collaboration and cooperation in both these areas?
Yeah, so first of all, let's start. These are two economies of similar size. India at $3.5 trillion and UK about the same size. UK has the advantages of a lot of areas of technology, biosciences, defense, very deep technologies on missile technology, space technologies. And yet they do not have adequate manufacturing facilities, talent pool that is required to back them up to be world champions. On the other hand, India has a very large market, unlike UK, which is a much smaller population. It has the talent, it has the low-cost manufacturing facilities. Now, imagine if you combine these two complementary benefits that each country can offer to each other, you become a force multiplier. India is poised to be a $25-30 trillion economy. UK recognizes that, and therefore we're very happy to embrace and talk about deep technology partnership, which usually the Western world has not opened up to emerging economies. So in that sense, this will be a very special advantage for India to get access to technologies for its own needs, own markets, but more importantly, exporting across the world. The total business between UK and India is at about $56 billion. This agreement has an ambition and a vision to take this to $120 billion in 5 years' time frame. And that's a real strong vision that has been set up by the two prime ministers. And I know that the Indian government, Indian Prime Minister personally himself, and of course our Trade Minister, Mr. Goyal, worked on each item of this deal personally to ensure that there was a very important advantage that India gets while opening its market, which UK will gain by sending, of course, as you rightly said, more products into India. But I personally feel the bigger advantage will come from UK companies investing in India and creating bases in India, which will be high talent pool that they can access, low manufacturing cost, and make the world their market, which I can tell you, having now worked in UK for several years, is hard for UK companies to come to those levels of competitiveness that India can offer them.
So that's exactly, you preempted my question, because, the expectation or the assumption is that with the tariff reduction, will there be incentives for UK companies to consider local manufacturing? You're saying that, yes, you see that happening. Are there any specific sectors where you believe we will see more of that happening? And do you also foresee more joint ventures between UK companies and Indian companies in light of this?
Yeah, so, we need to put it in perspective. $36 billion of investments have already been made by British companies in India. From Indian side, about $20 billion have been invested in UK in setting up companies. So UK, in that sense, is already ahead. And now with many of their, industry players seeing lower duty structures in India, where you can import stuff at a much lower duties than they were previously, incentivizes them to have bigger presence in India, both for their own goods that they can produce here and sell in India, whatever limited market they could get at the upper crest, but equally start to manufacture some of those parts, complete products in India to have bigger slice of the Indian market. So if I was a British businessman, and I know that the duties are low now, the country is open for business, we can move people between the two countries in a seamless manner, I think it makes the decision-making in the boardrooms much, much stronger in going into India to manufacture and set up larger bases in India.
You were speaking hypothetically from a British businessman's point of view. Let me ask you to speak realistically from an Indian businessman's point of view, Mr. Mittal. As you said, you've had business interests for several years now in the UK with that sizable investment that you've done in BT. Specifically from your point of view, between OneWeb and BT, etc., do you see yourself expanding your own bet on the UK? And do you believe that other business leaders in India, other business houses from India will consider making similar bets on the UK?
I would think so. And you will see most of that coming through acquisition of some UK companies. As I said, technology is very advanced. Markets are small. And we are already seeing companies like TVS, who have picked up the Norton motorbikes here in the UK, where they are manufacturing very high-end motorbikes. They were on display today. Our companies which are in the beauty areas like Kama, Nykaa, forest essentials. They're all making their inroads into the UK markets, trying to acquire companies here to get better technology, better access into the Western markets. So I see a much better roadmap for Indian companies to come and invest here. You know that the big unlocking of the monies that were put through the contribution side have been a big problem for Indian companies, where giving the contribution into the UK pool for equivalent of provident fund and medical, etc., were a waste for Indian individuals when they went back home. Now, UK has in this agreement given a 3-year waiver on the double contribution commitment, which means that the Indian employees which are going to be working here will not be required to pay those contributions, saving nearly 4,000 crores of rupees to the Indian companies. So Indians can now come invest here, bring talent, and fire up the local companies which are generally otherwise not having such large markets or talent pool. So I would say you will see a lot more Indian companies coming and investing here.
What about your own appetite, sir, to expand your presence in the UK?
Well, we are, as you know, taking a big position both in OneWeb and BT. We are, looking at more opportunities here in the UK. We also have hospitality sector where we came some years back. We have a number of marquee hospitality hotel properties, real estate properties here. So we are certainly looking at opportunities, and we remain very agile and open for new opportunities.
Mr. Mittal, you said that you hope that this deal kind of becomes the template for other deals that India is hoping to ink. We were hoping to have a deal with the US. Of course, talks are on. We are given to understand that the 6th round of negotiations will now perhaps happen in August. So that 1st of August deadline, we may or may not have a deal. What's your take on where we find ourselves in dealing with the US and the possibility of getting that deal done?
Well, I think that, as you know, has been in the works also in the last several weeks. Many times have been said. I think probably we will need a little bit more time there. There are a lot of issues. US is a huge market for imports as well as exports. I would say that is an area for the government to negotiate. Definitely, there be an interim deal, then a final. Let's see how that works out. But this UK deal on the back of EFTA deal of 4 countries in Europe, UAE, Saudi, Australia, I think India is gaining ground. And if EU was to happen in the coming months, I think one of the big US trade deal India would have covered the whole globe. And I remain hopeful that despite some of the inseamers and curveballs that are coming from the US, Indian negotiators will be able to come to a balanced outcome there as well.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Market at a one-month low ends in the red for the fourth consecutive week, marks its longest losing streak of the year so far. All major indices except banks and pharma end in the red for the week.
We were amongst the first to get into negotiations, and our discussions, our engagement is truly very, very significant.
Commerce Minister Piyush Goyal bats for preferential tariffs from the United States ahead of fresh round of talks next month. Says India was amongst the first to enter into negotiations with Washington. That's a CNBC exclusive. Days after ending the 5-year freeze on Chinese tourist visas, efforts are underway to speed up economics re-engagement with China. Government sources say India cannot avoid working with China since it hosts 60% of global electronics manufacturing. Calls for considering greater engagement and flexibility with China. That's a CNBC-TV18 exclusive. Rift within the Sona Comstar first family. Rani Kapoor, mother of late Sanjay Kapoor, writes a letter to the board seeking a deferment of the AGM that was scheduled today. Alleges she was made to sign documents under coercion. Hints that she is opposed to Sanjay's wife, Priya, being appointed to the Sona Comstar board. Claims that her son passed away in the United Kingdom under highly suspicious and unexplained circumstances.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
A stunning exchange between US President Trump and Fed Chair Jerome Powell as they spar on camera over the renovation costs of the central bank's headquarters. But Trump backs off from his threats of firing Powell even as he continues to pressure him to cut rates. At least 7 children killed in Rajasthan's Jhalawar after the roof of a government-run primary school collapses. 14 children injured in the dilapidated building. Prime Minister Modi expresses condolences. The monsoon session of Parliament remains paralysed for the 5th straight day as both houses get adjourned amid opposition protests. Lok Sabha Speaker Om Birla meets leaders of all parties to discuss the functioning of the House. Government agrees to opposition's demand for a debate on Operation Sindoor on Monday. More people die of starvation in Gaza as Israel continues to block food assistance. Canada's Prime Minister says the denial of humanitarian aid is a violation of international law. France recognizes the state of Palestine despite opposition from the US. And Prime Minister Modi arrives in Maldives as both nations attempt to reset bilateral relationship after a diplomatic row. He is the first foreign head of state to visit the Maldives during President Mohamed Muizzu's tenure. Right, let's start with today's market action. Market ends at a one-month low with Nifty ending below the 24,900 mark. IT stocks remained a major drag for the market, largely led by weak earnings for the week. Market slipped for the 4th straight week, making this the longest streak this year. Sensex and Nifty slipped 0.5% each, while Nifty Bank gained 0.5%. Prashant Nair joins us with all the market action. Prashant.
Well, it sort of ended the way it started, right? I mean, there was little hope, sporadically maybe intraday, but in a sustained way, the market didn't really at any point during the week give an indication that it was ready to recover and sort of move higher. So it was a slow drift down. And actually, if anything, the broader market space started to look poorer and poorer over Thursday and Friday when market breadth looked pretty bad. So the numbers for the week will come up on your screen. Not very much in the Nifty, actually. Just a 0.5% cut Friday to Friday. The Nifty Bank also around that much. The mid-cap index a little bit more, about 2%. And the small-cap index, as I said, the last 2 days made a difference there. 3.5% for the week, down on the small-cap index. I just looked at sectorally, right? Where did things lie? Real estate cracked. I mean, the index was down 5% through the course of this week. Of course, IT, and it was large cap first, then of course it became mid cap IT, and Friday was particularly bad as well. 4% cut on the Nifty IT index. Capital markets is a space of about 4% cut, and the oil and gas index, Reliance, of course, has been under a bit of pressure. 3.5% is a heavyweight as far as that space goes. Now, large caps, and where do we see strength? It was, of course, Eternal, Zomato, which was up 21% this week. There was Cipla. I mean, actually, look at this, right? I mean, Eternal, the top gainer in the large cap pack for the week with a 21% gain. And then there is Cipla at 3.5%. So just tells you, ICICI Bank was up 3.5% this week as well, coming off, of course, the numbers which were reported over last weekend. Weakness in the large caps, Nestle, Trent and Reliance, 866 respectively. Those are the cuts that we saw on those three names.
Thank you, Prashant, for that. Union Commerce Minister Piyush Goyal has hailed the India-UK Free Trade Agreement as a win-win deal for both nations. The India-UK FTA will boost bilateral trade by $35 billion annually. The deal reduces the average tariff on UK products from 15% earlier to 3%. Meanwhile, India's labour-intensive sectors will benefit from zero duties in the UK. Indian fruits, vegetables and cereals will also get cheaper in the UK. Now, speaking with CNBC, Goyal also said that UK offers several high-value products which India can benefit from. The Commerce Minister added that both India and the UK are also eyeing to double bilateral trade by 2030.
Plethora of items which are uncompetitive to manufacture in UK today, which India can be a trusted supplier in your supply chains. Likewise, they're very high value medical devices, many products that the UK is known for, high value special medicines, where India can benefit from the UK story. UK also is a largely service-driven economy. Another area where we hope to expand our relations so that all in all, by 2030, we can double our trade.
It's got to be a win-win. You just can't take all and not give anything. I think it's been a great balance. On pure supply of goods, which is a trade block, I think in that the whole trade deal is very nicely balanced. And if I may hasten to add, perhaps more in favor of India.
And speaking of trade deals, Commerce Minister Piyush Goyal has also said that the Indian government is expecting a robust and a good deal with the US. Speaking with CNBC, Goyal added that India will eye preferential tariffs over its peers because it was one of the first countries to come to the negotiating table with the Trump administration.
I think it's a wonderful relationship that the United States and India share, a very special relationship. And I'm very confident we'll do a robust and good deal where both countries benefit and where businesses on both sides are happy. India will get a preferential tariff compared to our peers and our competitors because we were amongst the first to get into negotiations, and our discussions, our engagement is truly very, very significant.
I think India is gaining ground, and if EU was to happen in the coming months, I think one of the big US trade deal would have covered the globe. And I remain hopeful that despite some of the in-seamers and curveballs that are coming from the US, Indian negotiators will be able to come to a balanced outcome there as well.
Right, moving on, India's manufacturing sector activity hit a 17-year high in July with the HSBC Flash Manufacturing PMI rising to 59.2. The surge indicates that rising demand drove a strong improvement in factory operations. The composite PMI output index, which tracks both manufacturing and services, reached 60.7 in July. This is the index's sharpest growth in over a year. Remember, a reading above 50 indicates expansion, while one below that suggests contraction. All right, moving on to a CNBC-TV18 exclusive. The Indian government may have to consider greater engagement and flexibility with China. We learned from government sources that India cannot avoid working with China since it hosts 60% of global electronics manufacturing. Sources have also indicated that the industry is hopeful of some breakthrough in imports of rare earth magnets. The foreign minister took up the issue during his meeting with Chinese Foreign Minister Wang Yi. This comes days after both nations ended the 5-year tourist visa freeze on one another. Ashmit Kumar joins us now with more. Ashmit, India and China, are the ties slowly thawing between the two countries?
Well, electronics industry is something that, in fact, has long been crying that, look, it's not just the auto space that's getting affected. Electronics players are also getting impacted due to these Chinese restrictions. Now, we raised these questions within the government, and what government officials are telling us is that given the size and scale of the electronics industry in China, there has to be some engagement, there has to be flexibility in terms of engaging with Chinese entities, with Chinese players. In fact, the government officials tell us is that overall, more than 60% globally of electronics manufacturing sits out of China, sits out of Beijing, and therefore engagement with Beijing cannot be avoided. Now, these statements coming out from government officials come on the back of three very interesting triggers. Well, number one, let's bear in mind that only as early as last night, we saw Dixon announcing that they have managed to get the government's blessings and the government's approval for a JV with a Chinese entity called Longcheer. So we're already seeing this engagement translate into action. Dixon already getting an approval from the government, from METI. Number two, bear in mind that only recently we've seen travel by the Indian foreign minister to China, and it is on the back of that we began to see relaxations like we did in the form of visas being allowed to Chinese tourists. So there is already some amount of thawing of ties, perhaps some amount of engagement that we're already beginning to see. And let's also not forget that at this time, with the industry reeling under the impact of restrictions from China, there is already solutions being worked out. METI is already in conversations with the Ministry of Electronics, with the Ministry of External Affairs. They're discussing how, in aspects such as rare earth, perhaps entire components can be imported to beat the impact of rare earth restrictions.
Right, thank you, Ashmit, for that. Shifting focus to earnings now, shares of pharma major Cipla surged today in response to its first quarter earnings. The pharma giant reported an overall beat. However, revenue slightly missing the mark there due to muted India business. Net profit jumped over 10%, while revenue rose 4% on an annual basis. The company expects the India business to bounce back with a full year growth of 8 to 9%. Right, moving on, Bajaj Finserv's first quarter net profit surged 31% year on year. Revenue from operations in the quarter also rose 12.5% compared to last year. Now, gross written premium of its life insurance business rose 9% year on year. However, that figure fell 41% sequentially. Meanwhile, gross written premium from its general insurance business surged 20% compared to last quarter. ITC Chairman Sanjeev Puri has said that the company will invest 20,000 crore rupees over the medium term to expand its manufacturing footprint across sectors. Speaking at the company's AGM, Puri said that the company has already set up 8 new manufacturing facilities in recent years as part of its growth strategy. He added that the company will focus on a Bharat First to strengthen its domestic presence. The Enforcement Directorate has conducted raids on Anil Ambani-owned Reliance Group across multiple locations for the second day. The ED began its operations yesterday and searched 40 locations across Mumbai and Delhi as part of a money laundering probe. Sources have said that the ED has alleged that the company diverted public funds by cheating banks, claiming that they received information from various agencies, including SEBI. Shares of Indian Energy Exchange rebounded after a 28% fall yesterday, closing with gains of 12%. This after the power trading platform's first quarter net profit rose 25% year on year. Remember, the stock clocked its worst single-day fall yesterday after CERC approved the implementation of market coupling. The mechanism allows energy markets to create a single uniform price for electricity across different trading platforms. Speaking with CNBC-TV18, joint MD Rohit Bajaj said that market coupling of real-time markets will be implemented at a later stage.
So, bit early days to comment on that, but let me quickly try to rephrase what is there in the order. So, CRC issued order for implementing of market coupling for day-ahead market on 23rd July, day before yesterday. And it talks about initiating the process of market coupling for day-ahead market. There are a few more elements in this order where they said that due to shorter time frame available for bid submission in real-time market, and also because of other operational complexities, coupling of real-time market will be considered at a later stage. So yes, there is going to be some impact on our business for sure. But if we see the whole thing, in the recent time, we have seen day-ahead market is not everything for us. There was a time when day-ahead market contribution in our total volume was 80-85%. But today, this number has come down to less than 35%.
All right, the big corporate story we are tracking. There's rift within the Sona Comstar First family. Rani Kapoor, mother of late Sanjay Kapoor, wrote a letter to the board urging them to defer company's annual general meeting hours before it was scheduled to take place. The Sona Comstar AGM was held this afternoon in a virtual setting. Rani Kapoor alleged that she was made to sign documents under coercion which she claimed are being misused to, and I quote her here, usurp her family legacy, end quote. In the letter, she hinted at being opposed to Sanjay's wife Priya being appointed to the Sona Comstar board. She also claimed that her son passed away in the United Kingdom under highly suspicious and unexplained circumstances. However, sources tell CNBC-TV18 that according to company documents, Priya Sachdev Kapoor has to act as the director of Sona Comstar in the absence of Sanjay Kapoor. Sources add that Priya is also the director of Oris Investments, the promoter entity which owns around 28% stake in Sona Comstar. We spoke with Rani Kapoor's counsel. This is what he told us.
So Mrs. Rani Kapoor was the sole beneficiary as far as the will of Mr. Surinder Kapoor, late Shri Surinder Kapoor, is concerned, which was a registered will. You're aware that she's written a letter to the shareholders and the board of directors. She has put down on paper quite explicitly how things have transpired, how there are, serious apprehensions as far as she's concerned in terms of the circumstances leading to the death, what has unfolded immediately post that. As written in the letter as well, lots of suspicious circumstances have unfolded and are coming to light now. How various appointments were made, what the role of certain individuals that you have named in just right now, how did they come into being where they are, what were the documents which were signed, what was the manner in which they were brought about. All of these are matters which have to be looked into very carefully.
Right, at least 7 children were killed after a roof of a government school building collapsed in Rajasthan's Jhalawar. 14 children were injured in the incident. The school building was reportedly in a dilapidated condition and its structural quality was affected by heavy rainfall. News 18 India's Tarun Kumar Sharma is here with the latest.
राजस्थान के झालावाड़ जिले के लिए आज का दिन काला साबित हुआ है। जिले के मनोहर थाना उपखंड क्षेत्र के पिपलोदी गांव में आज एक खस्ताहाल स्कूल सरकारी स्कूल भवन की बिल्डिंग धर-धरा कर गिर गई। इस हादसे में मलबे में दबने से 7 बच्चों की मौत हुई है, जबकि 22 बच्चे घायल हैं। इन घायल बच्चों में से 11 बच्चों का झालावाड़ के मेडिकल कॉलेज अस्पताल में उपचार चल रहा है, तो बाकी बच्चों का मनोहर थाना के सरकारी अस्पताल में इलाज जारी है। सारे मामले में ग्रामीणों का कहना है कि सरकारी बिल्डिंग की हालत लंबे समय से खस्ता हाल थी। इसके लिए वे सरकार से बजट की भी मांग कर रहे थे। वहीं स्थानीय लोगों ने और जनप्रतिनिधियों ने भी सरकार से इसकी मरम्मत की मांग की थी। इसके बाद कई बार मरम्मत की मांग के बाद कुछ ही बजट इस स्कूल की मरम्मत के लिए मिला।
The US Federal Aviation Administration has said that the Air India plane crash was not due to mechanical failure in the fuel control system of the Boeing 787 aircraft. Speaking to reporters, FAA's new administrator, Brian Bedford, has confirmed that there was no inadvertent manipulation of fuel control switches. He added that the switch mechanisms were functioning normally and showed no signs of a failure. Prime Minister Modi landed in the Maldives for a 2-day official visit. He was greeted by President Muizzu with 2 other leaders who shared a warm hug on arrival. This is PM Modi's 3rd visit to the Maldives and the first by any foreign leader since Muizzu took over. Prime Minister Modi will be the guest of honor at the Maldives' 60th Independence Day celebrations on July 26th. Right, time for a short break. Coming up next, a stunning exchange between the US President and Fed Chair Jerome Powell as they spar on camera over the renovation costs of the central bank's headquarters. More on that when we return. Welcome back. You're watching Business 360. US President Trump and Fed Chair Jerome Powell sparred on camera over the renovation costs of the central bank's headquarters. The exchange happened during the president's visit to the US Federal Reserve. However, Trump backed off from his threats of firing Powell, even as he continues to pressure him to cut rates.
So we're taking a look, and it looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Yeah, it just came out. I don't know who does that.
You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building is what that is. That's a third building.
Well, no,
including the
but
Martin building.
it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
It's part of the overall work.
But it's
So,
not new.
So we're going to take a look. We're going to see what's happening, and it's got a long way. Do you expect any more additional cost overruns?
Don't expect them. We're ready for them, but we have a little bit of a reserve that we may use, but no, we don't. We expect to be finished in 2027.
That keep going for another 8 months. Why not just fire them?
Because to do that is a big move, and I just don't think it's necessary. And I believe that he's going to do the right thing. I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing.
Jerome Powell is doing a commendable job in maintaining independence, quote unquote. That's the word coming in from the RBI governor, Sanjay Malhotra, when asked if he has any advice for his US counterpart. This comes amidst growing pressure from President Donald Trump to cut rates. Take a look.
I don't think he needs advice. I think he's doing a very good job. So,
okay, fantastic.
Maintaining the independence of the central bank is very important. I think he has done a commendable job. There was, some 40, 50 speakers, and Jay Powell was also there, and he spoke about, what he was doing about central bank independence. And out of everyone, he was the only one who got a roaring applause. No one else. So I think, he's doing a good job.
Palestinians continue to die of starvation in Gaza. The chief of the UN agency serving Palestinians said his staff are fainting from hunger. As per reports, at least 45 people have died of hunger in the last 4 days. Ukraine and Russia traded drone attacks after brief direct peace talks between the two sides in Istanbul failed to make any progress. Ukraine said that Russia launched 103 drones and 4 missiles during its overnight attack. Meanwhile, Russian authorities said 2 people were killed in an overnight Ukrainian drone strike on Sochi. Thailand and Cambodia have continued to exchange heavy fire for the second day. Thailand's acting Prime Minister has warned that fighting with Cambodia could develop into war. At least 15 people have been killed in Thailand, out of which 14 of them were civilians. According to the country's health ministry, 1 person has been reportedly killed in Cambodia. More than 1.5 lakh people have been displaced on both sides. Iran has agreed to restart technical level discussions on its nuclear program with the International Atomic Energy Agency. Iran and the United Nations nuclear watchdog will discuss how to restart inspections again. Tehran has said that the delegation will visit Iran but not to go to the nuclear sites. Pro wrestling legend Hulk Hogan, arguably the greatest WWE superstar of all time, has died at the age of 71. A vocal supporter of Donald Trump, he suffered a cardiac arrest at his home in Florida. Hogan, whose real name was Terry Bollea, was key in making professional wrestling a mainstream phenomenon in the 80s and 90s. A controversial personality and a pop icon, Hogan's career was dogged with allegations of drug abuse, racial slurs and sex tape scandal. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
Hello and welcome to Startup Street. I'm Shruti Mishra. These are the top headlines from the startup space. Semiconductor startup Netra Semi has raised 107 crore rupees in Series A round from Zoho Corporations and Unicorn India Ventures. Funds raised will be used for accelerating research and development initiatives, expand manufacturing capabilities. Value First retail chain for small towns of India, Super K, has bagged 100 crore rupees in Series B round of funding led by Bini Bansal's 3 State Ventures and Mithun Sacheti. The round also saw star Indian batter and current men's test captain Shubman Gill joining in, along with existing investors Bloom Ventures and Exceed Ventures. Enlight, a design-led product-first company, secured 46 crore rupees in a Series A round led by Vana Capital with participation from Claypon Capital. With this round, the company will expand into international markets, including the Middle East and Southeast Asia. It also plans to accelerate its edge AI and elementary capabilities. PhysicsWallah became the first EdTech firm to get the go-ahead from SEBI to launch an initial public offering. According to an update from the markets regulator, the company was among the 7 companies cleared for a public listing. SpaceX's Starlink suffered one of its biggest international outages when an internal software failure knocked tens of thousands of users offline, a rare disruption for Elon Musk's powerful satellite internet system. Michael Nicholas, Starlink Vice President of Starlink Engineering, wrote on X that the outage was due to failure of key internal software services that operate the core network. Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Chennai-based deep tech startup FabHeads, founded by ex-ISRO engineers, has raised $10 million in a Series A round led by Axel. The company is one of just 7 globally and the only one from India to automate the complex process of continuous fiber composite manufacturing with transformative applications across aerospace, mobility, defense, and clean energy. The fresh capital will be used to ramp up manufacturing facility, expand the leadership team, and strengthen client-facing engineering and R&D divisions. Joining me now to talk about what's next at FabHeads is its founder and CEO, Dinesh Kanagaraj. Dinesh, welcome to Startup Street. Now, FabHeads is, like I mentioned, one of only 7 companies globally and the only one from India to automate continuous fiber composite manufacturing. What is the core innovation that sets your, tech apart? What kind of efficiency gains or performance improvements are you delivering?
Pleasure to be part of the show, Shruti. Today, if you see more than 85% of fiber composite parts, be it drones, performance bicycle F1 cars, jet planes, or even extremely large wind turbine blades, these are all completely made by manual manufacturing process. So at FabHeads, we have developed a completely new process called adaptive toe placement, ATP. And this is something that we have procured patents, not just in India, but across Europe, USA, Japan, and several countries. So this is actually the key process innovation that allows us to handle the automation. So this essentially significantly reduces the manpower involved by at least 80% and also increases the speed of production in a very big way.
Dinesh, carbon fiber is hard to work with. So tell us, how are your systems addressing challenges around precision, material wastage, and high rejection rates, issues that even global giants struggle with?
It most definitely is, Shruti. So you are very right. Because, as I said, currently most of the manufacturing is done very manually, there is a very high unreliability in the overall sector itself. And depending on the complexity of the parts, see some simpler parts in automotive to extremely complex parts in aerospace, the rejections can be just as low as 1% to even sometimes as high as 15%. And this is incredibly high wastage. And that is where our ATP process comes in. And because it is a completely automated manufacturing process, it increases precision and speed in a very drastic manner. We have been able to demonstrate that our processes have been able to reduce rejections by at least 20%, and even in very complex stage stages, like even rejections by of the order of 50% actually, and also reducing the material wastage and cost in a very big way.
Okay, let's get to the fundraise now. You recently raised $10 million in Series A led by Axel with plans to set up a larger facility in Bengaluru. What kind of capacity are you targeting and which sectors are you prioritizing as you scale?
Today, the largest mission that we have in our facility is about 1.5 meters, and that kind of limits the size of parts that we could cater to our clients. So moving forward, we are looking at building missions that can cater up to 5-meter parts within the next year and up to 15-meter size parts within the next 2 to 3 years, sort of. And that is kind of caters to a large number of aerospace and defense grade parts, essentially.
Okay.
And moving forward, we are also looking at catering into shipping, biomedical, and other sectors as well.
All right. And Dinesh, the timing couldn't be better. India's composites market, pegged at $1.8 billion, is set to touch $2.8 billion by 2030. Also, with the government now backing domestic carbon fiber production and targeting $10 billion in technical textiles exports under the PLI scheme and National Technical Textiles Mission, how is Fabheads positioning itself, especially in aerospace and mobility?
Yeah, exactly. I mean, there has been extensive policy support in India towards increasing manufacturing work and also in and around Make in India related various initiatives. And all this has been extremely helpful for us as an ex-startup, and we are more than happy to ride the wave as it helps us push much faster. Especially in aerospace also, actually, we are seeing a lot of global players increasing their foothold in India and increase the amount of components that they procure from India. Earlier, these used to be primarily procured from China and several other countries, but the percentage that is being imported from India has been drastically increasing. And even the Boeing has set up their final assembly line for helicopters now. And like this, we are expecting more such developments in India, and which we are willing to take more than enough push out of it. Yeah.
All right. With the fresh funds raised, Dinesh, you're also looking to expand your leadership and R&D teams. Tell us more about the roadmap for the next 12 to 18 months. What are the hiring plans, global ambitions, and revenue targets that you've set for yourself?
Yeah. So we are going to be mostly focused on quickly setting up our large-scale facility in Bengaluru right now, and also showcasing its capabilities to the larger aerospace community across the world. And we'll be participating in multiple events showcasing the capabilities. And there are a lot of other capabilities that we have not yet revealed to the world, which we are very excited to showcase in the coming months. And yes, we are looking at hiring a lot of engineers, working on these very high tech that we are working on, as well as the sales team to start growing very international very quickly. And so in terms of numbers, we are looking to grow at least 50x in terms of our revenue in the next 2 years.
50x growth. Okay. Dinesh, beyond aerospace, which other sectors are seeing the strongest demand for your technology? Where do you see the biggest growth opportunities?
So carbon fiber is becoming extremely adaptive. People have been starting to use this in luxury yachts now, and slowly it is becoming more use case, even in cargo ships. So shipping is definitely seeing a very big rise in adopting these materials. Locomotives, another use case, the lighter the locomotives, the more fuel efficient and the more faster it is going to be. And also biomedical, titanium is slowly being replaced with carbon fiber as a preferred material for implants. And like this, so carbon fiber is greatly changing the way the engineering world works. And the biggest problem for it has been the cost and how things are being produced.
Sure.
And what we are doing right now in terms of automation is going to make that adoption that much more faster.
All right. Lastly, Dinesh, do you envision Fabheads as a long-term made in India deep tech success story, one that could eventually go public? Is that a long-term vision?
Absolutely. So we definitely wish to go all the way. We believe what we are building is going to have an insanely positive effect across the world in making a more sustainable Earth, and we wish to play a very big role for it across the decades and not just a few years.
All right, Dinesh, on that note, it's time for me to wrap up our conversation. Many thanks for joining us on Startup Street today, and wish you the very best for all your growth plans. Moving on, now let's take a look at the deal activity this week. As per Venture Intelligence, 21 startups secured $108 million this week. Some of the notable deals were Composio, which secured $25 million from Elevation Capital, Lightspeed Ventures, and others. Semiconductor firm Netra Semi secured over $12 million from Unicorn India Ventures, and Zoho retail chain Super K raised around $12 million from Bloom Ventures. Three State Ventures, Exceed Ventures, and others. AI cloud platform Cluis AI also raised around $10 million from Bloom Ventures, Climber Capital, RTP Global, Unicorn India Ventures, and others. EduFund, an education savings platform, has raised $6 million from Mass Mutual Ventures and Vulcan Capital. With this, the total number of deals for this year till date climbed to 508 and is valued over $4.6 billion. And on that note, we have to take a short break. But up next, my colleague Ritu Singh will join in with a special chat on PayPal's new global cross-border platform launch called PayPal World with its president and CEO, Alex Chris. Stay tuned for that.
Well, in an important development for the global payments landscape, PayPal has partnered with several major digital wallet companies to launch PayPal World, which is a platform designed to make cross-border commerce more seamless and accessible. Now, this initiative allows users to pay international merchants or send money across borders using their local wallets and payment systems they already use at home. Launched in partnership with major payment systems, including India's UPI through the NPCI International, China's TenPay Global, which is Tencent's payment arm, Latin America's Mercado Pago, and of course PayPal and Venmo, the platform aims to connect nearly 2 billion users over the world. To illustrate how it will work, if an Indian shopper, for instance, is browsing on a US-based online store and he clicks on the PayPal button at checkout, they'll see the UPI option that they're familiar with, and that'll enable them to complete the purchase in their local currency using their preferred domestic payment method. But to understand the strategy behind PayPal World and what it could mean for the future of global payments as we know it today, we're joined by Alex Chris, the president and CEO of PayPal. Alex, thank you very much for your time here on CNBC-TV18. It's a pleasure to have you here. To begin with, very, very simply put for our viewers, for the consumers out there who are shopping in India or shopping abroad or vice versa, what does PayPal World really bring to the table, and how is it any easier than, say, using our credit cards to make an online transaction internationally?
Sure. Well, again, thank you for having me. It's great to be with you today. So when we set out to create PayPal World, the problem we were solving was we know that there is tremendous advancement in digital wallets today. Digital wallets are how people want to pay. Digital wallets hold multiple credit cards. They may hold digital currencies. They may hold buy now, pay later options. There's lots of different options around the world. But the challenge is these wallets don't interoperate. And so if you're traveling, if you happen to be wanting to exchange money on a peer-to-peer basis with another consumer that has a different wallet, you run into a challenge. And so PayPal World creates interoperability across the leading wallets across the world. So if you're a consumer in India, you happen to be a UPI user, you can now shop anywhere that PayPal is accepted. So you can go to Europe, you can go to an e-commerce store in the United States or anywhere else. You'll be able to find the PayPal button, click on it, and be able to actually check out with your UPI wallet. And this is interoperable across different geographies. So users that are Venmo users or Mercado Libre users that are traveling into India will be able to scan a UPI merchant QR code and be able to check out with their home wallet as well. So we're trying to give people the opportunity to use their native wallet anywhere that they want to shop, anywhere in the world.
And Alex, how soon is this going to be live?
Yeah, so we just announced a partnership with our top first 5 founding wallets. So it's PayPal, it's Venmo, it's UPI, WeChat, and Mercado Libre. Our plan is to launch in the fall, and we already have tremendous influx of other wallets that have chosen and are reaching out to want to join. So we'll be rolling out this fall. And again, this is an open platform, an open ecosystem. We want to connect the world together.
Well, you're calling PayPal World a first of its kind platform, really. So, but for PayPal itself, should we read it as a shift from being a payments company to becoming this global payment infrastructure company? And, really, if wallets can transact across borders without needing PayPal accounts, what's your monetization model here?
Great question. So first, we are transforming PayPal from traditionally a payments company into what we're calling a commerce platform. And so commerce is what merchants and consumers need to be able to interact with each other. And we think we have the opportunity to really help our consumers, help our small businesses, help our merchants around the world do more than just payments. And so, yes, we are transforming the organization into a commerce platform. In terms of our monetization model, look, when there is more commerce that happens around the world, PayPal is going to benefit. We already are a part of a quarter of all the e-commerce. We have monetization models in place with our existing merchants. We've just given merchants that use PayPal in Germany or in the United States the ability to have access to close to 2 billion consumers just with these founding wallets. That is a huge opportunity for our merchants. And again, when commerce happens, we're going to be the platform to enable it, and we'll continue to grow the business.
You know, you're bringing together players like UPI from India, Tenpay from China, and, you know, Mercado from Latin America, different regulatory regimes there and very different, technical architectures as well. What were the biggest hurdles in making these interoperable, and how will you ensure that there is regulatory compliance across such a wide range of jurisdictions?
You know, we start with the vision, and the vision is, do we want to live in a world where wallets are interoperable? And, you know, every time I would talk to the CEO or a leader of one of these partners, we shared a common vision. And so when you start with a common vision and you start with, you know, the mindset that your users will continue to use your wallet, but we're now giving users and merchants the opportunity to interact with the world, then technology is always solvable. So we have created a technology platform. This is a platform that is future-proof. It's one that will continue to evolve. We will be investing in. And obviously, this creates opportunities for us to ensure that there's safety, security. This is something that PayPal has stood for the past 25 years and is known for around the world. And so we have standards on our platform and technology that ensures that things like KYC, KYB, all of the different security mechanisms to ensure that consumers can make purchases and feel safe and secure, and that merchants can transact in a very smart way. All of that is built into the platform. You know, what we really set out to do was ensure that there was as little friction as possible for adoption. And so from a consumer standpoint, you will just use your existing wallet, and you will now have access to all of the other merchants around the world. And from a merchant perspective, there's no additional integration needed. When we roll this out, your existing QR code or your existing tap to pay option will now just be available for all the wallets that are part of PayPal World.
Well, you know, you talked about onboarding more partners in the future. Could you tell us who those would be? Are you targeting any specific markets or regions or use cases?
You know, we really see a borderless world when it comes to travel and commerce. And so, you know, we will be open, we'll bring everyone in, and we want to make sure that, you know, wherever you as a consumer choose to travel, you know, the challenge you have now, you want to take your family on vacation, you know, you're either thinking about what is the cash that I need to bring and convert when I, you know, land at my destination, or what local wallet do I need to be able to go sign up for and try to get provision for. We want to eliminate that. So we want consumers to be able to make the choice wherever they want to travel for business, for pleasure, wherever they want to take their family. They can go, they can use their home wallet, where their money is, where their transaction history is, and just be able to check out online, in person, or in the future, agentic AI as well. So look, we'll be bringing on wallets, I know, from around the world, and we want to make sure that anywhere you choose to be, PayPal World is available.
Well, let's talk about India and your partnership with NPCI for UPI. How did that come together? And, you know, broadly, how do you view India's role in shaping the future of the payments infrastructure globally? And how central is UPI really to PayPal World's long-term strategy?
Look, I think one of the very first calls I made was to ensure that UPI would be a part of this vision, and it was a tremendous conversation with the leadership team there. They are exceptional leaders, and you know, a team that again shares this vision of an interoperable world. And they were, you know, tremendous partners throughout. And India is an essential geography for us, right? This is a country that is moving rapidly into digital commerce. There is vast acceptance of digital wallets. And, you know, I will say, even after we made our announcement earlier today, the number of inbound requests that I had from consumers just thanking me for including UPI, because there's so much commerce cross-border between different geographies around the world into India and out of India. I think this was one of the biggest and most important partners we could have, and I'm thrilled that UPI is a founding partner of PayPal World.
Well, Alex, if India is such an important partner, a quick word on your plans for the business here for PayPal, because, PayPal had surprisingly shut down its domestic business in India back in 2021 because, it said priorities had shifted. But of course, you now do have that in-principle approval from the Reserve Bank to operate as a cross-border payments operator. Will that be the extent of PayPal's presence in India? Do you have larger ambitions for the region?
Again, India is a critical region for us. We want to partner with the best that are out there, which is why we partnered with UPI. We have a lot of merchants in India right now that are using PayPal services. And I think with the PayPal World offering, we may see significant adoption of the services that we continue to offer. As you mentioned, we've got cross-border capabilities that our customers are loving, and we are continuing to see that business grow. So, India is a very important market for us, and one that we will continue to invest in, and we'll do it with partners that matter, just like UPI.
So no plans to be in the domestic payments business again in India, or any sort of investment plans for the region you could share to expand your business here?
Nothing to share at this time. We again have a tremendous cross-border business, and one that we want to make sure that we can create a differentiated offering when we come to a market. And right now there are tremendous offerings already in the India domestic market. We just want to make sure that when consumers and merchants want to interact with the rest of the world, they're using the PayPal World platform to be able to do it. So no new plans to announce today in terms of additional domestic investment, but we're very excited to connect the rest of the world with India and ensure that we're continuing to grow commerce around the world.
Well, Alex, when you took over this job, I remember hearing one of your first interviews talking about how you have competition, or PayPal sees competition from every player from A to Z. What sort of competitive response do you expect to PayPal World? Whether that is Swift, GPI, Visa Direct, I don't know, MasterCard, Apple. How defensible is PayPal World as a platform?
When you start with a mission and a vision that is truly customer back, truly at the heart of what a customer needs in terms of interoperability, in terms of frictionless commerce, then you've got a very strong leg to stand on. And PayPal, it really feels to me like we were built for this moment. 25 years of building a global presence that stands for trust and safety and security, and now opening up our leading wallets and technology to partner with the leading wallets around the world. I think this creates an incredible platform for us to continue to grow on. My expectation is, yes, this is a very competitive landscape. We're also, there's a lot of co-opetition that goes on. And so I expect that, many of the folks that we see day to day as partners are also competitors, and I welcome them to the PayPal World ecosystem. This is really about creating incredible experiences for consumers and for merchants. And if players want to be a part of that vision, then I want to welcome them to PayPal World.
Well, a quick word on another important piece for PayPal that you mentioned, of course, while announcing this launch, and that is plans to enable stable coins and other new payment methods into it. Could PayPal World eventually evolve into this, universal payment layer that'll include digital currencies, Web3 wallets, and the like? I mean, how do you see this evolving?
We have future-proofed the platform. Stablecoins are starting to really take off. We started to see some regulatory certainty here in the United States, even just within the last couple of weeks. PayPal has been a leader in stablecoins. We launched our US-backed stablecoin, PYUSD, a couple of years ago now. And if you just think about cross-border transactions and you think about the opportunity to provide, to use the blockchain to provide a stablecoin opportunity where there are lower fees, lower latency, high security, these are opportunities for us to really take the future of payments and innovate. And so, my expectation is, yes, as PayPal World continues to evolve, if there is consumer demand and merchant demand, particularly on cross-border transactions where stablecoins make sense, then PayPal World will be a big supporter and proponent of that. So, we think we have created the foundation and the platform to be able to innovate, and we welcome all of our partners to come in and build this with us and create incredible, delightful experiences for our customers.
All right, Alex, thanks very much for taking us through all of that. We look forward to how PayPal World shapes up and to using it. Thank you very much, Alex Chris, for your time here on CNBC TV18 today.
Thank you.
On that note, we're going to wrap up this special conversation. Thanks very much for tuning in. It's a goodbye from all of us.
Welcome to Indonomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indonomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Lata, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position, but again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, very in a very, very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Well, Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it will effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards the repo rate, which basically means that there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you two quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I mean, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly that it's not just the next couple of sprints, the next quarter. You have to look at it over the course of the year, probably across the cycle. So again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, I mean, this is not. You hear the argument that, I mean, it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because, I mean, obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack two quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? In the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, very, I mean, the amount of money that's being raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, I mean, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Okay. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Indianomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
It boils down to how you are looking at credit growth, whether you are looking at it from the demand side or you are looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front. And that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Shogata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12, 13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity? Every day, bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI. Would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samaran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12, 13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth, we'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12, 13% numbers by the end of this year.
Okay. A two-part question for you, Samir. And actually, I'll put it in two separate questions. One, this 12, 13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. it's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually in negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samiran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down, and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally, perhaps, at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news,
Yeah.
and you don't know if tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every
Sure.
dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well, So that they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think